Hello there. I hope that you're doing well. Welcome to the first lecture of the day trading model. This lecture is going to be about order flow. Before we begin this lecture, I want to share a few key notes with regards to this series. The first note is the following. During this series, I will guide you to a higher level of understanding price delivery. This does not mean that you will reach profitability after watching this series straight away. The reason why I can't promise you to become profitable is the following. You are an individual who has its own struggles. You might be given rules, but for some reason you are not disciplined enough to stick to those rules. You will bring a lot of mental struggles to this trading. And that's what makes it so hard. And we will have psychological lectures as well. So I will share with you insights how to overcome the majority of certain psychological struggles because I've been through them as well. Anyone that says that this can be easy, that it's easy to understand how these markets work and it's easy to make financial decisions based on them, is absolutely lying and you should run away when someone says that. Secondly, it's important to note that from the release of this lecture, every single week a new lecture will be finished until announced that the series is complete. And from there on, future add-ons will be added, but not every single week. And finally, I want to share with you the following. It's important to take proper notes from day one. So that means during this lecture, if you hear me say something that you believe to be valuable, you should write it down and then come back at a later point in time and restudy it. Because the greatest light bulb moments don't necessarily come whilst watching or studying new educational content. As weird as it may seem, the greatest light bulb moments that one can experience actually occur just while doing regular daily stuff. Maybe whilst going for a walk and you're thinking about that new concept that you've learned, and out of nowhere it clicks. Ah, that's why it works. And that's what I hope that you will achieve after watching this first lecture and the lectures that will come. Because that light bulb moment is the most beautiful thing that you can experience. And every single light bulb moment should be journaled and cherished. So, enough of the rant, let's begin with the order flow lecture. Before we begin, I must give you a risk disclaimer. I am not a financial advisor and I will not give you any financial advice during this series. All I will share with you is my understanding of price delivery and my view on the markets. This is meant for educational and or entertainment purposes only. If you want to read the full risk disclaimer and the terms of services that you have agreed upon when joining the mentorship, you can do so by going to our website, theonesthatknow.com, and then scroll through these files. This model is ideal for the personality that is interested in getting in and out of the market within a relatively short period of time due to a variety of reasons. The reasons that could be present for a person to be interested in day trading over swing trading can be the following. He or she does not want to be attached to the charts all day. And you might think, huh? Are Isn't it true that swing traders aren't only not attached to the charts all day? No. Reason why is because the model that will be shared with you is very time specific. So that means there are intervals during which we will look at the charts. We will not look at the charts outside of those intervals. And you might wonder, why would we do that? Because during very specific time intervals, the market delivers in a certain manner. So if we know that, our job is to show up during the right times. Because it's time that comes first and then price. It's not, okay, the price pattern is present and it doesn't really matter what time it is. It's London lunch, it's 5 a.m. in the morning, but you know what? I see a bearish breaker, so therefore I can trade it. No. You will be given very specific times to look for very specific algorithmic signatures within the delivery of price. And that's the goal of this model. And finally, this model is ideal for the personality that has a short attention span, meaning that he or she has not the ability to focus for long periods of time and therefore has to be very objective about during what times he or she will utilize their focus. So it means during what hours they will really focus and be present and only think about the charts. Before you watch this lecture, it's important that you have watched the foundation lecture, which has been uploaded on the 15th of December 2023 on the mentorship platform, and that you watched the beginning of the ipdax journey, which was uploaded on the 30th of December 2023. The reason why I want you to watch these lectures before beginning this model series is the following. I will not treat you like a complete beginner. I will be talking to someone who has already built up some understanding of how to look at price delivery from an algorithmic perspective. And the reason why I want to do that is because I do not want to make it too uncomfortable for the more experienced traders to look at these lectures. And I know that you might think, as a complete beginner, why aren't you then sharing it again, the knowledge? Well, because the knowledge has already been shared within these lectures. And just so you know, what I'm referring to is just a simple understanding of imbalances, a simple understanding of breakers, a simple understanding of just in general PD arrays, just sell liquidity, buy liquidity. I would not share that again within this series because I believe that you should already know this before you watch this series. So let's now really dive into this lecture. Before we can determine order flow, we need to know by what order flow gets measured. We will not be using any depth of market, volume profile, or whatever tool retail-minded traders might use that they believe to give them insights on the markets. All we will use is a blank chart. And on that blank chart, we will only use time and price. Meaning, at very specific times, we will be looking at very specific algorithmic signatures that will show us whether or not these algorithms are right now active within the markets. First of all, you might think, ZEUSSY, you just said we're not going to discuss any basic knowledge, and now you're showing us an uptrend. I know, but I'm going somewhere. Just wait. Here we can see an uptrend. An uptrend is basically that higher highs are being made. What we call this is bullish institutional order flow. Means that the market is going higher, retracing, higher, retracing, higher, retracing, higher, retracing, higher, etc. That's bullish institutional order flow. For bullish institutional order flow to occur, there has to be a market maker buy model. A market maker buy model is simply the following schematic. It means that there's a sell side delivery, aka delivery lower into a very specific price level, our point of interest. And from there on, buy side delivery occurs. So the market delivers higher and we see that uptrend occur. It's very important to note that this all has to occur during a TOI, aka a time of interest. If we anticipate higher prices, we will look for the POI to be reached during our time of interest and wait for signatures to confirm the SMR. The reason why this is important to know, because if we want to gauge order flow, we first must know, okay, what are potential key reversal prices where the market could tap into before reversing. And if we know that there's a certain price level that is significant, for example, a higher time frame PD array, and the market trades into that, then we can wait and see, okay, will any reversal signs be present? If not, okay, then the market is going to continue the original order flow. If it does, however, show signs of reversing, then order flow is switching and a change in the state of delivery is occurring. If we take a look at a downtrend, it's the following. Lower lows are being made and lower highs. So if we take a look at this, we see sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery, retrace. Sell side delivery. All right, so here we can see the market maker sell model schematic very simply put. So what we can see is that there's repricing higher into our point of interest, into that very specific price level during our time of interest. And if we anticipate lower prices, so if our narrative and higher time frame order flow is signaling to us, okay, well, we're likely to deliver lower for the upcoming period, then we look for that PY to be reached during our time of interest, and then we wait for signatures to confirm the SMR, aka the smart money reversal. And notice that we're not even looking at the different stages of the market maker models just yet. The market goes higher until the point of interest gets reached during our time of interest. Then we see signatures that confirm a reversal occurring, and from there on we see sell side delivery or lower repricing. Alright, so now we're going to take a look at reversal patterns. There are two possible reversal scenarios. The first one is a breaker block formation, and the second one is a mitigation block formation. There are no market reversals unless one of these two occurs. You can go into the charts after you know what they look like, and you will never be able to see a reversal occur without one of these two occurring. It's as simple as that. So let's take a look at the breaker block formation. As you can see, the breaker block formation is the following. We can see that sell side delivery occurs, the market reprices lower, a low gets engineered, the market retraces, creates a high, and that high gets utilized to send price lower once more, purging sell side liquidity, trading into our point of interest, into this price level, and from there on a reversal occurs, market displaces to the upside, and from there on we anticipate this upclose candle to be utilized as support moving forward. You might wonder, why would this occur? Why would we want to see that upclose candle act as support on price? It has to do with balanced price ranges. Balanced price ranges are the following. They are, in my opinion, the most important thing to understand when it comes to understanding the hierarchy of institutional order flow. A balanced price range can be understood when you look at delivery cycles from a seesaw perspective. So that means you start counting how many times each delivery cycle has occurred within a very specific price range. So if we start counting, we can see the following. We can see that sell side delivery occurs here. Inside of that sell side delivery, a CB gets created. The market offers buy side into that CB, and it then offers sell side again, trading away. Into what? Into the sell side liquidity engineered below this low. So it purchases that liquidity by tapping into our point of interest, and it then reverses to the upside. But hey, what occurs here? Buy side delivery gets delivered again. So from there on, if we start counting again, we can see sell side, buy side, sell side, buy side, but there's something missing. Why is there something missing? Because this buy side delivery higher has made the delivery within this price range, within this CB, imbalanced. So what has to occur is the following. The market has to reprice lower over sell side delivery before it is allowed to expand higher. And that's why you will always see a retracement form into a breaker block, and specifically into the imbalanced price range here before it continues to the upside. And it's the same for mitigation blocks. However, one important thing to note is that buy side and sell side delivery doesn't always necessarily mean that it has to first trade away a lot, so it means that candles have to be formed outside the price range and that it then retraces. That's a possible scenario. However, another possible scenario is the following, in which there's a wick of a candle that reprices above the high of the breaker block. I apologize for not having the box annotated perfectly to the high, but I wanted to show it clearly that this is the high I'm referring to. So the moment that a wick reprices above that high, it's already a confirmed change in state of delivery. And what's possible is that the next candle then completely shoots price higher after opening inside of that breaker block. Why is that allowed to occur? Because if that open occurs and sell side delivery occurs once more in the form of a wick, the market has already delivered efficiently inside of that price range and it's allowed to expand to the upside. So therefore, a breaker block, it's part of a balanced price range, and your breaker blocks form inside of imbalanced price ranges. So if we take a look at the mitigation block, the mitigation block looks like the following. A mitigation block is when sell side delivery occurs and the sell side delivery trades all the way into our point of interest, into the price level where we're anticipating a reversal to originate from. From there on, a high gets engineered. That high then sends price lower once more, but it does not create a lower low relative to this low, to the low that formed prior to the high. And then price expands to the upside. The up close candle is the mitigation block, and we can apply the same logic to see whether or not this is a balanced price range now when the market has retraced into it and expanded to the upside. We can see the creation of this CB here. Then the market retraces into that CB, into that bearish fair value gap. It forms a high, so it means buy side delivery has occurred, into a price range where only sell side delivery occurred. Then sell side delivery occurs out of it, buy side delivery occurs again. So you might think, oh, but now we have 2 times sell side delivery, 2 times buy side delivery, right? Yeah, but buy side delivery by itself already here has an imbalance inside of it. There's a BC that formed. So that means sell side has to be delivered again before the market is allowed to expand higher. So that is why we can look at this and say, okay, well, a mitigation block is basically a failure swing. There's a failure for the market to create a lower low after the creation of this high. Whilst for the breaker block, a lower low gets created, and that's why we call that a full swing. And one of the important things to note is that when a breaker block forms on one market, we usually see the formation of a mitigation block on a highly correlated market. And that means that one creates a lower low, whilst the other creates a higher low. And that's what we call SMT, Smart Money Tool, or Smart Money Technique. There's not a real name dubbed to it, but what SMT basically signals is that smart money is actively buying this market inside of a bullish scenario. For the bearish thesis, for the bearish breakers, just invert the logic, and the same for the bearish mitigation blocks. So for the bearish mitigation blocks, you would be looking at a high that would form, a low that would form, then a lower high would form relative to that initial high that formed, market displaces to the downside, then that last low is your mitigation block. And for the breaker, it's when a high forms, a low, a higher high forms, displacement below that low. Now that low that formed initially, which sent price higher, is your bearish breaker. So it's just the logic shared here, but then inverted. Alright, so here we are in the real charts. And I'm going to explain to you what I mean with a higher time frame retracement is the left side of the curve, and that the expansion leg on this higher time frame is the right side of the curve within a fractal market maker model. What we can see is the following. We can see that there's an indecisive candle that forms after we have seen multiple candles to the upside, right here. What then occurs is that a high gets created here, and the market then displaces lower or gets repriced lower into the high of this up-close candle here. This is what we call immediate rebalance. I'm going to take you with me to the lower time frames to see how price reacted off that immediate rebalance price level. But after that immediate rebalance occurs, we can see that the next candle immediately targets the buy side engineered above this high. So here we can see the lower time frames. And as you can see, this dotted line is the high of that previous higher time frame candle, aka the immediate rebalance that occurs. What we see is that buy side got engineered above these highs here. This is our original consolidation. Then the sell side of the curve unfolded here into that price level. After that price level was reached, the market then reversed, targeting buy side liquidity. If we go into even a lower time frame, we can see the following. We can see our market maker buy model in here. We can see that there's an original consolidation up here. Then we can see the distribution phases in which every retracement is being sold by smart money. And from there on, we can see that more buy side liquidity gets engineered here. Look at the equal highs that get generated. And the market keeps on displacing lower. Expand, retrace, expand, retrace, expand, retrace, expand, retrace, expand, retrace. Until it reaches that very specific price level at 1:22 p.m. And from there on, we can see that the market begins to deliver to the upside. Targeting what? Targeting the high of that candle, of that indecisive candle. And if we take a look at this reversal here, we can see our bullish breaker formation. Where do we see the bullish breaker formation? We see the bullish breaker formation inside of this up-close candle here. And the reason why this up-close candle is important is because this up-close candle formed, or this high formed, after we saw an initial leg lower, a low get engineered, boom, market retraces into what? Into this CB here. From there on, it gets utilized to send price lower once more into our key price level. Boom, some time distortion here. Don't get fooled by that. Begins to displace to the upside or expand to the upside. Imbalance forms inside of that breaker. Retrace, boom, sends it higher, targeting the buy side liquidity above that high. If we take a look deeper into this chart and we zoom in on the smart money reversal, we can see the following. We can see that I've extended this CB all the way to the right. And you might wonder, why is this high not important to you? Why not this high? Why specifically that high? It's because what I just outlined to you. When a high gets formed inside of an imbalance, the moment that that high gets broken and the moment that that imbalance gets broken or displaced above, if this was a CB, what we then want to see is that we want to see the price range of the CB and that up-close candle get utilized as support going forward, because a change in the state of delivery has been confirmed by then. It already gets confirmed earlier, but if this occurs, it's so sweet. And you will see it so many times in your charts. And I have dubbed this pattern in which there's a CB that gets formed, a high that gets formed in that CB, followed by a displacement leg above that high as the market structure shift pattern. But there's one more thing you need to note, as the following. Within the break of this high and this CB, within the price range that breaks through that high, there has to be an imbalance, there has to be a BC. This doesn't necessarily mean that the BC has to be created above this high, but it just means that in the sequence of candles that breaks through that high, there should be an imbalance that we can utilize to buy from going forward. And that's what we call the market structure shift pattern. So here's the final delivery where again the buy side liquidity above here got showcased. So let's take a look at another chart. As you can see, here we are on another chart. For those of you that are wondering what chart this is the DOR index chart and then the monthly chart. What we see is the following. We can see that the market consolidated here. It purged sell side liquidity below these lows, then reverted higher, or it retraced into this CB here. This is a CB because there's a lack of buy side delivery inside of the price range between this low right here to this high. The market retraces and it then begins to fall over, begins to expand to the downside. What I want you to understand is that by looking at this chart, we can see the following. We can see that buy side delivery occurs here, or a retracement, but within a lower time frame, we will be able to see that that buy side delivery is the left side of the curve within a market maker sell model. This expansion leg lower from that CB is what we call the right side of the curve, or the sell side of the curve within a market maker sell model. And what we see is that if we zoom in onto the weekly chart, we can see that this was the buy side delivery. Boom, market consolidated a bit and it then fell over. What we see is that inside of that sell side delivery, there are multiple retracements that occur. So you have an expansion leg lower, retrace, expansion leg lower, retrace, expansion leg lower. And the reason why I'm sharing this with you is the following. If we think back to what was shared with you, and we understand that a retracement on this time frame is the left side of the curve within a lower time frame or fractal market maker sell model, we already know that if we would zoom in deep enough or low enough on the time frames, note this is a weekly chart, we will see sell models all over the place. So if we know that the order flow on the highest possible time frames has shifted bearishly or has been bearish, then what we can see is that if we go into lower time frames, we can see that from those higher time frame price levels, smart money reversals occur, breaker block and mitigation block formations occur, and from there on reversals occur that gets utilized before price is allowed to expand higher or lower in this case. If we zoom in on that reversal point above here, we can see the following. We can see that a high gets created here, low, higher high. The moment that this low gets broken, it's already a sign of, oh, it's a change in the state of delivery, potentially. Why? Because this low formed inside of this CB. But what do we know then? We see that consolidation takes place. Why? Because it was not the right time yet for the market to reverse. So what then occurs is that within this down close candle, which is a bearish breaker here, there's another bearish breaker that forms inside that consolidation. Because what we see is that a high gets engineered here, a low, and that low gets utilized to then send price higher, taking out the buy side liquidity above here. What then occurs is that displacement occurs below that low, below that down close candle, market has to retrace. Why? Because smart money bought this down close candle and they need to mitigate their losses. So the market gets offered higher, retrace, boom, gets utilized to send price lower. And what I want you to understand again is that within this retracement leg higher, there's a fractal market maker sell model that formed. Buy side of the curve into a price level where we can anticipate a smart money reversal to occur from, followed by the sell side of the curve. The same occurs here, where we see a low form here, 2 equal lows, market retraces into the CB, institutional order flow entry drill takes place, boom, price gets sent lower, taking out the sell side liquidity below here. And what I want you to understand is that within a lower time frame, a market maker sell model is present here again. Buy side of the curve, sell side of the curve. It happens in every single market stage. All you need to do is go into low enough time frames and you will see the market maker sell models occur. Simple as that. So let's now take a look at time frame synchronization. Before we can use time frame synchronization to determine the drawing liquidity, we need to first know how to spot institutional order flow. It is crucial that you understand this, because without an understanding of institutional order flow and or narrative, you will get caught up in chasing price patterns for the sake of chasing price patterns. It will make you just a new retail-minded trader. It will just make you a bull flag or whatever animal pattern you might use trader. That doesn't matter. It doesn't matter that the pattern occurs. What matters is that the pattern occurs at a very specific point of interest at the right point in time during a time of interest. That's what matters. So how do we determine order flow and narrative, really? First of all, we can look at the news and the general market sentiment. We know that when markets are going higher and when the news is becoming very bullish, euphoric, so to say, we should be cautious, because we know that news gets utilized, or that leg higher gets utilized for smart money to open short positions against, to sell against. So when the news turns bullish and price is near or at premium race being premium breakers, premium mitigation blocks, premium inefficiencies, premium balanced price ranges, premium volume imbalance, etc., premium liquidity pools, we should be warned, because we know that they use that news for manipulation purposes. When the news turns bearish and price is near or at discount arrays, we should also be warned. Discount arrays coming in the form of, for example, discount balanced price ranges, discount breakers, discount mitigation blocks, discount imbalances, BCs to be precise. And we know that they utilize that news for manipulation purposes again. So when the markets are dropping, we want to be looking for signs to justify looking for buy signals if the higher time frame order flow is bullish. So let's take a look at the same schematic again, but let's now add another variable to the sequence. The variable that we've now added is the following: news. As we can see, during the sell side of the curve, news gets released. This news gets utilized to send price lower into our point of interest during our time of interest. This news gets utilized for the final repricing lower before the real move is allowed to occur. And that's something that a lot of people seem to not get. Many people that have been trading and they have been investing, they have been active in the stock market, etc. And we also ask them the question, what usually happens when positive news comes out? What follows? Well, usually they say the price begins to start dropping. So what happens when bad news comes out? Well, usually the price begins to start rising after a period of time. So that means that initially there can be, if the news is bearish, a leg lower. But that leg lower follows that higher time frame order flow into that price level that we've been waiting for. And from there on, a buy program unfolds, sending price higher. And it's funny to realize that because then it makes sense how the whole smart money paradigm sets you free from all retail minded traders, their beliefs, because they look after the fact why something has happened. We look on the right side of the charts, that blank area that no one has ever seen or touched. That's our goal as smart money minded traders. If we take a look at the market maker sell model schematic that I've been utilizing with you so far, we can see that there's a leg higher, and near the end of that leg, near the reaching of our point of interest, news gets released during a time of interest that sends price higher into that price level that we've been anticipating and waiting for. And from there on, a sell program begins and price is distributed lower. So again, the function of the news was to send price higher. Once more, trap retail-minded buyers into believing that the markets were going to continue to rise. Boom, lower time frame, break or mitigation block formation during the right time, and there it goes. Smart money reversal confirmed. And here's an example of that. As we can see, this is an article of Reuters, however you pronounce it. And what we can see that on the September 20th, 2023, they wrote an article saying the dollar index on the verge of forming a bullish golden cross. The Bank of America says. So the Bank of America is a pretty substantial bank within America. And they said that the dollar index was likely to form a very bullish retail-minded pattern, so to say. If we take a look at the dollar chart in a bit and see when this news article was released relative to where dollar was at, and we look at it from the perspective that I'm teaching you to look at the markets from, a light bulb moment should go off. At September 20th, that article came out from Reuters. It was inside of this candle here on this day that article came out. Notice that afterwards there were only about 10 candles that were still inside of an uptrend. And from there on, a monthly CB gets reached, that CB that we discussed. And from there on, the sell side of the curve unfolds. And what I'm trying to prove to you here is the following. The moment that, so to say, legitimate sources or reliable sources or governments come out and they say something that is against our higher time frame idea of what should occur, it's the best confirmation tool that we can utilize because we know that they manipulate these markets and they utilize the news for repricing purposes. So therefore, I suggest you to just go into your own charts and see when certain things were said and what was followed. Because if we think about what occurred in 2020 when the C virus came out, I'm not going to say it out loud because then this mentorship platform might be shadow banned or something like that. I'm not too worried, to be fair, because it's our own platform, etc. We're not depending on any sources, but still I'm being careful with saying that because we know how it goes on the internet nowadays. Because that C-virus came out, we saw the markets drop for a few months. There was panic. People were like, huh, what's happening? And blah, 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 all of that stuff. However, what followed was one of the most explosive bull markets or higher repricing events that occurred in the past decades. So what we can take away from that again is that the news gets utilized for repricing purposes, and therefore we can anticipate news as well to come by simply looking at the charts. What happens is already priced in, and the news comes after the fact. And I'll let you think about what that really means about how controlled and engineered this world really is. Secondly, to spot institutional order flow, we will be looking at the relationship of the PD arrays that get created and act as support or resistance, or fail to do so. Within bullish order flow, our eye is drawn to a blue shaded box here on the left side of the curve, on the sell side of the curve. Inside of that blue shaded box are inefficiencies, CBs to be precise. The market reprices into our point of interest, into our price level during our time of interest. Boom, market expands to the upside. And because these CBs are failing to act as resistance on price, meaning the market doesn't retrace into that CB and then continues lower, because it fails to occur because those CBs fail to act as resistance on price, it's a sign to us that a change in the state of delivery is occurring or has occurred. Because if we take a look at, or if we think back to the example that was shared prior with you with regards to the market maker buy model on Nasdaq, and we think back to that CB that got created, then a high formed inside of that CB, market was sent lower. After reaching our point of interest, the market traded above that CB, and now that CB began to act as support on price moving forward. The reason why that's important to note is because if the market would be bearish, that CB would not get broken, it would not get violated. So if it does get broken, as we can see occur, then we can say, okay, now buy side is likely to be the draw next. But only if our point of interest has been reached during a time of interest and we see the confirmation signs that we will be looking for. And here's another example. What we can see is that there's a CB on the left side of the curve that got created here. A high formed inside of that CB. This is that same price example again, by the way, but annotated a bit differently. What we see is that that high gets created inside of that CB, price gets sent lower afterwards, purging the low that was utilized to even create the high in the first place. Then the market reverts, and from there on, a buy program begins. But what confirms the buy program? Well, if we take a look at this price action and we see this CB, this is the most significant CB inside of the final leg lower to my eye because this high formed inside of it. So the moment that price breaks above that high, I want to see the candle of that high be utilized as support moving forward. And the fact that price broke above this CB signals to me, okay, there's a willingness for the market to now move higher. And if we take a look at all of the CBs that followed afterwards, or I mean the CBs that got broken afterwards, we can see a CB here. Fails to act as resistance on price. Price breaks through it, boom, begins to act as support on price. Next CB, up here, price breaks through it. Here, boom, CB begins to act as support on price. Next CB, here, price spends a bit of time in it, but eventually breaks through it. And then that CB begins to act as support on price. So what I'm showcasing to you is that we need to look at the left side of the curve in order to determine how the right side of the curve is likely to deliver. I will go more on depth in this later because we will specifically look at the left side of the curve to also justify entries and trade management. However, for now it's important to note that the moment that the imbalances on the left side of the curve begin to fail to act as resistance on price, we need to be warned and we need to anticipate higher prices to occur next. So if we are taking a look at bearish order flow or the market maker sell model, our eye is drawn to BCs that form inside of that final leg higher, targeting or price level or point of interest. The moment that those imbalances get broken, get violated, we will be looking for a change in the state of delivery to have occurred, and therefore sell side delivery is likely to be next. Because if the market was going to continue higher, it would retrace into those BCs and then continue higher. Here we are again on the dollar chart, and what I've done is that I've annotated all the BCs and extended them to the right. All the BCs that are significant to my eye and that are easily spotted by you. What we can see is that the highest BC here got broken through, and notice that all the bodies closed inside their price range. There were a few wicks above it, but the wicks do the damage and the bodies tell the story. What we then see is that this BC is also relevant. Why this BC specifically is because we can see that a real significant low formed inside of that. Same can be said about this BC here. Next BC is here. And notice how price is first finding support in or at those BCs, retrace, boom, gets broken. This BC again, market trades into it but completely overshoots it. Market trades into a lower BC as well. This is where short-term low gets created. Market retraces. Look at the bodies closing below 50% of that inverted fair value gap. Boom, sends lower. And the reason why I'm showcasing this to you is because of the following. I want you to see how price is moving through those imbalances on the left side of the curve and how it's referring to those imbalances on the right side of the curve. This is what we mean when we say that the left side of the curve influences the right side of the curve. And this is how we can gauge institutional order flow. So we have come to the end of the order flow lecture. I want to give you some homework. I want you to go into your own charts and study all of the times price reached a POI that you deemed to be relevant and PD rays began to fail to act as resistance or support on price. If you are looking at market maker buy models, your eye should be drawn to the CBs on the left side of the curve to see whether or not they're acting as resistance on price going forward. If you're studying market maker sell models, your eye should be drawn to the BCs that form inside of the left side of the curve and their unwillingness to be utilized as support before being sent higher. You should study at what time or what time interval this reversal period occurs, in which the imbalances begin to fail to act as support or resistance on price and the market begins to show signs of reversing. I want you to collect at least 30 plus charts that have been annotated in depth before watching the next lecture of the model series. The next lecture will be about point of interests. We will create this mechanical rule-based model step by step. I want to thank you for watching this lecture. Be safe, and I look forward to welcoming you within the next one soon. Welcome to the second lecture of the model series. During this lecture, we're going to discuss points of interest. Before I'm going to begin with this lecture, I must advise you to first watch the first lecture if you didn't yet. Next to that, you should have done the homework before watching this lecture. The reason why I want you to do those things is because you're else going to do yourself a disservice by already taking a look at this lecture. I know it may sound stupid or it may sound weird, but that's just the way effective learning gets done. You follow the structure that gets provided. You don't just jump from this to this to this. No, you follow the structure that gets provided, and then eventually you will notice that the growth takes place by following that structure. So that's why I'm advising you to do those things. Before we begin with this lecture, I'm going to first give you a risk disclaimer. I am not a financial advisor. Everything that I say and share within this lecture is meant purely for educational and/or entertainment purposes only. If you want to read the full risk disclaimer and terms of services that you agreed upon when signing up, you can do so by going to the website that can be seen within the webpage. Next to that, you can go to theonesthatknow.com/terms of service and you will be able to find all of the details. So let us take a look at the schematic that was shared with you initially during the last lecture. In this schematic, we can see bullish order flow, aka a market maker buy model. We can see the sell side of the curve right here. Sell side delivery occurs into a point of interest during a time of interest, and from there on a smart money reversal occurs and the market reverses and goes higher, targeting buy side liquidity. If we anticipate higher prices, we look for the POI, the point of interest, to be reached during our TOI or time of interest, and we wait for signatures to confirm the smart money reversal. During this lecture, we're going to focus on what this blue line is and on what this point of interest is. So here's the bearish order flow example, the market maker sell model. As you can see, repricing higher occurs, buy side delivery into our point of interest during our time of interest. Boom, market reverses and it delivers lower, offering sell side delivery. Again, we're going to focus on what this blue line specifically is during this lecture. So first of all, we're going to start with something very basic, but it is important that you understand this. So take notes. Higher time frame PD array as a POI, or that means that we will utilize a PD array on a higher time frame as a point of interest. So what this could mean is the following. We could utilize higher time frame balanced price ranges, breaker blocks, mitigation blocks, and imbalances as point of interest on the lower time frames to see whether or not market maker models can unfold from them. If we take a look at a few schematics that I've created for you, I want you to do the following. I want you to take a screenshot of each schematic. I'm sorry if the watermark is on it when you're going through the video initially. Just wait because it will eventually move and then just take a better screenshot. I want you to save those screenshots somewhere and I want you to utilize them when you go into your own charts to investigate to see whether or not there's any validity behind what I'm saying. So here we can see the first schematic. As you can see, this is the schematic in which there's a CB on the left side of the curve right here that gets extended to the right. Market taps into that, boom, expands higher. That's what it looks like on a higher time frame. But what I will share with you today will open up your eyes when it comes to knowing when and where market maker models unfold on the lower time frames, because every single move has a market maker model in it. It's as simple as that. You will never find a market move that does not have a market model in it, and that shows the beauty of them. So if we zoom in on this delivery right here, on this down close candle, and the candle next to it, you can see that equal highs get created here. Market then opens with this candle, it trades lower. What do you think this looks like on the lower time frames? That delivery lower is the sell side of the curve within a lower time frame market maker buy model. Here we then see that the POI, the point of interest, this old CB gets reached, this blue line. Smart money reversal takes place, and then this big up close candle occurs, which is the buy side of the curve. And that's how you can see whether or not market maker models unfold in one another. It's the fractality of the markets explained. If we take a look at the next example, we can see the breaker block example. For the breaker block, we can see that a low gets engineered after sell side delivery occurs. Here, market retraces into what? Into this CB, creates a high. That high gets utilized to send price lower once more. Purging the sell side liquidity below this low, it displaces to the upside. Boom, it retraces into the breaker block, finds support there, continues higher. That's what it looks like on a higher time frame. But if we zoom in again on this delivery, on the delivery that has been annotated, we can see that equal highs closely got engineered right here between this indecisive candle and this down close candle. This down close candle delivers sell side into the breaker block. So that is the left side of the curve within that buy model. Then the market reaches that red line, that high of that breaker block. That's where your smart money reversal occurs, and that's where the low of this candle forms. And from there on, buy side delivery occurs, and the buy side of the curve gets delivered. So we have seen a few examples so far, and I'm going to keep on showing you examples until you understand this. A higher time frame retracement followed by an expansion is a lower time frame market maker model. I'm going to repeat that for you. A higher time frame retracement followed by an expansion is a lower time frame market maker model. If we take a look at the following example, we can see that there's a mitigation block. A mitigation block because there's sell side delivery. A low gets created here, market retraces, it forms a high, but doesn't create a lower low. Instead, a higher low gets created. Market expands above the high, it displaces, and from there on, you can see that a retracement occurs into that candle's high, and from there on, you can see that the market aggressively expands higher. If we zoom in again on this delivery right here, we can see that equal highs get engineered right here. That's our original consolidation. If you didn't notice that yet, then this downcast candle is the sell side of the curve within our market maker buy model. So our sell side of the curve in the falling, we can see that market expands away from the original consolidation. It retraces here, first stage of distribution or a low sell, second stage of distribution, and finally a third stage of distribution or redistribution. Then the market expands aggressively into the mitigation box high, which is annotated by this fat red line. Smart money reversal occurs right here, and boom, buy side delivery occurs, targeting the original consolidation and beyond. Now, imagine the following. Imagine knowing that you're in a higher time frame buy program. So that means on the highest possible time frame, the markets are bullish. And you go into a bit of a lower time frame. For example, let's say that you're bullish on the daily time frame and you go into the hourly time frame. Let's imagine that on the hourly time frame, you see this scenario play out or unfold, in which there is a mitigation block creation, market retraces into that during the right time of day. You see a low form, boom. How sweet is that? How sweet is it when all time frames align? How sweet is it that when you're bullish from the most highest possible time frame, And you can see that bullish bias work on the lower time frames as well, because it's all connected with one another. Without these lower time frames fluctuations, that higher time frame bullish scenario, that bullish bias, will never play out. But if you know that in order for a higher time frame bullish scenario to play out, lower time frame market maker models will form, you seriously have such a big advantage. Because then it's not random anymore why the market goes up or why it retraces and then aggressively goes up again. Because you know that on the higher time frame it's drawing to a specific price level, it's drawing to a key liquidity pool or a key PD array / imbalance. Alright, so let's take a look at another example. Here we can see a sell side delivery lower, low gets engineered, retrace, form a high. This high is your bullish breaker, but we're not paying attention to the bullish breaker now. Sell side delivery occurs again, purging the sell side liquidity below here. Market displaces above this high. It retraces into what? Into this BC, into this bullish fair value gap, and that's our PY for this scenario. So we have this bullish fair value gap on our chart. Then we see that there's relatively equal highs that got created here, or a trend line that can be drawn from this high to this high. Retail thinks, okay, a high is in, we're now gonna go lower. This is our original consolidation, sell side of the curve into what? Into that very specific price range that we're anticipating for an SMR to form in. Market reaches that bullish fair value gap, forms a low, displays to the upside, boom, there it goes. Targeting buy side liquidity above these highs right here, which is our original consolidation on a lower time frame. So let's take a look at the same scenario, but now without the whole bullish breaker stuff added to it. This is purely a BC that got formed. And this is a scenario that you will notice unfolds in very bullish markets in which there's a lot of speed and velocity behind the markets. So it's in a rush to get somewhere. What you will notice then is that there are a series of consecutive up-close candles, and between those consecutive up-close candles there will be the creation of a BC. And if the market did not reach the high time frame objective yet, that BC will be utilized to send price higher. So the market will retrace into that over sell side of the curve on the lower time frame market maker buy model, reach that BC, and then from there on continue higher, targeting buy side liquidity and drawing towards that higher time frame objective. So let's take a look at the bearish examples. Here we're taking a look at the bearish examples, and as you can see, we're going to begin with the bearish breaker block. We can see that buy side delivery occurs right here. A high gets engineered, market forms a low inside of a BC. It then expands higher, purging the buy side liquidity before displacing below that low right there. This low then becomes your bearish breaker. So we're going to take a look at the delivery inside of here. The delivery that forms inside of this down close candle, inside of this up close candle, and inside of the next down close candle looks like the following on a lower time frame. We see an original consolidation, which gets formed here. Then the buy side of the curve unfolds into our bearish breaker price level or into the bearish breaker low. And on a lower time frame, we will see that a smart money reversal unfolds inside that bearish breaker, and from there on we see the sell side delivery of the curve occur into the sell side liquidity engineered below the first candle that broke below the bearish breaker and lower eventually. So let's take a look at the bearish mitigation block. As you can see, the bearish mitigation block comes in the form of the following. We can see buy side delivery, a high gets formed, market creates a low inside of this BC, but it fails to create a higher high in the run afterwards. Instead, it makes a lower low. It then displaces below the mitigation block. We're going to focus on this delivery right here. Market retraces into that mitigation block here. Inside of this delivery, there's again a market maker sell model that's present. There's a expansion leg lower, displacement, retrace, continuation. And inside of that fractal, on a higher time frame, you will see those market maker models. Always. So here we can see that origin consolidation, bicep of the curve into that mitigation block low, smart money reversal, boom, there it goes, lower. So here we're going to take a look at the bearish CB scenario. This occurs when there's a lot of bearishness behind the marketplace. It's in a rush to get somewhere. And what you will see is that then when there's a series of consecutive down close candles, that a CB will form. When the market retraces into that CB and it fails to break above it, we anticipate a lower time frame market maker sell model to occur. So that means we're anticipating that this low that got created right here is going to get targeted once the CB gets reached. So that low is our original consolidation. Then the bicep of the curve unfolds into that CB's low, smart money reversal, boom, sell side of the curve. There it goes, targeting this sell side liquidity right here, and eventually lower. Are you noticing how we're moving from a higher time frame fractal to a lower time frame fractal consistently? I know that some of you are probably already like, why is he sharing so many examples? Because I want you to understand this. You need to understand this. Because once you truly see it, repeat over and over again, you will see and you will know. Simple as that. And repetition is key to getting to understand this. So I know that some of you are already like, are these all the point of interest that we can utilize? Is this all there is? Of course there isn't. This is just the most basic version of a point of interest, so to say, from which a market maker model can unfold. We're now going to take a look at something more advanced, which is time-based liquidity. Time-based liquidity is a form of liquidity that is purely based on time, because I am of the opinion that liquidity pools themselves don't mean anything. Simply as that. A liquidity pool is only significant when it formed during the right point or right window of time. Simple as that. And I will explain to you what I mean by that statement. All times that I will discuss from this part on will be in New York time. And just so you note, every time that I will ever discuss within the mentorship is based on New York time. First of all, we're going to take a look at previous month liquidity. So that means if we're now in January, we're going to look at December's high and low. We're going to focus on previous day's liquidity. So that means if we are currently on Tuesday, it means that we're going to focus on Monday's high and low. We're also going to focus on previous session liquidity. So that means if we're now in the New York morning session, we're going to focus on the London session high and low. And finally, if we're currently in a new 90-minute cycle, we're going to focus on the previous 90-minute cycles, their respective highs and lows. You might think, why is this important? Because if you start to see how the market reacts of these very specific price levels during the next time windows, a whole new level of understanding will be unlocked, and you will never look at the markets from the same perspective again. So let me explain to you how we can study this. We're going to take a look at rather simple schematics. We're going to focus on PXH and PX low. X being a variable that can be replaced by whatever time window we're interested in. So if we're swing traders, we're going to focus on higher time windows, of course. We're going to look at, for example, daily highs and lows, weekly highs and lows, monthly highs and lows, yearly highs and lows, etc. So what we're looking for is when we're bearish, we're going to look for a run on buy side liquidity on the previous X high. From there on, a smart money reversal will occur within a lower time frame sell model, and we will target the PX low. If we're taking a look at the buy model, which occurs if we're bullish, we're going to look for the following scenario. We're going to look for a run on sell stops below PXL, and then we're going to look for a smart money reversal to occur here, targeting buy side liquidity above PXH. And here comes the gem for why this works and why it occurs. The reason why this works is because the market is allowed and it's programmed to move at very specific times of a day, times of week, times of month, times of year, even during specific years it's allowed to move aggressively. And in order for those aggressive moves to occur, a lot of liquidity has to be engineered during a previous time window. So that means that during a previous time window, the market will create a sentiment that, for example, a low is in. So if we're taking a look at an intraday example, it would mean that during the previous day's delivery, they will have created or engineered a lot of sell-side liquidity below that previous day low because they want to create the idea, okay, we're now very bullish. What they will do is that they will run on those stops during the next day's delivery, taking out all of those buyers that got in prematurely, purging the sell side liquidity, and then they will reverse it below that previous day low, targeting the previous day high. And it occurs so many times that you would be surprised that if you would go into your charts and you would study this by how many times it has occurred without you even noticing it. It's because you are purely focused on price, you are purely focused on price patterns, whilst you are ignoring the most important part of it all, which is the time aspect. At what time very specific things occur. And that's something that a lot of people just seem to miss. And it's understandable because you need to dig deep. You need to pay attention to details. And unfortunately, many people are lazy. It's as simple as that. So let's take a look at the previous day liquidity example. Previous day liquidity, I'm now just going to rename the X to the day. So previous day liquidity is relevant in the following sense. If we're bearish, we're looking for a run on the previous day high within a sell model. The smart money reversal will occur above the previous day high, then the sell side of the curve will unfold towards previous day low. If bullish, we're looking for a run on the previous day low. Smart money reversal will occur below there. Boom, buy side delivery towards the previous day high within a market maker buy model. Session liquidity. We're now going to take a look at the session liquidity. So it means the previous session high gets taken out. Smart money reversal will occur above there within a sell model, and then the sell side delivery occurs targeting the previous session's low. If bullish, we're going to look for a run on sell stops below the previous session low. Market maker buy model, its SMR, smart money reversal, will occur from below there. Boom, we're going to target buy side liquidity above the previous session's high. So now we're going to take a look at all the sessions that I deem to be relevant. We're going to first of all begin each day with Asia. Then we're going to focus on the London AM session, New York AM session to be precise, lunch hour, and the PM session. Each one of these sessions has different reference points that it will refer to whilst trading inside that session. And with reference points, I mean relevant liquidity pools. I will now share what liquidity pools are relevant during each session. But before I do that, I will tell you the following. Because we have these sessions on our charts every single day, we must understand that each session refers to the previous session or to the previous sessions. So that means that London refers to Asia. The AM session refers to London and Asia. The lunch session refers to the AM session, London and Asia session. The PM session refers to lunch, AM session, London and Asia. Here we can see the schematic more in depth with more details. As you can see, during the Asia session, there are no significant draws on liquidities that we can target. This doesn't mean that we can't trade Asia. It does mean, however, that Asia has very minor price runs usually. So when we know that, we need to be very nimble if we ever decide to trade Asia. During London, we can refer to the Asia high and low. And we can refer to the previous day's highs and low. During the AM session, we can refer to the London high and low, and the Asia high and low, and the previous day high and low. During lunch, we sit on our hands and we do not really try to refer to anything. However, if you do decide to trade lunch and that you see that lunch is likely to move aggressively, then what you refer to, or what we refer to, is to all of the previous time windows. But for now, within this schematic, I have just decided to say, okay, for the model that I am teaching you, you will not often trade during lunch. It's as simple as that. There will be a few very rare instances in which you will see the model that I'm teaching you play out during lunch, but lunch trading requires a bit of a, how to say that, a bit of a different touch to the model. It doesn't mean that it doesn't work and that the price patterns that we will eventually utilize don't work during lunch. It just means that the majority of times lunch will not move as clean as if, for example, the AM or PM session would, or London to say the least. So if we're taking a look at the PM session, we can see that we refer to the lunch high and low, the AM high and low, the London high and low, the Asia high and low, the previous day high and low. And are you noticing that there's a hierarchy to the lows or highs that are relevant during the current session? Notice that the most recent session is the most important for the session that we're currently in, but the other sessions before that recent session should also be noted when it comes to what liquidity pools could be targeted. This schematic was first shared within the time PDF that I shared and released within the Ones That Know back in February of 2023. And since then, many knowers, members of the Ones That Know, have experienced light bulb moments when it comes to time and when it comes to deciphering when certain things are allowed to occur and specifically where as well. Because by looking at the markets from this perspective, it doesn't become random anymore, so to say, why the market formed a high or low there during the current session and then reversed. Because we know the reference points, we know what levels are relevant. We know what levels ipdax is locked on, and now combine this logic of previous XH, previous X low, to what was shared during the beginning part of this lecture when it comes to the higher time frame PD race, and trust me, a whole new world will open up for you. And as you might note, I have decided to share sessions and not speak about kill zones. The reason why I've decided to share sessions instead of kill zones is because I'm not a big fan of the use of kill zones anymore. Because I do not look at London close as London close kill zone. I look at it as the end of the AM session. And that's why you see 5 boxes here, whilst in the time PDF there was 6. So to summarize, you now know what points of interest we can utilize to look for smart money reversals in. You now know in what higher time frame delivery there is a lower time frame market maker model. So it means that you now know that a higher time frame retracement followed by an expansion leg or continuation leg is a lower time frame market maker model. You got introduced to the concept of time-based liquidity, and you now know the importance of PXH and PXL, and even more important to that is the following, is their relationship to higher time frame PD arrays. The moment a smart money reversal is confirmed, we target opposing arrays and liquidity pools. So that means that if we're in a market maker buy model, the moment that the smart money reversal is confirmed right here, we target buy side liquidity above all highs on the left side of the curve, and more specifically the original consolidation. As a beginner, as someone who is new or who has just started to learn about market maker models, what you can do is that you can draw a range with your Fibonacci tool from this high right here, the high of the original consolidation, to the low of the smart money reversal, measure where 50% is at, where the range midpoint is at, and try to target that. Simple as that. If you can consistently target that, you can then say, okay, let me now try and target the full market maker model, so targeting the original consolidation. You grow into that. You will not go out there after learning, after studying, after investigating, and just be able to say, okay, I'm now going to target original consolidation within every market maker model, because that requires experience that you simply do not have yet, looking at the markets from this perspective. So within a sell model, it's exactly the same, but then inverted. What we can see is the following. We see buy side of the curve into our point of interest, smart money reversal. When that's confirmed, we look to get short inside of a retracement leg, and then we target range midpoint, 50% of the range from this low to high, and eventually the original consolidation. So your homework for this lecture is the following. I want you to collect 30 plus examples in total of the market reversing if it's bearish above the PXH, and the market reversing if bullish below PXL. And now comes something that's important for you to note. Go on the time frame that you are interested in learning how to trade on. If you are interested in learning how to trade like me on the lower time frames throughout the day, so very specifically during the AM or PM session, then what you will do is that you will go into the lower time frames, meaning for example a 1 minute chart, and you will go out there and you will just study how price is reacting to the previous session's liquidity. And after we have shared the importance of time during the upcoming lectures, you will then be able to utilize 90-minute cycles as well for your studies on these time frames during these time windows. If you are interested in learning how to swing trade or hold positions for a longer period of time, you will be looking specifically at previous week's liquidity, or previous month's liquidity, or previous year's liquidity, etc. And you will study how price reacts off those liquidity pools. And note that this all occurs within one-sided institutional order flow on a higher time frame. And every run lower If bullish is considered manipulation, and every run higher, if bearish, above a PXH is considered manipulation as well. The next lecture will be on time and how we can actively use it. I want to thank you for watching this lecture, and I look forward to speaking to you in the next one. Hello there. Welcome to the third lecture of the day trading model. This lecture is going to be about time. Before we start this lecture, I must first give you a risk disclaimer. I am not a financial advisor. Everything that I say and share within this lecture is meant purely for educational and or entertainment purposes only. If you want to read the full risk disclaimer that you have agreed upon when subscribing to the mentorship or joining the ones that know, you need to go to our website and you will be able to read it there. Before you watch this lecture, I must share something with you, and that's the following. You need to know how to determine the order flow. If you do not know how to determine order flow, this lecture will do you no good because it's above your current level of understanding. Next to that, you need to know how to determine the draw on liquidity. Again, if you do not know how to determine the draw on liquidity, this lecture will again be of no benefit to you just yet. You need to know how a true market maker model functions and its characteristics, because again, if you do not understand the full inners and outers of the market maker models, this lecture will do you no good, because time is by far the most advanced concept to even discuss, but also to learn about. This is not me saying to you don't watch this lecture. Of course, you should definitely watch it, but first make sure that you have these three things noted correctly within your notes and that you have studied them at least and that you have followed on through the homework assignments that have been provided to you during the past two lectures. This is me as a mentor guiding you in the best manner possible, and this is not me saying, okay, don't watch this. This is just me giving you reasonable advice and saying, okay, you should first do this, and then when you understand that, come here. So let us take a look at the table of contents for this lecture. This lecture is going to be the longest lecture by far so far of the model series. The reason why this will be the longest lecture is because, again, time is the most advanced concept that you can discuss. And therefore, I want to go in great detail with you with sharing how I interpret time and utilize it within my own trading. So first of all, we're going to take a look at the sessions of interest. These sessions are the following. First of all, we're going to take a look at the London session and the characteristics that are present during London. After that, we're going to take a look at the morning session. And finally, we're going to take a look at the afternoon session. As you may notice, we're not going to look at the Asia session because in my opinion, Asia is not a great session to trade. So let's begin with the sessions of interest. For Forex, so for trading, for example, Euro or GU, your focus should be on the London and morning session. The afternoon session can be skipped for Forex. The reason why this is my advice is because the London and morning session usually provide the most volatility for the main markets of interest. And therefore, I would always look for setups in Forex during the London and morning session. For the index futures, I would focus on the London, morning, and afternoon session. However, here comes something very important. Please do not try and trade every session. You should pick the session or sessions that suit you best and let go of the others. If you notice that, for example, the London session fits best in your daily schedule, due to, for example, work or due to a personal life, etc., then your focus should just be on the London session and you should ignore the morning and afternoon session. If due to your personal routine, the morning session fits you best, focus on the morning session and let go of the London and afternoon session. If, for example, the afternoon session fits your schedule best, focus on the afternoon session and let go of the London and morning session. If you want to take it a step further and you are full-time, then I would suggest every single index futures trader to look both at the morning session and the afternoon session. During this lecture, I will share very specific time windows during which we will be looking at the morning and or afternoon session. We will not be stuck to our charts all day because that's not effective trading. Effective trading is the following. You know when and where you're looking for very specific things to occur. You're not looking for, oh, I see a breaker setup, therefore I'm going to trade this breaker setup. No, that breaker setup will only be valid during the right period of time at the right point of interest. And that's where I'm trying to guide you towards. Here we can see the sessions and their time-based draws on liquidities. As we can see, during the Asia session, there are no significant draws on liquidity. During the London session, our eye is drawn to the Asia high and low and to the previous day high and low. During the AM session, our eye is drawn to the London high and low, to the Asia high and low, and to the previous day high and low. During lunch, we usually sit on our hands, and during the PM session, our focus is drawn to the lunch high and low, to the AM high and low, to the London high and low, to the Asia high and low, and to the previous day high and low. As you may notice, there are 5 boxes, 5 significant time windows that I look at. The reason why there are 5 significant time windows has to do with the following. I try to look at sessions purely, but within the sessions themselves, I divide the sessions into 3 parts, and that's something that we will discuss during today's lecture more in depth, why I like to do that. Before we begin with looking at the sessions, I must first share an important note with you, and that's the following. We will discuss delivery profiles. Each scenario has its own characteristics. Our job is to determine what scenario is likely to occur. This does not mean that every single day there will be a profile that we would be able to engage in, and that's okay, because not every single day is a trading day. Later on, within the model series, we will discuss environment selection more, and then we can basically already see when those profiles that we will discuss today will likely occur and when not. And the days on which they are likely to occur, we need to, of course, be present. That's when our shop is open. That's when we allow customers, which are setups, to enter the store, and we can either treat them in the right way, or we can let go of them and just ignore them and don't service them. These delivery profiles do not occur every single day, and therefore you cannot force their occurrence. You need to wait and see whether or not the signatures that we'll be discussing today are present on the day that you're looking at if you are looking for setups to form. So let us take a look at the scenarios within the London session. First of all, the main question that we will be asking ourselves if we take a look at London is the following. What has Asia done? The first model that we will be discussing in a bit is the Asia High, Purge and Revert model. After that, we will take a look at the previous day High, Purge and Revert model. Then we will discuss the Asia Expansion model for shorts. Then we will take a look at the Asia Low, Purge and Revert model. After that, we will take a look at the previous day low, purge and revert model. And then finally, we will take a look at the Asia expansion model for longs. So let's take a look at the Asia high, purge and revert model. For the Asia high, purge and revert model, we will be looking at the following. We will be looking at, first of all, a market that is predetermined to go lower. So from the higher time frames, we have established that the market is likely to draw lower towards a sell side objective, a key liquidity pool, or to an old imbalance that price is likely to revisit. When we know that, and we have seen that Asia consolidated, then what we will look for is for a run higher around 2 a.m. towards the Asia high, and above the Asia high, we want to see the signatures occur that we have been discussing during the model series. So for example, the left side of the curve, their respective discount arrays get violated, or a lower time frame breaker setup forms, market structure shift pattern, change in the state of delivery occurs after the Asia high gets purged. During what time? During 2:30 to 4. If no reversal occurs during 2:30 or 4, I would walk away from the London session. From there on, I want to see displacement to the downside occur, and I want to see sell side delivery occur. What would be the first drawn liquidity? The first drawn liquidity would be the Asia low, and secondly, that higher time frame objective that price is likely to draw towards. The second model that we will be looking for during the London session is the previous day high purge and revert model. This model again occurs when the higher time frame order flow is bearish and we're looking for lower prices. What we will be looking for is a run higher to originate from around 2 a.m. and from there on we want to see the market draw towards the previous day high. When the previous day high gets traded above, we will be looking for signs to confirm a smart money reversal during 2:30 to 4. During this time window, we want to see a high form above the previous day high, and we want to see a change in the state of delivery occur on the lower time frames. From there on, we want to see displacement lower occur, which confirms that sell side delivery is likely to be next. This is a rather simple model that can be spotted quite easily when we take a look at previous day highs and how London trades above them. This scenario sets up a classic sell day in which London creates the high of the day, it expands lower, AM retraces and then continues the London trend towards that higher time frame objective. The next model that we will be looking at is the Asia expansion model for shorts. This model sets up when Asia is an expansion leg lower, so that means during the Asia session we saw speed and velocity to the downside. Then from the midnight opening or around the midnight opening, we want to see a retracement occur into an imbalance that formed during the Asia session. This run higher traps retail buyers into believing that higher prices are likely to be next during the London session. The market reprices into that inefficiency. A lower time frame market makers sell models smart money reversal forms inside of that CB. And from there on, we want to see sell side delivery occur. This model again occurs when the higher time frame order flow is bearish and price is drawn to a higher time frame sell side or inefficiency objective. This retracement leg usually forms the high of the day for the market to then continue lower, and this model occurs within fast markets. Again, we want to see the high form between 2:30 to 4 a.m. The next few models that we will be looking at for the London session are the same models but then for longs. So what we're going to look for is for a Asia low purge and revert model, in which we want to see that Asia has engineered liquidity on both sides of the marketplace. And from there on, we want to see that around 2 a.m. a manipulation run lower occurs, purging the sell side liquidity below the Asia low. A smart money reversal forms here during 2:30 to 4. And from there on, we want to see that market shows a willingness to trade back above the Asia low and show lower time frame change in the state of delivery signatures to continue price higher towards the Asia high. This model sets up when the higher time frame order flow is bullish and the market is drawn towards buy side liquidity or to an all-in efficiency. You might be wondering, Zeus, why are you putting emphasis on around the 2 a.m. window? Because around 2 a.m. you will usually see a volatility injection during the London session. That volatility injection can be utilized for manipulation purposes. If there is a news event during the London session at a specific time, that news event is release could also be utilized for that final manipulation leg towards the point of interest, which is the Asia low, from which a smart morning reversal can occur to reprice higher. Now we're going to take a look at the previous day low, purge and revert model, where we see that around 2 a.m. a manipulation leg begins, market draws towards the previous day low. The moment that the previous day low gets purged during 2:30 to 4, we're looking for signs of a smart money reversal occurring below that low, and from there on we want to see price trade back above the previous day low to confirm a lower time frame change in the state of delivery, and from there on we want to see a buy program unfold towards the previous day high if the higher time frame order flow is bullish. The next model will be that Asia expansion model, but now through longs. This model occurs when we see an expansion leg during the Asia session. We want to see a manipulation leg lower originate from the midnight opening, and then we want to see price trade into a imbalance that formed during Asia in a discount during 2:30 to 4 a.m., where we will be looking for a lower time frame smart money reversal to occur from to target buy side liquidity next. The buy side liquidity that we will be targeting is above, first of all, this high and the buy side liquidity that was engineered in the past where the market is drawing towards. This retracement into that Asia imbalance usually sets up the low of the day, and this occurs during very bullish market environments, and this is the first step to seeing whether or not a classic buy day is likely to unfold, where London forms the low of the day, and we can then look for buys during the AM session as well if the higher time frame objective has not been met just yet. What's important to note is that what I shared with you so far with regards to the London session is rather simple. It's rather basic when it comes to determining point of interest and what to look out for. And the reason why I'm keeping it simple for the London session is because of the following. London has a characteristic where if you are looking at index futures, its respective 90-minute cycles delivery are not that clean compared to the AM and PM session. If you are looking at London for example, EU or GU, then you will notice that what you will be able to do is that when you have established that a higher time frame POI is, for example, a BC that forms during Asia, you will notice that during the first 90-minute cycles of London, which is 2:30 to 4, you will see that if you fractalize that 90-minute cycle to 30-minute windows, where you have 2:30 to 3, 3 to 3:30, 3:30 to 4, you will notice that if 2:30 to 3 doesn't yet trade into that imbalance, 3 to 3:30 will form the low, and from there on 3:30 to 4 will confirm the smart money reversal. This is something for you to look into, and when we discuss the 90-minute cycles more in depth during the AM session in a bit, it will be more clear to you to how to apply this logic. So to finalize the schematic that we've been discussing so far during the past few lectures, we have the following schematic, where if we are bullish, we are looking for the following. We are looking for sell side delivery to occur into a point of interest, into a discount array or a PXL, for example, previous session low, specifically the Asia session low or the previous day low, during 2:30 to 4. And from there on, we want to see buy side delivery next if the higher time frame order flow is bullish. It's important to note that time cycles, they shift. So that means that you should be flexible when it comes to, for example, saying, okay, I want to see it specifically occur during 2:30 to 3 or 3 to 3:30. That's why I've given you a 90-minute window to look out for. When we take a look at the bearish example, we are looking at the following. We're looking for repricing higher into a point of interest, into a premium ray and PXH during 2:30 to 4 a.m. Again, this occurs when the higher time frame order flow is bearish, and we want to see a smart money reversal occur within that point of interest during the right time, and then we want to see sell side delivery occur next. So to summarize, here are the times of interest for the London session. During 2:30 to 4 a.m., I want to see a smart money reversal form. If no reversal is present during this time window, I will walk away from the London session. I need to see an expansion leg during 3:30 to 4 a.m. towards the targets. If, for example, the smart money reversal occurs at 2:45 a.m., I don't anticipate the market to go sideways until 3:30 a.m. I want to see it begin to expand from at least 3 a.m. on. So that was the London session. My focus as a trader is mainly on the AM and PM session, so it's time to go deep into time during those sessions. First of all, we're going to begin with the regular trading hours. The regular trading hours are from 9:30 to 4 p.m. Often a gap will form between the closing price of the previous day and the opening of the new day. This is called the regular trading hours gap, or the RTH gap. Price will seek to reprice back into this gap to rebalance it before expanding. This information is useful because if we know that there's an RTH gap present, then we can anticipate price to trade back into that gap or reprice into that gap to rebalance that inefficiency before expanding and continuing the real order flow. So let us begin with the 9:30 opening. The 9:30 opening is for me the most important opening price of the whole day. The reason why this is the most important price for me is because this is the open or the beginning of the regular trading hours. And we will always see a volatility injection during the 9:30 time window. If we take a look at why we are looking at the 9:30 opening specifically, we will be looking for the following. If we are bullish, we want to buy below or in close proximity to the 9:30 opening price. If we're bearish, we want to sell above or in close proximity to the 9:30 opening price. The 9:30 opening price is, in my opinion, the most important reference point that we can have on our charts throughout the whole trading day during the regular trading hours. Before the 9:30 opening, we can of course trade. There are still algorithmic signatures present. However, the 9:30 opening is a very important confluence for me when it comes to determining high probability setups. If we are looking at how 9:30 can deliver, we can look at the following. We will be looking at 9:30 opening profiles. It's important to note that these profiles are again scenarios that could occur. If they do not show signs of occurring on the day, I will walk away. We ideally want to see 9:30 create a false run against our narrative, against our analysis on where the market is likely to draw towards, and form a smart money reversal afterwards. This false run engineers liquidity and traps traders that fell for that manipulation. So this is what it looks like. On the left side, we can see what occurs if we're bullish. We can see that the market is trading lower, and then pre-9:30 a low gets engineered right here, and from the 9:30 opening the market completely rips lower. This repricing lower is the final manipulation leg before buy-side delivery comes next. The reason why this is so important is because every retail-minded trader will look at this manipulation leg lower and they will think to themselves, well, we have seen a 9:30 opening that was so bearish, therefore today is likely to be a bearish day. They are purely looking at this, they are not looking at narrative, they are not looking at where's the market like to draw towards, they are simply looking at the price pattern that forms here for them. People that buy or sell on a breakout will sell below this low, and what do? We buy those sell stops. And from there on, we see buy side delivery occur next because the higher time frame order flow is bullish. For the bearish example, we can see the following. We can see that pre 9:30 a high gets formed right here. Market then retraces. During 9:30, a run on the buy side liquidity above that high originates. And we can see that after that high gets purged, a higher high forms and the market begins the real sell side delivery program. Again, the reason why it secures is because of the following. From the 9:30 opening, they will reprice it higher and people will chase that. They will buy that because they see big green candles on that charts. Especially when those people are purely looking at the 9 or at the regular trading hours. So the 9:30 opening is the first time that a candle begins to print on their charts. And you would be surprised how many people just look at the regular trading hours. So what they see is that from here on, they see opco candles, opco candles, opco candles, opco candles, opco candles, and then out of nowhere it begins to turn. They are surprised why that happens, but they are already in their long position. And if they do not cut their trade when the market shows that it's forming a high here, they will get stopped out, or they will not even get stopped out and their account will be blown. We do not care about what those people do because we are purely focused on ourselves. When we look at this, we need to recognize that there are people that are making that mistake, and that's our enemy, that's our target, that's the opposing liquidity on our trades. So when we see that manipulation run higher towards the high that formed pre 9:30 into our point of interest, because that's important to note. Our point of interest is here, and for the buy model, our point of interest is here. When we see that occur, we will be ruthless and we will wait for our signatures to confirm that this is the high, and from there on sell side delivery is likely to be next towards our higher time frame draw on the liquidity. This is what the manipulation looks like within the buy model, and this is what the manipulation looks like within the sell model. The gray boxes represent this. Another 9:30 opening profile is the following. If 9:30 trades in our anticipated direction, we want to see a fake high or low form and then rip against our direction. This will be a false move before the real smart money reversal forms. Let me show you a schematic to explain what I mean by this description. This false run engineers liquidity again. What we see is the following. We are bullish on the marketplace. From 9:30 on, we see that the market rips higher and it forms a high. Again, what does every retail miner trader think when they see that? They want to buy that market. And what occurs afterwards is that sell side delivery occurs and the market gets repriced below the sell side liquidity that was engineered from the 9:30 opening. Why was sell side liquidity engineered? Remember everyone that was purely looking at the regular trading hours and tried to buy this from the 9:30 opening? They placed a stop below that opening price. So the market purchased that sell side liquidity, forms the smart money reversal inside of a point of interest, and from there on the real delivery occurs towards higher prices. For the bearish example, it looks like this. We see that the market trades higher. From 9:30 it begins to rip lower. Everyone goes short. What does the market do? Or what occurs? It gets repriced higher, purging the buy side liquidity that got engineered above this high, and then the real move occurs. Again, what I want you to note is how I'm looking at manipulation from that very specific time. That's so important to understand and note. This is what the manipulation looks like. If bullish, this whole leg higher is the manipulation leg. And if bearish, this is the whole manipulation leg from the 9:30 opening. But you could even argue that the real manipulation is everything above the opening price. And that's a valid argument as well. But what I'm showcasing here to you is that multiple manipulation legs follow after another. If you truly believe that the market is driven by algorithms, looking at the markets from this perspective will make every single market move logical to you, and you would never be surprised anymore why the market did what it did. Because if you look close enough, you will always see the logic that I'm sharing here with you occur, no matter what. This does not mean that you will be profitable trading these concepts. I cannot guarantee you profitability. I am purely sharing with you my own opinions on the marketplace. And again, this is in accordance with the terms of services and the risk disclaimer that you have agreed upon when joining my mentorship and subscribing to the platform. So the smart money reversal occurs below that 9:30 opening price, and this orange box represents that if bullish, and if bearish, this orange box represents the smart money reversal within that sell model. We'll now be looking at the morning session scenarios. First of all, the main question that we will ask ourselves is the following. What have Asia and London done thus far throughout the trading day? The first model that we will be looking at is a London high purge and revert model. Secondly, we will be looking at the Asia high purge and revert model. And thirdly, we will be looking at the previous day high purge and revert model. We will also be looking at the London low purge and revert model. We will be looking at the Asia low purge and revert model. And we will be looking at the previous day low purge and revert model. And finally, we will be looking at the London expansion models. So first of all, we're going to take a look at the London high purge and revert model. This model occurs when we have seen that the London was going sideways or was consolidating, I should say. We then see that the market begins to trade higher. We want to see that around 8:30 a.m. a leg higher begins, a run higher. 8:30 is a very important opening time during the AM session, and we will discuss in a bit why this is an important opening time. It is also an important opening time, by the way, because a lot of high impact news usually originates or gets released around 8:30. What we want to see is that the market begins to trade higher into that buy side liquidity above the London high. We want to see that price level gets traded above during 9:30 to 10:30. For the viewers that are paying attention, they will notice that for the AM session, we have 1 hour for our point of interest to be reached, whilst for the London session, we had 90 minutes. And that's what I mean with saying that AM and PM are more precise time-wise than the London session when it comes specifically to the index futures. So between this time window, we want to see the market trade above the previous day high, and we want to see a smart money reversal occur from there. We then want to see displacement to the downside, and from there on we want to see sell side delivery occur next. This model occurs when the higher time frame order flow is bearish and the market is drawn to a key sell side objective or old inefficiency. The next model that we will be looking at is the Asia high purge and revert model. This model occurs when Asia was a consolidation, London was an expansion away from that original consolidation, and we see that around 8:30 a run higher begins towards that Asia high. This run higher is the buy side of the curve within a market maker sell model. We want to see the market trade above that Asia high during 9:30 to 10:30, and we then want to see signs of a smart money reversal originate from there. From there on, we want to see displacement to the downside. And from there on, we can anticipate that the market will draw towards the London low and the higher time frame sell side objective and inefficiency if the higher time frame order flow is bearish. And it's important to note that everything lies around determining drawing liquidity and knowing the higher time frame order flow. And that's why I shared with you that if you did not understand those topics just yet, this lecture should not be watched. Because unless you understand those things, these delivery profiles will not do you any good so far. So let us take a look at the next schematic. The next schematic is a previous day high purge and revert model. This model occurs when we see that Asia was a consolidation, London takes out both sides of Asia, and we then see that around 8:30 the market begins to reprice higher towards previous day high. We want to see this high get reached during 9:30 to 10:30, and we want to see a smart money reversal occur above that previous day high, and we want to see signs of a change in state of delivery occurring to target sell side liquidity below the London low and below all of the other significant sell side pool liquidity pools. This model is fairly straightforward, just like the others. We're now going to take a look at the London expansion model for shorts. This model occurs when we are in a very bearish market and the market is drawn to a key sell side objective. We then see a expansion leg during London, which leaves behind an inefficiency, a CB to be precise. Around 8:30, we want to see a retracement occur into that CB, and between 9:30 to 10:30, we want to see that CB get reached, and from there on, we want to see a lower time frame market maker sell model get confirmed to target the sell side liquidity below this low and draw towards the higher time frame objective. Let us now take a look at the bullish examples. First of all, we're going to take a look at the London low purge and revert model. We want to see that around 8:30 the market begins to reprice lower into the London low, and we want to see a smart money reversal occur below that London low between 9:30 to 10:30. When the market then displaces to the upside and trades back above the London low, we will see our bullish breaker formation here, and we can then anticipate higher prices to be next if the higher time frame order flow is bullish and the market is drawn to buy side liquidity or an old inefficiency, especially in the form of a CB. If we're taking a look at the Asia low purge and revert model, it looks like the following. Asia was consolidation, London expanded to the upside, but did not continue higher. Instead, the market retraced lower, and from 8:30 we want to see sell side delivery occur. We want to see manipulation to the downside occur. Where could the market potentially reverse? Below the Asia low. We want to see the Asia low get reached between 9:30 to 10:30, and we will be looking for signs of a smart money reversal occurring below there during that time window. And if we see that order flow is shifting bullish intraday, we will first be targeting the London high, and after that the higher time frame objective that we are targeting. And then another model is the previous day low purge and revert model, where Asia was consolidation, London took out both sides of Asia, and then we see that around 8:30 the market begins to sell off again. Into what? Into the previous day low, and then between 9:30 to 10:30 we want to see that previous day low gets taken. We want to see a purge of that occur, and we want to see displacement to the upside occur. When that displacement occurs and we have taken out the sell side liquidity, we want to see the market draw towards the buy side liquidity above the London high and the liquidity resting higher. And the final model for longs during the AM session is the London expansion model, where we see an expansion leg during London that leaves behind an imbalance. Then between 8:30 to 10, yep, 8:30 to 10 specifically, we want to see a retracement occur. We will discuss this soon. Why? But we want to see that BC gets reached between 9:30 to 10:30. We want to see a low time frame smart money reversal occur, and we will be targeting buy side liquidity resting above this high and higher. This model again occurs when we are in a fairly bullish market and the market is in close proximity to the higher time frame objective. So let us divide the morning session in 90 minutes now. First of all, 7 to 8:30 is the accumulation phase. This is the first 90-minute cycle of the morning session. This cycle is referred to as AM1, the first cycle of the AM session. The second cycle is 8:30 to 10. This is the manipulation cycle. This cycle is referred to as AM2. The third cycle is 10 to 11:30. This is the distribution cycle. This cycle is referred to as AM3. So what we have is that we have accumulation, manipulation, distribution. 7 to 11:30 AM is my AM session. That's how I look at the AM session. And we will now take a look at this AM session through the lens of these 90 minutes. We will now look at the AM session through the lens of 90 minutes. First of all, we are looking at the following scenario, in which a purge of the first AM cycle's high, AM1H, and referred model occurs. The second model will be a purge of the second AM cycle's high and a referred model. The third scenario will be a purge of both the AM cycle 1 as the AM cycle 2 highs and referred model. We will then be looking at the purge of the AM cycles 1 low and referred model, and we will then be looking at a purge of the AM cycle 2 low and referred model, and finally we will be looking at a purge of the AM cycle 1 and AM cycle 2 their lows and referred model. It doesn't take long if you start putting in the work in your own charts after getting introduced to this theory to see the validity behind this theory. So let us take a look at the schematics. The first scenario is a purge of the AM cycles 1, his respective high, and a referred model. The AM cycle 1 is between 7 to 8:30. This is the accumulation phase of the AM session. We can see that the market is consolidating. Buy side liquidity is being engineered above those highs. Then during the second 90-minute cycle, between 8:30 to 10, we can see that the market trades above that previous cycle's high and it reverts lower. It displaces to the downside. Then between 10 to 11:30, the market distributes quickly lower. What is occurring right here inside of this consolidation? Inside of this consolidation, orders are being accumulated. That means that smart money that have very deep pockets, that have a lot of money, they accumulate shorts here. They then manipulate higher to short once more to trap buyers, to trap retail buyers to be precise, into believing that the market is going to go higher. They buy this on a breakout and they try to capture a run higher, whilst smart money is opening more shorts here. This is the manipulation phase. And then distribution occurs and the market begins to sell off because the higher time frame order flow is bearish. So to summarize this scenario, we see a run on the high that forms between 7 to 8:30 during 8:30 to 10, and this sets up the highest price of the AM session, of the morning session, and then the market begins to fall and it distributes going into lunch at 11:30. The second model is the following. This is a model in which, or a scenario slash profile, in which there's a purge of the AM too high and a revert occurs. This occurs when the accumulation cycle has went sideways, the manipulation cycle took out the previous cycle's high, so the high of the accumulation cycle, but it did not displace to the downside yet. Why not? Because usually there is a high impact news driver at 10 a.m. that will be used for repricing and manipulation purposes. So what they do is they hold the markets sideways or going sideways between 8:30 to 10, and then at 10 a.m. that high impact news driver gets utilized to send price higher once more, trapping buyers into believing that it's gonna go higher. Buys and liquidity gets taken out here. Smart money sells short against that, and the market begins to roll over quickly during the distribution 90-minute cycle between 10 to 11:30. And then finally, the third scenario that we will be looking at is a purge of both the AM1 high as the AM2 high and revert model. So what we are seeing is the following. We are seeing that both the accumulation cycle as the manipulation cycle were going sideways. Why does this occur? Again, due to a high impact news driver being later on within the AM session, or no high impact news driver at all, and the market just being held inside of a consolidation until a volatility injection at 9:30. What we see is that the market gets repriced higher above these equal highs, above that buy side liquidity. A high forms above there, and the market then begins to distribute quickly. What I want you to take away from this is the following. You might have looked at these schematics and thought, what is he discussing? What is he sharing? I am sharing to you algorithmic reference points without even having to look at the London session or the Asia session. I'm purely looking at 90-minute cycles here. And I don't need to know that, or I don't even have to look at my chart to know that in here a higher time frame POI gets reached during this 90-minute cycle and a high forms inside that POI and the market begins to fall over because time and price are meeting. At the right point in time, a smart money reversal is occurring at the right price. Alright, so now we're going to take a look at the AM long scenarios. The first long scenario is a purge of the first AM cycle's low and a revert should occur after that. This occurs when the first AM cycle has been a consolidation, when the market went sideways, then at 8:30 the market begins to run lower, purging the sell side liquidity below 7 to 8:30, below that first AM cycle. Smart money buys down here. This is where the low of AM forms, and the market then reverses and it shows a willingness to deliver higher. Then between 10 to 11:30 the market will distribute higher very rapidly. This scenario usually unfolds when there's a high impact news driver at 8:30 that gets used for manipulation purposes inside of a very bullish market. If we take a look at the second AM scenario, we can see the following. We can see that this is a purge of the second AM cycle's low, and the market then reverts higher. This occurs when between 7 to 8:30 the market has been delivering lower, then during 8:30 to 10 the market continues this sell side delivery, so the market is drawn lower. Why is it drawing lower? Because on a higher time frame it is retracing into a point of interest. Think back to the market maker lecture where I shared with you that the higher time frame retracement is a lower time frame sell side of the curve within a buy model that will be followed by a right side of the curve higher if the market is going to continue to be bullish. So what we see is that between 8:30 to 10, the market begins to deliver lower. But notice that between 8:30 to 10, a low gets engineered, the market retraces, and it then continues lower. It's vital here that at 10 a.m. the market is not yet below this low. So below the low of 8:30 to 10. Because we want to see a final manipulation leg occur at or around 10 a.m. to create a new AM low during the 10 to 11:30 window. Once this low is in, the market will displace to the upside and will then reprice higher aggressively because it's within the distribution 90-minute macro. So this is the purge of the second AM cycle's low and revert model. And I'm now going to answer a question that some of you might have already been asking yourselves. And that's the following. But Zeus, how do I know which model is going to unfold? First of all, you look at characteristics of what are the cycles doing this far. Are they consolidating or are they expanding aggressively? Secondly, you should wonder, or you should ask yourself the following. What is the point of interest where price is likely to trade into and continue from with the real institutional order flow? So if we're bullish, we want to have determined a discount array that could be utilized for a smart money reversal to originate in within a fractal market maker buy model. And we then want to see a previous cycle's low get engineered right above that point of interest, because that previous cycle low is engineering sell side liquidity inside of the point of interest. And it's funny because all the buyers that are buying during that previous cycle and are placing their stops below that previous cycle low, below that low that gets engineered, do not know that below them a real institutional price level is laying that will be utilized to originate a reversal from. They are buying it too soon. And that's how these markets are programmed and engineered. They engineer liquidity right before key market reversal points. When we see that occur and we see that Persian liquidity, it's the most sweetest thing you can see. So let us now take a look at the final delivery cycle scenario for the AM session. This is a purge of both the AM first cycle's low and the second AM cycle's low. This occurs when during the first AM cycle the market has been trading inside of a range, then towards the end it reprices lower, forming a low, but it immediately reprices higher back into the range. Then during 8:30 to 10 the market creates a higher high relative to the previous cycle's high, and it then falls lower. But notice that equal lows are being engineered right here. This is the engineering of sell-side liquidity, but not just any sell-side liquidity. No, it's engineering of 2 cycles worth of liquidity. So during the final AM cycle, during the third AM cycle, 10 to 11:30, there's a significant reference point and liquidity point that can be targeted for manipulation purposes. So when we see these relatively equal lows get engineered and the market shows a willingness to manipulate below that, this is the sweetest purge that we can look for. And when we then see the displacement occur, it is likely to reprice higher very quickly. Again, this scenario occurs when there's high impact news around the end of the AM session, so around 9:45 to 10 a.m., or when there's no high impact news at all and 9:30 is the main volatility driver for the AM session. It's important to note that all these scenarios that have been shared with you only occur throughout the day when there are obvious higher time frame, institutional order flow, either bullish or bearish present. If they're not, we can't go into the lower time frames and look for these signatures. We simply can't, because then we will get caught up in chop. Because if the market goes sideways, if it consolidates, if it goes into a seek and destroy profile. That's not something we like. And again, later during the mentorship and during this model series, I will share with you key insights on environment selection and how we can recognize these models and these scenarios likely not playing out. Because knowing when not to look for these scenarios is more important than knowing what they look like. To summarize, here are the time of interest for the AM session. During 9:30 to 10:30 AM, I want to see a smart money reversal form. I preferably want to see signs of a reversal between 9:50 to 10:10. The reason why I preferably want to see signs of a reversal between that time window is because that time window is a 20-minute macro. This macro has the characteristic of introducing or injecting speed and velocity into the marketplace, and therefore we want to see a reversal occur during that time window. If no reversal is present during the full hour window, so between 9:30 to 10:30, I will walk away from the charts and I will go on with my personal life. Because I know when the sweetest setups form and when they don't. And if a reversal is not occurring between this time window, then that means to me that, okay, we're likely to see either continuation of chop or we're going to see a late AM session reversal that I am not interested in. I would rather come back during the PM session, during the afternoon session, and see if there's something to trade then. I need to see an expansion during at least 10:30 to 11:30 towards the targets. If, for example, the smart money reversal occurs at 9:45 AM, I don't anticipate the market to go sideways until 10:30. I want to see it begin to expand from 9:50 to 10:10 on. So here is the final schematic of the schematic that has been shared with you ever since the first release of the first lecture of the market maker buy model, where we can see the sell side of the curve into a point of interest, and this point of interest has to get reached during 9:30 to 10:30. This point of interest is the discount array and the PXL. From there on, we want to see a smart money reversal occur, and on the lower time frames, this looks like a market maker buy model. For the sell side delivery, we can see the following profile, in which a market maker sell model occurs, where the market reprices higher into a premium array or PXH. This is our point of interest, and this point of interest has to get reached during 9:30 to 10:30. This is our time of interest for the AM session. We want to see a smart money reversal occur on the lower time frames right here, and from there on the sell side of the curve. Let us now take a look at the afternoon or PM session. The main question that we will ask ourselves is the following. What have the morning and lunch session done? You will notice that I look at lunch as the first part of the PM session. I will share more on this in a bit. The first model that we will discuss is a purge of the lunch high and revert model. The lunch cycle by itself is already the first cycle for the PM session. The second model that we will be looking at is a purge of the AM and lunch high to revert model. We will then be looking at a purge of the lunch low or the first PM cycle slow and revert model. And we will also look at a purge of both the AM and lunch low and revert model. Let us now take a look at the PM session through the lens of 90 minutes. The first 90-minute window of the PM session is the 11:30 to 1 PM window. This is the accumulation phase of the PM session. This is also what we call lunch. The second 90-minute cycle for the PM session is from 1 PM to 2:30 PM. This is our manipulation window. Then the third 90-minute cycle is from 2:30 p.m. to 4 p.m. This is our distribution cycle. Let us take a look at the first scenario for PM. This is a purge of the lunch high and a reverse scenario. This scenario unfolds when AM was an expansion lower. This is showcased by this red box. Lunch consolidated, engineered relatively equal lows relative to the AM cycle. And from there on, we see that lunch trades higher from the 1 p.m. opening. Why does it trade higher from the 1 p.m. opening? Because this manipulation leg higher towards the lunch high induces buyers into the marketplace. Every retail-minded trader will look at that leg higher and think that lunch is going to continue higher after AM expanded lower. So lunch would set up a reversal in their minds. We do not look at it that way because we know that the higher time frame order flow is bearish and that price is drawn towards a key sell side objective. Therefore, we are looking at this run higher as manipulation and we want to see a smart money reversal occur above the lunch high between 1:30 to 2:30 p.m. It is important to note that it is not required for AM and lunch to create relatively equal lows for this scenario to unfold. It is also possible that lunch could already take out the AM lows and that the market would then still trade above the lunch high and then reverse above there. All we are looking at currently is the relationship between the first PM cycle, which is the lunch cycle, and the second PM cycle, which is from 1 p.m. to 2:30 p.m. When that trades above the lunch high, we are looking for signs of a smart money reversal occurring above there if the higher time frame order flow is bearish. If we take a look at the following scenario, we can see a purge of the AM and lunch high followed by a revert. This occurs when the morning sessions high and the lunch sessions high are relatively equal, or if the morning sessions high was, for example, already taken out during the lunch cycle, then the first PM cycle will trade above the lunch cycle's high, purge the buy side liquidity above there during 1:30 to 2:30, and from there on form a smart money reversal to distribute lower if price is drawn towards a key sell side objective on the higher time frame. If we take a look at the bullish scenarios, we can see the following. This is the purge of the lunch low and revert scenario, in which the market sells off from the 1 p.m. opening right here. It retraces, then continues lower, purging liquidity below the lunch low, forms a fractal smart money reversal here between 1:30 to 2:30 p.m. and we see buy side delivery unfold, targeting the lunch high. This scenario unfolds when the higher time frame order flow is bullish and price is drawn towards a higher time frame price objective which is above the current market price. The function of the lunch cycle in both scenarios, by the way, is to engineer liquidity that can be targeted at a later point in time. Again, it is important to note that AM and lunch do not have to have created relatively equal highs for this scenario to play out. It is important, however, to note that AM should be an expansion leg higher and that lunch should be a consolidation or retracement into an imbalance from the AM session. So we have not only the liquidity that's important, the time-based liquidity that gets taken at the right point in time, but we also have the imbalance that gets traded into. And then the final scenario we're going to look at from these simple schematics is the following. Is a purge of the AM low and lunch low followed by a revert. Again, this occurs when the market has created either relatively equal lows during the morning session and during lunch, or that the lunch session already took out the morning's low but relatively speaking, price is already below the morning low, so therefore we can anticipate that the market will try and seek the nearest possible key sell side liquidity, which is below the lunch low. And the moment it gets reached between 1:30 to 2:30 p.m., we will be looking for a smart money reversal to occur below that low, from which a market maker buy model can unfold if the higher time frame order flow is bullish. What I want you to take away from all of these schematics that I'm sharing with you is that I'm speaking in if this then that terms. All these schematics are only valid if it's clear that the market is either going to go higher or lower. If it's not clear where the market is drawing towards, we will not be looking for these scenarios to play out. So let us now take a look through the lens of 90 minutes at the PM session from a model perspective. So we have already taken a look at the first section here, which was a purge of the lunch high and a revert model. This was, I believe, the first slide. Then the second bullet is the purge of the second PM session's high and revert model. Third bullet is the purge of the first PM high and both the PM2 high, followed by a revert. The fourth bullet is a purge of the first PM cycle's low and revert model. This was again a previous slide. And then we have the purge of the second PM cycle's low and revert model. And finally, the purge of both the first as second PM session's low revert model. So here is the purge of the second PM cycle's high and revert model. This occurs when during lunch a consolidation occurred, and then during the second 90-minute cycle, the market expands towards the lunch cycle's high, takes it out, but then falls back into the consolidation and doesn't displace lower. What then usually occurs is that the market has one more run on buy side liquidity, originating around 2:30 p.m., taking out the previous cycle's high, and from there on we see a reversal originate, targeting sell side objective. It's important to note that this can also occur when the second PM cycle was an expansion leg higher and the third PM cycle is just an open manipulation, forms the high of that cycle and then immediately distributes the lower, taking out sell side. There are many variations to these delivery profiles. However, what is not something that can be changed a lot is what is written down here. Because if you have made it this far throughout the lecture, and if you have paid close attention, all this is about this sentence right here. Purge the second PM cycle's high and revert model. When should the second PM cycle's high be taken out? If price is bearish on the higher time frames during the third PM cycle. So we're looking at the previous cycle's high as a reference point to utilize going forward. For the long scenario during the PM session, we're going to take a look at a purge of the second PM cycle's low and revert model. This occurs when from the PM opening at 11:30 or during the lunch opening, the market is slowly trading lower than during the second 90-minute cycle's open, which occurs at 1 p.m. The market sells off rapidly. It sells off aggressively. This selling off from the 1 p.m. opening is a retracement on a higher time frame into a discount array. This retracement engineers buy-side liquidity by trapping retail shorters into believing that the market is going to go lower during the PM session. The market retraces, and at 2:30 a final run lower occurs into the low of the previous cycle, which got engineered right here. It is crucial that 2:30 does not open below this low just yet. We want to see 2:30 be utilized for the final manipulation lower into that previous cycle low, into that discount array that will be utilized for a fractal smart money reversal to occur from. And if this model is being followed, if this delivery profile is being followed, the right side of the curve is likely to be very aggressive because a lot of buy side liquidity has been engineered and the market has been going lower for a relatively long period of time in a rather slow manner, and therefore it is anticipated that the low resistance liquidity run can occur. Accumulation, manipulation, distribution. So let's take a look at another long scenario. It's the following. It's a purge of the first cycle low and the second cycle's low. This occurs when during the first two cycles of the PM session, relatively equal lows got engineered, whilst a higher high got created during the second cycle relative to the first cycle. What this does is the following. This market is consolidating from the opening. What then occurs is that sell side gets delivered, a low gets engineered, and the market trades back into the range. It does not displace. What then occurs is that the market manipulates to the upside because buy side liquidity got engineered during that consolidation. It then reverses and it seems to displace lower. But what's occurring is that the market is just again retracing into a higher time frame discount array from which a smart money reversal will occur from inside of a discount array inside of a market maker buy model if the higher time frame order flow is bullish, if the market is predetermined to go higher. And what we then see is that the buy side of the curve unfolds between 2:30 p.m. and 4 p.m. Again, it's important to note that these are delivery profiles, and that means that they occur on certain days within certain environments. This does not mean that every single scenario will play out every single day, because that's of course not possible. There's a switching that occurs of what profile will be followed on that very specific day. And our job is to determine what profile is likely to be followed for that current trading day. To summarize, here are the times of interest for the PM session. During 1:30 p.m. to 2:30 p.m. I want to see a smart money reversal form. I would preferably want to see signs of a reversal between 1:50 to 2:10 p.m. Again, this time window is a macro window in which I want to see speed and velocity be injected into the marketplace, and this can come in the form of quick sell side delivery followed by quick buy side delivery if bullish within a buy model, and if we are seeing quick buy side delivery followed by quick sell side delivery if bearish, so within a sell model. That's why I want to see signs of reversal between those times. Let's take a look at the next bullet point, which is that I need to see an expansion during 2:30 to 3:30 towards the targets. If, for example, the smart money reversal occurs at 1:45 p.m., I do not anticipate the market to go sideways all the way until 2:30 p.m. I want to see it begin to expand from 1:50 p.m. to 2:10. So from that macro time window that has been shared with you. So to finalize the simple schematic that has been shared with you, this is what it would look like for the PM session within bullish order flow within a market maker buy model. We want to see the sell side of the curve deliver into our point of interest, which is a discount array and or a previous X low during 1:30 p.m. to 2:30 p.m. We want to see a smart money reversal occur from there and see higher prices be delivered after that. And this is what it looks like for bearish order flow. This is our market maker sell model where we want to see buy side delivery get delivered into our point of interest, into our premium array or previous XH. During 1:30 to 2:30 p.m. we want to see signs of a smart money reversal occur from here and see sell side delivery be delivered afterwards. And here's my final note for you. And this is going to be a technical one, so please pay close attention. What I hope that you understand is that this very simple drawing of an arrow higher and arrow lower originating from a horizontal line here is me sharing with you that this is all one big cell model. All you need to know is that the original consolidation forms at a price level and that there's a price level where the market will draw towards and reverse from. Based on the original consolidation, this price level is already predetermined. So based on how the original consolidation delivered and how it got engineered, it is already predetermined how high the market will draw on the left side of the curve, aka the buy side of the curve, before it will turn around during our time of interest, if it's going to turn around. One of the ways that we can look at how we can determine this price level, this reversal point, is by utilizing projections based on the range of the original consolidation. So what we can do is that we can say, okay, we project standard deviations based on the low to high of the original consolidations and project into the future standard deviations, and whenever significant standard deviations get reached, we can anticipate a smart money reversal to occur. But that's not all. Based on the time that the lowest low forms here, we can already anticipate when the highest high is likely to form. Stuff for you to think about. So yes, this was all me explaining the market maker sell model to you in a very simplistic manner during the past 3 lectures. And of course, for the inverted chart, the market maker buy model. I want to give you some homework to end this lecture. I want you to go into your own charts and see the application of the 90-minute cycles and the logic I shared with you during the AM or PM session. If you want to apply the logic shared to the London session, I will share with you now how you can do so. What you can do is that you can divide the 90-minute cycles by 3. What you then get is for 1 90-minute cycles, you get 3 30-minute cycles. Since London is, in my opinion, not a favorable session to trade when it comes to the 90-minute cycles, the only way I would look at London from a scalper's perspective is by looking at 30-minute cycles and 30-minute AMD cycles. So within every single 90-minute cycle, you have again AMD that occurs. And within every single 30-minute cycle, you have again AMD that occurs into 10-minute cycles, and you can even fractalize that, and you can see how crazy it gets when you keep on fractalizing. But that's what is happening. Time and price are both fractal. But anyhow, if your focus is just on the AM and PM session, follow the logic that was shared during this lecture, and going forward I will share more insights on what I just shared, so don't worry about that. I want you to study how price relates to the previous cycle's high or low with regards to where, for example, smart money reversals occur. With this bullet point, I mean that you should put emphasis on the point of interest from which a smart money reversal occurs. Utilize these time cycles when you're looking at the AM and PM session. So note that, for example, a smart money reversal occurs at exactly 10:03. If a reversal occurs at exactly 10:03, below 8:30 to 10 slow and 7 to 8:30 slow, you note that down because that is crucial information. I will share with you how you will be able to log this better in the future. I will create a tutorial on how you should log this, because logging the data is the most important thing. For now, just try and make proper notes of where smart money reversals occur from, where the market is drawing towards after reversal occurs from, and that's how you can study the application of time through the lens that I shared it with you during this lecture. I want you to try and annotate at least 30 plus examples of market maker models utilizing this logic. What you often see is that during the AM and PM session, this logic can both be applied. It does not mean that the cleanest market maker models are present every single day during both sessions. Again, this logic only works and it only is applicable during very specific environments, or within very specific environments, I should say. And environment selection is crucial when it comes to determining when these things should work and when they shouldn't. So to conclude, this was a long lecture, so it is completely normal if you feel overwhelmed by everything that was shared with you during this lecture. We started off rather basic, but we quickly increased the level of difficulty, and the level of the difficulty is currently around midpoint. So it's around level 5 of a scale to level 1 to 10, and there's way more to dive into and to utilize. I want you to take your time with digesting the knowledge and re-watch this lecture in a while when you feel like you're ready to do so. The next lecture will be on the application of what has been shared so far within the model series and more insights on time, and specifically time-based PD arrays will be shared. So I want to thank you for watching this lecture. I wish you a very nice day and I look forward to speaking to you in the next one. Hello there. Welcome to the fourth lecture of the model series. During this lecture, we're going to look at the topic called application. During this lecture, we're going to apply what has been shared thus far within the model series to the real charts and see whether or not there are any repeating phenomena that are occurring with regards to our sequences of events that we are looking at. So here's the risk disclaimer that I'm forced to share with you before every single lecture. TOTK is not a trading advisor or an investment advisor. All we do is share our own knowledge and our own experiences for educational and or entertainment purposes only. If you're interested in reading the full risk disclaimer and the terms of services that you agreed upon when joining the mentorship or joining TOTK, you can do so by going to our website, theonesthatknow.com, and you can read them in great detail. To begin this lecture, we're first going to take a look at the table of contents. During this lecture, we will discuss the London session, the morning session, and the afternoon session. The goal of this lecture is to show you how applicable the theory is that has been shared thus far within the model series. It's important to note that this is not me giving you any financial advice. All I'm sharing with you is repeating phenomena that occur within the algorithmic delivery of price. And these are my own findings and I'm sharing my findings with you. So as we know, this is the schematic that we've been working with ever since the release of the first lecture. This is what occurs inside of a bullish market, inside of bullish order flow, aka a market maker buy model. We want to see the market sell off into our point of interest, and we want to see our point of interest get reached during 2:30 a.m. to 4 a.m. That's the sweet spot for the London session. From there on, we want to see a smart money reversal form, and the market maker buy model should unfold as we know it should unfold. For the bearish order flow, for the bearish market environment, we are looking for the following. We are looking for repricing higher, buy side delivery into a point of interest, which should be reached during 2:30 to 4 a.m. And from there on, we are anticipating a smart money reversal to form. And if it does, we are anticipating sell side to be the draw. So let us now take a look at the first chart example of the London session. As you can see, the reference points for the London session are first of all the Asia buy side, so it means the Asia high and the Asia low. During this lecture, I will make use of boxes that showcase the sessions. So in this case, the Asia session is plotted in blue and the London session is plotted in red. What we can see is that from the midnight opening, the market gets repriced higher above the Asia buy side. And now the question arises, How high can it go? How high could it potentially run before reverting? Well, first of all, we must pay attention to time. As you can see, this all occurred during the beginning of the day, even between our sweet spot. So therefore, it is anticipated that the market can at least draw a bit higher into a premium of the current dealing range, and then at the right time form a smart money reversal to then deliver towards sell-side liquidity below the Asia low firstly, and below the low right here. If we zoom in into the lower time frames, we can see the following. We can see that between 2:30 to 4 a.m. the following delivery occurred. What we see is that the market got repriced higher. Above what? Above the buy side liquidity engineered above these relatively equal highs. This is a point of interest inside of an already existing point of interest, meaning because we already trade above the Asia buy side liquidity, our mind is drawn towards shorts. Now we're looking for a run on buy stops, buy side liquidity being engineered above these highs, to then displace lower, confirm a sell program and draw lower, because we know that the higher time frame order flow is bearish. And now my question to you is the following. On this chart, what confirms to you that the change in the state of delivery has occurred after we have purged the buy side liquidity here? And what confirms that we can now anticipate lower prices to be next? I'm going to give you about 10 seconds, so please pause the video, because you don't want to ruin this learning experience for yourself. Alright, let's take a look. First of all, our eye is drawn to this down close candle. Why this down close candle, you might be wondering. Well, this down close candle is a bearish breaker. Why is this a bearish breaker? Well, we see a high form here, a low, higher high, lower low. So now we anticipate that down close candle to act as resistance on price. Now, notice that the moment that price traded into the price range of this down close candle, the bodies never closed outside of it. But from what point on was the market allowed to expand lower? The moment that price displaced below it, so it closed outside of it, retraced, offered buy side, boom, there it goes. And from there on we see a sell program unfold. Let's now take a look at the second example. Here we can see the Asia range annotated again or plotted in blue. What we can see is that the Asia sell side got taken right here by this long wick. This is manipulation. This purchase sell side liquidity. So what can we anticipate now? We can anticipate the market to at least retrace into the range that is currently present. So the range being from this high to this low. Why that range, you might be wondering? Well, that's the range of the current day, because the day opened up here at the true day open, midnight opening price. So therefore we can anticipate a run towards buy side liquidity back into that range. What we see is that a new high of London gets created. This was the initial high. They sent it lower. They made it go lower towards the Asia sell side. What does everyone think? Lower prices are next. What do? They short. So what is smart money doing right here? They're buying every single manipulation wick lower. Why? Because they know that the market is predetermined to go higher for this day, because the higher time frame order flow is bullish. If we take a look at the M1 time frame, we can see the following. Between 2:30 to 4, a consolidation occurred initially. Market went sideways. What's the function of this consolidation? It's engineering sell side liquidity above the Asia sell side. What then occurs is that the market purchases the sell side liquidity below these lows and below the Asia sell side, and then it reverts higher. Now my question to you is the following. What confirms the change in the state of delivery after we have purged the Asia sell side? We look at the left side of the curve. What confirms the change in the state of delivery is the following. It's first of all the market trading above this CB. Why that CB? Well, if price was going to continue lower, it should have found resistance inside that CB and then continue lower. Instead, it displaced above it, and from there on we can see that higher prices are next. But secondly, something else is crucial inside of this delivery. the market displaced above the CB above there as well. So what are we seeing? We are seeing the first CB get overrun and the second CB. Notice that when the second CB got overrun right here, the market closed inside of that CB, inversion of a value gap, before being allowed to continue higher. Notice that this is all one big market maker buy model during the London session. Original consolidation being above these highs here. Point of interest, Asia low. The Asia low got run during the right time of the day. Market displaces, boom, buy program unfolds. Very sloppy delivery though. But for the viewer that's paying close attention, he or she might notice something different inside of this delivery. And that's the following. Inside of this delivery, we do not see only CBs that get overrun, but we also see this up-close candle get overrun. And this up-close candle is significant because if we're bearish, we want to see up-close candles begin to act as resistance on price once broken. But because our point of interest, the Asia sell side, the Asia low, was reached and we saw a purge of that sell side liquidity occur, and the market then displaces above this up-close candle, we can now confidently say, okay, order flow has shifted and we're now going to look for down-close candles to act as support on price. If we're bearish, we're looking for up-close candles to act as resistance on price, and if we're bullish, we're looking for down-close candles to act as support on price. Let's take a look at the third example. The third example is the following. As you can see, the Asia buy-side liquidity is plotted again right here above this high. Notice relatively equal highs during the Asia session, got the left intact. Same scenario basically as the first example, where we see that during the beginning of the London session, the market already purchased the buy-side liquidity of Asia. But is the market already allowed time-wise to expand? No. Why not? Because it's waiting for 2:30 to 4 a.m. So therefore we see consolidation, market opens up at 2 a.m. of a sell side here. What is the function of that delivery lower? It's manipulation. They trap shorters into believing that London is gonna go lower. They push it higher once more, trapping buyers, taking out buy-side liquidity. And this is where smart money sells during the right time of day, targeting sell-side liquidity below the Asia low and below the trend line liquidity engineered below these lows. If we take a look at the M1 time frame, we can see the following. Here we can see that delivery lower from the 2 a.m. open. Sell-side delivery leaving intact relatively equal lows, market expands higher. And at what time does the high of the London session form? Look close. Near 2:30. From there on, we see this CB act as resistance on price. This signals bearish order flow, the fact it's not getting broken. After we have seen this low get violated, we then see another displacement leg lower after 3 a.m. 3 a.m. is a significant time window, 3 to 4 to be precise. CB market retraces into that for buy side, time distortion inside of it, and there it goes lower. New CB, significant, distributes lower, targeting the Asia sell side, which is below the low of this blue box. If we take a look at this CB, here we can see it annotated on the chart. Second BC here, which is an inversion for value gap. Why is it significant? Think back to the model series. What is being shared right here? When discount arrays on the left side of the curve are failing to act as support if bullish on price, then it's a sign that order flow is potentially switching and that we could anticipate lower prices to be next. What we see is that when this big down close candle displays through that BC, there's this large manipulation wick higher into what? Into the high of that BC, into the high of that inversion for value gap. So let's say that you went short right here inside the CB. Where would your stop be? Your stop would be above the high of this indecisive candle, because that indecisive candle is the invalidation if price is going to fall over. You cannot place your stop at the high of the CB because of this inversion for value gap. Price might retrace into that before continuing lower. And finally, the third relevant box is the following. This down close candle is a bearish breaker. Why is it a bearish breaker? Because we see a high form right here, low, higher high. This low set up the run towards the buy side liquidity. This low was the low that set up the run before the right time of day came around and the market was allowed to reverse. Notice that this low got broken by a CB. So you have a bearish breaker with a CB. Something we like to see at the right time of day. So let us now take a look at the New York session. The New York session bullish order flow model looks like the following. It's a market maker buy model. What we see is that sell side delivery occurs into a point of interest during the right time of the AM session. During 9:30 to 10:30 AM, we want to see the point of interest get reached, smart money reversal form, market should expand higher once the smart money reversal is in. If we take a look at the bearish scenario within the bearish environment, bearish order flow, and we can see that repricing higher occurs into the point of interest between 9:30 to 10:30. Market forms a smart money reversal there, and then it distributes lower, targeting sell side liquidity. So here we are on the 15-minute chart, and as you can see, I have annotated equal lows engineered during the New York morning session. The reason why these equal lows have been engineered is because at the time of these equal lows being engineered, it was significant because these lows are lows of time cycles, 90-minute cycles to be precise. What we see is that the market purchases those equal lows right here and then distributes higher because the higher time frame order flow is bullish. Therefore, any leg lower purchasing sell side is manipulation, and inside of this delivery higher, there's a fractal market maker buy model. Point of interest being the liquidity below these lows, and specifically this BC. If we take a look at the 1 minute time frame, we can see the following. We know that the first AM cycle is from 7 to 8:30 AM. The second AM cycle is from 8:30 to 10 AM. What we see is the following. We can see that these equal lows got engineered, and then from around 9:30 the market got repriced higher. That's significant because our higher time frame order flow is bullish. And now think back to the two 9:30 opening profiles that I shared with you. If 9:30 runs in our favor, we want to see, if bullish, a false high get formed. That high traps people into believing that, okay, we're gonna go lower now. So what do? They go short, they place their stop losses above that high. And what then occurs is that the market gets ran into the opposite direction of what we're anticipating. So we have established a bullish bias for this market, we are looking for higher prices, and we then see the market opened up, form a high right here, so it goes higher, and we think to ourselves, okay, it's bullish, right? Well, what occurs is that they then distribute it lower because they need to purchase sell side liquidity before they are allowed to make it go higher. So what occurs is that this high gets engineered here, false high, gets utilized to reprice lower. Traders that sell on a breakout, they sell the moment that price trades below these relative weak lows. They think support gets broken. Market spends some time below there before it finally begins to displace to the upside and expand higher. This is all occurring during the right time of the morning session, during the right time of day, 9:30 to 10:30 AM. Now, pay close attention to the delivery here. What confirmed the change in state of delivery? The moment that price closed above this up-close candle or traded above it, the change in state of delivery was confirmed. Why? Because this is a bullish breaker. We see a low form below that AM1 sell side liquidity, high, lower low, higher high. We now anticipate this up-close candle to act as support on price moving forward. Notice that price stepped into it here and then never revisited that area again. Why not, you might be wondering? Because of this up-close candle right here. This acted as support on price, and more specifically the CB, in which that high formed that up-close candle. This trade was taken by me, and if you want to see the recording, the execution video, you can go on the mentorship platform and you can see on what day this was, and you'll be able to get the breakdown somewhere in the middle of January. And here we can see that inversion for value gap doing its thing on price. Here we are at the second example of the morning session, and as you can see, I have annotated both the London sell side as the London buy side liquidity. London low and London high are important during the morning session. What occurs is that around 9 o'clock during the second AM cycle, the market taps below the London sell side, but notice that this is not a real purge. It's just forming or engineering more liquidity, more sell side liquidity. What occurs is that during the third 90-minute cycle for the morning session, the market opens up, distributes lower, it manipulates, trapping people into believing that the markets are going to go lower. Below the AM2 sell side liquidity and below the London sell side liquidity, smart money goes long, Fractal market make a buy model back into the range of the day thus far, the London high to the low of this candle right here. If we take a look at the 1 minute time frame, we can see the following. We can see that during the second 90-minute cycle, the market traded just below the London low, but notice that the bodies are closing above it. This means that the sell side liquidity is being engineered. Because the wicks do the damage, the bodies tell the story. And in the case of engineering of liquidity, when the bodies close at the exact same price level that you had marked up on your charts as a point of interest, it's a sign that the real purchase has yet to occur. We then see that the market gets repriced higher. At 9:30, the market gets repriced higher again. What's the function of that repricing higher? It traps people into believing that we're going to go for longs during the morning session. What occurs is that a high forms. Market then runs lower. Those people that were just long think, okay, it's now going to go short. Let's go short. Where do they place their stop losses? Above the high of the second AM cycle. Market distributes lower into what? Into the sell side liquidity below this low and below the London sell side. But at what time? At exactly 10 AM, the manipulation begins. Lower, low forms, buy program unfolds, targeting the buy side liquidity above this high. Again, this is all occurring between 9:30 to 10:30. And what we have seen thus far is that 9:30 opened up into the anticipated direction and it forms a fake high. Then we see manipulation lower against the anticipated direction. This is what we want to see. This is the sell side of the curve into our point of interest, which gets reached during the right time of day. And from there on, we can see a smart money reversal form and the buy program begins. Smart money reversal gets confirmed the moment that price displaces or trades above this high. Why this high specifically? Because this high formed inside of the CB and set up the final run lower, purging sell side liquidity to then revert it higher. Notice that in the price lag from low to high, so the displacement lag of these candles, first candle, second candle, third candle, fourth candle, there's a BC that forms. I apologize. A bullish or value gap here. Market retraces into that. Institutional order for entry drill, IFET. Boom, there it goes. Market forms a new high. It retraces into what? Into this BC and into this candle right here. This whole CB is an inversion for value gap. Left side of the curve being utilized as support on the right side of the curve. And from there on we see higher prices next. Bullish order flow. Notice that the market falls short below the London buy side liquidity, and that's why you take partials accordingly above this buy side liquidity and so forth. This CB getting overrun was another sign of a change in state of delivery occurring. The moment that CB got overrun, it should have acted as support on price. As you can see, it did. This was again a trade that I took live, and if you want to see the recording, you can do so by going to the 10th of January 2024. Here we can see the third example of the morning session. During this example, we can see that the London buy side liquidity got taken early during the morning session. Market got repriced higher aggressively, and this is, by the way, on the euro. So I'm showcasing to you that this works on Forex as well. You can see that repricing higher occurs from the opening of the New York session. Then the market purchased the second AM cycle's buy-side liquidity, which got engineered above this high, and then reverts lower, back into the range that got created during the morning session thus far. If we take a look at the 1 minute time frame, we can see the following. We can see that between 8:30 and 10 AM, the market got repriced higher. At 8:30, there was a news driver that got utilized for heavy repricing higher, choppy delivery, but the market gets repriced higher. Then a high gets formed between 8:30 to 10. 10 AM, the market begins to manipulate higher, gets repriced higher. And then the moment the price comes above the second AM cycle's buy-side liquidity, between 9:30 to 10:30, I apologize for not having it on my chart right here, but you can see that this is where 10:30 is and this is where 9:30 is. What we can see is that that buy-side liquidity gets taken, it gets purged, and the market begins to roll over back into the 8:30 news candle. Now, my question to you is the following. What confirmed the change in state of delivery above the second AM cycle's buy-side liquidity? Take a good look and we'll then showcase it to you. This down close candle was a bearish breaker. Why was this a bearish breaker? Because we saw a high form, low, higher high, lower low. This low formed inside of what? Inside of this BC here. So this low is an intermediate term low. It should not get violated if price is going to continue higher. Inside of the leg that breaks through this low, we see a CB. Market retrace into that CB and then continues lower, drawing towards sell-side liquidity. Notice that the market swept the buy-side liquidity here already, but it had to make another run on buy-side liquidity. This is what we call a three drives pattern. When there are, for example, highs that are being engineered, in this case, there was a high that formed during 8:30 to 10. This was a significant buy-side liquidity pool. This is the first high, second high. So this high sweeps the liquidity of the first high, and then the third high sweeps the liquidity engineered during the sweep of the first high. So it sweeps the liquidity of the second high. This is what we call a three drives pattern, and if you take a look at your charts and at old historical market data, you will see that it occurs actually pretty often. Not something you should put emphasis on, but just something I wanted to share with you. As you can see, that inversion value gap acts as resistance on price once broken. And here we can see the final example of the morning session. This is a trade that I took during the morning session, a market maker sell model. This was shorting near the high of the Nasdaq thus far, so the all-time high. What occurred was the following. What we saw was that from the New York opening, the market got repriced higher, and it already took out the London buy side rather quickly, but it also took out the Asia buy side liquidity, which got engineered around here. Notice that the previous day high left equal highs intact. What occurs is that the market trades above the previous day high, here, but it occurs too soon. It doesn't occur during our time window, because 9:30 was here. So what occurs is that the market gets pushed higher, 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 until it breaks above the old all-time high, which was around here. And between 9:30 to 10:30, the market rolls over and sell-side delivery follows on a Friday. If you want to listen to the full breakdown of this trade, you can take a look at the lecture that was shared on the 24th of February 2024. We're now just going to put emphasis on what has been taught so far within the model series. As you can see, the previous day high got taken. What's the nearest sell-side liquidity that we can potentially target? While the opposing side of the range thus far for today, London, formed a low right here. New York formed a high right here. So what can we target? We can target the London sell side liquidity. Here we can take a look at the 1 minute time frame, and as you can see, at 9:30 the market got repriced higher. When this occurs and 9:30 gets utilized to reprice into a point of interest, this is another scenario that was outlined during the previous lecture about the 9:30 opening profiles. When this occurs, we immediately begin to think, okay, this is probably going to be manipulation because the market has been going higher for so long, and this key opening gets utilized to send it higher once more into our point of interest, into our drawn liquidity. And what we see is that between 9:30 to 10:30, market consolidates here and it forms a high. What confirms the formation of this high is if this down close candle, sorry, I did not outline it perfectly, but if this price range from basically this high to this low gets violated, gets displaced below, I am looking for sell side delivery to be next. I went short inside of this candle here, inside of the retracement. But why is this significant? Why this price range specifically? Because from this high to low, this price range got utilized to reprice into this BC, into the imbalance, which can be seen here. And once that gets broken, we know that a change in the state of delivery is likely to occur next. And from there on, we see sell side delivery occur, targeting sell side liquidity. Again, if you want to read the breakdown or listen to the breakdown of this trade in great detail, you can do so by going to the review of the 24th of February 2024. Let us now take a look again at the schematic, but now for the PM session. This schematic applies when we are in a bullish environment where there's bullish order flow present, and we anticipate higher prices for the PM session. What we want to see is that sell side delivery occurs into a point of interest. Market should reach this point of interest between 1:30 p.m. to 2:30 p.m. This is our time of interest. From there on, we want to see repricing higher occur. So this is the buy side of the curve within a market maker buy model. If you take a look at the bearish order flow scenario, inside of a bearish market, inside of a bearish anticipation for the PM session, we are looking for the following. We're looking for repricing higher into a point of interest, which should get reached between 1:30 to 2:30 p.m. From there on, we want to see sell side delivery occur, targeting lower prices. If we take a look at the schematic on this chart, we can see that there's a yellow box right here, which represents lunch. And then this purple box right here represents the New York PM session. What we can see is that lunch consolidated, New York PM sent it lower, repriced lower right here. This repricing lower traps people into believing that PM is going to continue lower after the AM session expanded lower. People go short here. What occurs is that the market runs on those stops, on those buy stops, trading above the lunch buy side liquidity, then begins to roll over, targeting sell side liquidity below all of the lows inside of this leg higher. This is a purge of the lunch buy side, which is a scenario outlined for the PM session. The lunch buy side is a POI if we're bearish for the PM session. Take a closer look on the 1 minute time frame, we can see the following. We can see that the lunch buy side liquidity got engineered above this high, and here you can also see why I say that the lunch is from 11:30 to 1 instead of from 12 to 1. By saying that, many people say that because they think lunch hour, so therefore it must be 12 to 1. No, because if it was 12 to 1, why would this high be a relevant reference point on price? If you would extend this high, you can see that this high gets utilized through support and resistance going forward. That occurs because this is the real lunch high, 11:30 to 1. What occurs is that the market gets repriced above that buy side liquidity between 1:30 to 2:30, and it then begins to slowly fall over. Notice that this delivery is very choppy and it is not the preferred smart money reversal. However, I'm sharing this with you because it's important to not only have the cleanest possible deliveries, but to also see deliveries that are not that clean, but that follow the logic. The reason why that's important is because that's what it's like. You're not going to have the perfect day, every single week. But the logic is going to be usually pretty clear and pretty straightforward when the delivery occurs like this. And you will see that, okay, the PM scenario that we are looking for is a run on buy side liquidity between 1:30 to 2:30 p.m., specifically the lunch buy side liquidity. What we see is that buy side liquidity get taken, but notice how choppy this delivery lower is. And then once it begins to fall over, once the first CB forms right here, that's the first shorting opportunity. Second CB that forms, second short opportunity. And notice that after that, it just gets sent lower. Panic occurs. Oh, what is this? Why is this happening? What's occurring in the world? Blah, blah, blah. Panic arises, whilst in reality, the market is just doing what it's programmed and engineered to do. What confirms the change in the state of delivery is the moment that price closed below this downward candle, which is a bearish breaker. High right here, low, higher high, between what time? Between 1:30 to 2:30 p.m. If you look closer, between 1:50 to 2:10. Yep, that's a macro during the PM session. We will discuss macros later on more in depth, because they are very significant within my analysis when it comes to determining what a real PD array is. Yep. Anyhow, market closes below this breaker. Notice that right here the market closed below it. Notice that the closes are never above the low of the breaker anymore. Market gets sent lower and there it goes. Business done. Inversion value gap on the left side of the curve acts as perfect resistance on price. This is how you gauge order flow. You look at the left side of the curve and how it's being treated on the right side of the curve. If this kind of rays on the left side of the curve are acting as resistance on price, you now know that order flow has shifted bearish and that you can anticipate lower prices. Here we can take a look at the second example of the PM session. As you can see, lunch buy side liquidity got engineered above this high and sell side liquidity got engineered below this low. At 1 p.m., which is the opening of the 90 minutes mind manipulation cycle of the PM session, the market opens up and it expands lower. What's the function of this expansion leg lower? This expansion leg traps retail shorters into believing that the lunch is going to fall, so what do? They chase it. They go short, 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 short. What occurs? Market trades into a point of interest. Point of interest was already the lunch sell side liquidity right here, but more so a discount of the range from AM to lunch thus far. So from this low to this high. And from there on, we can see that buy side delivery occurs, starting buy side liquidity above the lunch buy side. If we take a look at the 1 minute time frame, we can see the following. We can see that at around 1 p.m. the market begins to expand higher. So this run higher has the same function as was what we have been discussing with the 9:30 opening profiles. It trades into our anticipated direction, into our expected direction. Why does that occur? Why is that relevant? While this run higher traps people into believing that, okay, well, we're going to trade higher during the PM session. That's our underlying narrative. But we understand that this occurs and can only occur when a deep discount gets reached before the expansion leg at the right time. And the right time is between 1:30 to 2:30 p.m. So we know that they trap buyers into chasing it right here. Then occurs is they run on those buyers. So that means that sell side liquidity rests below every single low here and basically below every single low inside this leg higher. Then sell side delivery occurs into a point of interest, gets reached between 1:30 to 2:30 p.m. More specifically around 1:45 and 1:50 to 2:10. Again, the 20-minute time window. Market displays to the upside. And now my question to you is, what confirms the change in the state of delivery here, and what confirms that buy side delivery was likely to be next? When the market traded above this upclose candle right here, which is a bullish breaker, we could anticipate the market now trading higher. What was more significant about this upcast candle was first of all that it formed inside of the CB here, but secondly, a BC formed inside of the price leg that traded above it. So we see the market retrace into that BC and then continues higher, comes back into the bullish breaker, spends some time around it, and then finally begins to expand higher. Why does this consolidation occur? Because we know that after a consolidation, an expansion leg follows. Now we can take a look at the third example of the PM session, where we can see that we have annotated the launch buy side and the launch sell side liquidity. Now my question to you is the following. What could we potentially target if the launch range was rather large and we are bearish, we are anticipating lower prices? Well, what we can do is that we can measure premium to discount relative to the launch range. So from this high to this low. And then we know that equilibrium is around here. And the market will always try to retrace back into equilibrium before it begins its next move. When launch is a large range, so it means launch is an expansion, we can anticipate that. What we see is that a run on buy side liquidity occurs here, above the launch high, market reverts to lower, but it never touches the launch low. Why not? Because the market was being held inside of a consolidation. So therefore, equilibrium was a good target, and of course the previous cycle's low. If we take a look at the 1 minute time frame, we can see the following. Launch high was above here. Between 1:30 to 2:30 p.m. the market got repriced above that high, above that buy side liquidity, and then begins to roll over. Notice again that this is very choppy delivery. That doesn't matter. The logic still applies. The moment the price displays lower, we can now anticipate it to draw towards sell side liquidity. Where does sell side liquidity rest? Well, sell side liquidity rests below, first of all, these lows here, because these are the lows of the 90-minute cycle between 1 to 2:30 p.m. And we have an inefficiency here that we can target. What we see is that displacement occurs, CB, market retrace into that, boom, there it goes. Another CB, market retrace into that, there it goes. And that's how we can detect whether or not the market is going to expand lower, even within a very choppy left side of the curve. The moment that the first CBs begin to form on the right side of the curve, it's the sign that, okay, now the time is right for the market to begin to move. What confirms the change in state of delivery is the closure below this downclose candle, because this downclose candle is the candle that set up the run above the launch buy side liquidity. So we have a high that forms here by just shallow tapping into the launch high, engineering more buy side liquidity, low gets formed, higher high, lower low. That downclose candle should act as resistance on price now. BCs on the left side of the curve getting violated showcases that order flow has shifted bearish, and therefore we can anticipate lower prices. Notice that this BC lines up with this CB. Your PD arrays, they form based on the left side of the curve. So that means that whenever there's an imbalance on the left side of the curve and we see an imbalance form inside of that imbalance on the right side of the curve, it makes that price range a very strong resistance area if bearish. So let us now take a look at another example where launch was an expansion. What we can see here is that the launch high was engineered above here and the launch low was engineered below here. At 1 p.m. the market repriced higher inside of these two upclose candles. Market leaves equal highs intact. You do not need to go into the lower time frames to see that these wicks are relatively equal. What this does is that it engineers more sell side liquidity relative to the launch sell side liquidity. So you can see that the true day open is just in front of it, but what you can see is that these bodies are equal and next to that the wicks are also nearly equal. What occurs is that the market runs on its sell side liquidity, trades into the open of this candle, which is a bullish rejection block, market rejects that, and then it draws higher towards the buy side liquidity above these highs, and into what? Into equilibrium or even premium of the launch range from high to low. Because here's the range. Premium discount. And what we see is that there's a CB that was yet to be traded into inside of a premium. And at what time did that CB get repriced into? right before the market close. And that just shows how IPDA, how the interbank price delivery algorithm, has certain price levels that it has to deliver during each session before the market closes. Here you can see the 1 minute time frame, and as you can see, between 1:30 to 2:30 p.m., market traded deep below the lunch sell side liquidity here, and then around the end of a point of interest, or a time of interest, I must say, you can see that displacement higher occurs and buy side delivery unfolds. You might be wondering, what confirms that the change in state of delivery occurs here? First of all, this up-close candle being broken signals that a change in the state of delivery is occurring. The reason why this up-close candle is significant is because this up-close candle, this high, was utilized for the final repricing lower here near the end of our time of interest. And when we see that up-close candle get violated and we would then see BCs get respected after that, we know that order flow is bullish. And from there on, we can say, okay, while the order flow is shifted bullish, now any retracement can be bought. This doesn't mean you have to buy it here. You can buy it here, you can buy it here, you can even buy it here, you can even buy it here. As long as the range between point A, wherever your entry is, to point B, which is here, the buy side liquidity above these highs. Why those highs? Because it's the previous cycle's highs. Why? 1 to 230. It already did its job on the downside, so there's no sales liquidity that has to be taken again. What's the first target? The previous cycle's high. And even that 15-minute imbalance. And from there on, we see very choppy buy side delivery occur towards the buy side liquidity. Second candle that got violated on the left side of the curve that signals bullish order flow was this big up-close candle. Why that big up-close candle? Well, notice that this big up-close candle's low formed inside of here. Market gets repriced higher. Then the market displaces below that low. Up-close candle gets delivered, repricing higher, immediate rebalance here. Whenever this up-close candle gets violated, you do not want to see that get broken, because what do we know? What was shared during this lecture. Up-close candles should act as resistance if the order flow is bearish. Down-close candles should act as support if the order flow is bullish. Here comes something for you to investigate. When these candles do not fulfill their function when it comes to what I just shared with you, the opposite occurs. So instead of that candle now acting as resistance, because it already got broken through, you are looking for that up-close candle to act as support on price. Let us now take a look at a new topic during this presentation. We're going to take a look at the topic called SMT relative to PXH or PXL. The name already basically says it, but I'm going to share with you something that will explain to you why certain purchase on liquidity do not occur on the market that you're currently looking at. Because if we take a look at the following charts, I want to ask you, why would price not take out the launch sell side, the launch low right here, before reverting towards the launch buy side liquidity? I'm going to give you a few seconds to think about it, and then I'm going to answer it to you. Please pause the video if you did not think about the answer just yet. During this series, I have not discussed the topic of intermarket relationship or SMT just yet. It will come soon. I will share more insights on it during the next lecture, because we will refine the model during the next lecture and we will add extra tools to it that increase the level of precision. But the reason why the launch sell side was not purged, why this launch low was not taken out before reverting towards the launch buy side, was because of the following. A highly correlated market, because this is the Nasdaq, a highly correlated market to the Nasdaq took out the launch low, whilst Nasdaq created a higher low, so that signals SMT, or cracking correlation between those highly correlated markets. And when it occurs near a point of interest, So in this case, near the launch low, we can anticipate that they will leave that launch low intact before reverting higher if we are anticipating higher prices for the session. Here we can see the Dow Jones, and the Dow Jones created lower lows right here, whilst the Nasdaq created higher lows. And this confirmed the delivery that was likely to occur on Nasdaq to draw towards the largest buy side liquidity. And let us now take a look at another example. But instead of taking a look at 90-minute cycles, their lows and highs, we're now going to take a look at sessions. So complete trading sessions. What we can see is that the red box represents the London session, whilst the green box represents the New York AM session. And what we see is that on the left side, on the left chart, we can see that ES made a lower low, whilst Nasdaq made a higher low. And within the right context, within the right narrative, this is the confirmation that higher prices are likely to be next. And for the people that are paying close attention, this chart has actually been discussed on the lower time frames during the AM session examples. And this is another confluence that can be added to the already existing rules of a model. But more on that during next week's lecture, where we will fine-tune the model and where we will take a look at extra things that can be added, extra saucy stuff that can be added upon the already existing rules. I want to give you a homework assignment before going into next week's lecture. First of all, I want you to take a look at historical charts through the lens that I'm sharing with you and that I have been sharing with you thus far. I want you to take a look at 3 steps. First of all, point of interest, meaning that you must determine a point of interest after you have already determined, of course, the order flow, if the market is bullish or bearish. Once you have determined your point of interest, you're waiting for your point of interest to be reached during the time of interest, during the right time of day, and we're then going to wait for a change in the state of delivery. I want you to really pay attention to what confirms a change in the state of delivery. During this lecture, multiple gems were shared and have been shared when it comes to how you can determine the order flow, how you can detect changes in the state of delivery. Pick which one you like and start putting emphasis on that. So basically pick the one that makes sense to you. This could be the creation of a bullish order block. This could be the violation of upclose candles on the left side of the curve if bullish. Or this could be the disrespect of downclose candles on the left side of the curve if bearish. There are so many things that you can utilize to determine order flow and determine whether or not the change in state of delivery is occurring. Pick the one you like and start paying attention to that. One that might work best for you is the inversion for value gap and the breaker. But anyhow, I want you to begin collecting data for in what point of interest reversals take place and at what exact time these reversals take place. I want you to try and collect as many examples as possible, and you should strive for 30 plus at least before watching the next lecture, because it's important for you to put in the work. You cannot treat the series, as I outlined early on, as just Netflix. You need to go into your own charts and you need to put in the work. You need to put in the required effort if you want to gain the benefits from this knowledge, because simply watching a lecture is not enough. As outlined during next week's lecture, we're going to add rules to our already existing rules, and we're going to fine-tune the model. I want to thank you for watching this lecture. I hope that you found it insightful, and I look forward to speaking to you in the next one. Hello there. Welcome to the 5th lecture of the model series. During this lecture, we're going to discuss additions. If you did not watch the previous lectures yet, I would highly advise you to do so first, because this lecture is going to build upon the knowledge shared within those lectures. During this lecture, we're going to look at ways to fine-tune our current model and how we can add extra confluences into our series of requirements. Before we can begin with today's lecture, I must first give you a risk disclaimer. I, or TOTK, am not a financial advisor. I will share my own opinions about the marketplace. I will share my own experience with you. This is not meant for financial advice. The reason why I'm sharing this is purely meant for educational and or entertainment purposes only. If you want to read the full risk disclaimers that you agreed upon when signing up to the mentorship or to TOTK, you can do so on theonesthatknow.com. So before we can add extra additions to our current model, we will first take a look at the market maker buy model schematic. It's a rather simple schematic where we can see a green box up here, which represents an original consolidation, an area where buy side liquidity has been engineered above the highs, followed by sell side delivery lower into our point of interest during our time of interest. This yellow box represents the smart money reversal, the SMR, and from there on we see buy side delivery targeting the original consolidation's high. We're going to build up on this schematic, and during the beginning part of this lecture, we're going to focus on this yellow box, which represents the smart money reversal. We're going to take a close look at the reversal, and we are going to see what always occurs in every reversal besides the creation of a breaker or mitigation block, because there's something else, and that is so crucial when it comes to determining whether or not a reversal is in place. So let us take a look at that. What we're going to take a look at is intermarket relationship. Within a market maker buy model, we can look for a cracking correlation between correlated assets, correlated markets, on the lows if our point of interest has been reached during our time of interest. Because you need to understand that highly correlated markets should always behave in the same manner. That means that when one creates for example, a lower low, the other one should also create a lower low. If we are taking a look at the following schematics, where we can see the ES, Nasdaq, and Dow Jones chart, and we take a close look at what is occurring at the lows within a market maker buy model, we can see that ES makes lower lows, Nasdaq makes higher lows, and the Dow Jones makes lower lows, all whilst trading into the yellow box, which is our smart money reversal within that market maker buy model schematic. What we can see is that there's a cracking correlation between ES/Dow Jones and the Nasdaq, because both ES as the Dow Jones made lower lows, whilst the Nasdaq makes higher lows. And this SMT is so crucial because it's a confirmation of a smart money reversal occurring at your point of interest during your time of interest. And every single reversal will have this. And you might be thinking, how could every single reversal have this SMT? Because until SMT is present, the market is not allowed to reverse. And the SMT can be with a very wide amount of markets. So for example, if we're looking at the SMT can occur with Nasdaq, the Dow Jones, or even with the dollar index. Same for Nasdaq, same for Dow Jones. So if you are able to have multiple charts open at the same time, if you have an extra monitor for that, an extra screen, I would highly advise you to have a tab open with all these markets that are of interest to you, because the moment that price reaches your point of interest during your time of interest, the moment begins that you will actively look for a cracking correlation to form. Because after this cracking correlation has formed and you see change in the state of delivery occur, it's the most beautiful sign that, okay, we're now likely to expand to the upside, if bullish. If you are looking at, for example, other markets than ES, Nasdaq, or Dow Jones, so you're, for example, looking at the EU or GU, what you then do is that you compare EU, Euro USD, to the GBP USD. And that's how you can basically use all correlated markets to see whether or not SMTs are present. Here we can see the SMT on the lows annotated. ES makes a lower low, Nasdaq makes a higher low, Dow Jones makes a lower low. Notice what is being signaled right here. Oftentimes you will see that the market that creates a higher low whilst the others make lower lows already traded into its respective point of interest or its respective range low before the other markets did. And therefore it's a matter of time for the other markets to also trade into their point of interest during the time of interest before the markets are allowed to reverse. It's time and price meeting. If you are taking a look at inversely correlated assets for SMT within a market maker buy model, we can see the following. The market maker buy model is taking place on euro, so foreign currencies. And what we can see is that ZEUSSY trades into its respective point of interest during a time of interest. And euro trades into its respective point of interest during its time of interest as well. ZEUSSY does the opposite of euro. So when ZEUSSY trades into a premium of the range, whilst euro trades into a discount of the range, and we are anticipating euro to continue higher, to draw higher, what we will be looking for then is for an SMT to form between EU and the DOR index. And the SMT will be in the following form, where we will see the DOR index make a higher high, whilst the euro makes a higher low. And within that bullish thesis, this is the sign that the SMR smart money reversal is in, and from there on we can anticipate that the foreign currencies are likely to be allowed to expand higher. The reason why this is occurring is again because the moment that the SMT takes place, the markets are allowed to expand. They are allowed to reverse. The SMT is present here. We can see higher highs get formed on the DOR index and higher lows on the euro. Let us now take a look at the market maker sell model. This occurs within higher time frame bearish order flow. What we can see is that there's a green box which represents the original consolidation. Below that green box, sell side liquidity gets engineered. The market expands higher into our point of interest during our time of interest. And from there on, we see that a smart money reversal forms, and this yellow box represents that. We're going to zoom in on this smart money reversal again. For correlated markets, an SMT looks like the following. A cracking correlation within a market maker sell model. What we see is that ES trades into its respective point of interest, creates a high, followed by a lower high. Nasdaq creates a high, followed by a higher high. And the Dow Jones creates a high, followed by a higher high. And what we can see is the following. We can see that ES did something different on the highs relative to Nasdaq and the Dow Jones. And the reason why this is significant is because we already established that the market reached our point of interest, or so to say, point of interest for a reversal to originate from during our time of interest, and to then see SMT, a cracking correlation between these higher correlated markets, is a confirmation of our thesis likely to play out. And the moment that we see CSD occur, this is the ultimate confirmation of that being the case. Again, this occurs within bearish higher time frame institutional order flow. This is where we can see the SMTs, the Kraken correlations highlighted. We can see that ES makes a lower high, whilst Nasdaq makes a higher high, and the Dow Jones makes a higher high as well. If we take a look at inversely correlated markets, their SMT within a market maker sell model, so a sell model occurring on the EU, we can see the following. We can see that Dixie trades lower into a point of interest during a time of interest, and a higher low gets formed. Whilst this is occurring, Euro trades into its respective point of interest during a time of interest, and a higher high gets formed. This higher high creation, whilst dollar makes a higher low, is a sign of weakness on Euro, and it is a sign of strength on the dollar. The change in state of delivery, the displacement leg lower, confirms this. Here we can see the SMT outlined, where the dollar creates a higher low, whilst Euro creates a higher high. We're now going to take a look at the next topic of this lecture, the next edition, so to say. This topic is going to be about feeling order flow. And you might be wondering, what does feeling order flow mean? Well, feeling order flow is the following. Feeling or gouging order flow means knowing when price will expand, retrace, expand or consolidate, etc. after you have established that a smart money reversal is in. Simply said, feeling order flow is basically having a nudge for what price is likely to do next now that you're in a position, or now that price has showed a willingness to reverse. This is important for trade management, so pay attention. Feeling the order flow comes whilst focusing on how price delivers after you have established a smart money reversal being in. Once you know how to feel order flow, managing positions is an objective and straightforward process. However, getting a feeling of order flow sounds way easier than it actually is. We're first going to take a look at the general schematic which you can utilize to gauge the order flow within a buy program. And after that, I will take you into some live executions and share how I view the order flow whilst price is printing. Let us first take a look at a rather simple schematic of a market maker buy model. Notice that we're all basing our foundational knowledge on the schematics that we begin with during the first lecture of the model series. Because if we understand that there's an original consolidation, there's sell-side delivery into a price level where the market will likely reverse from if it reaches it during the right time period, our time of interest, and we then see a smart money reversal form and buy program unfolds, we can strip it down all the way basically to an arrow lower, arrow higher. But in reality, that is not how the market prints, because there will be retracements, of course. However, I am just sharing with you the importance of keeping your understanding of price very simple. And you might be thinking, very simple. How could that make me profitable? How could that help me? Well, you need to understand that in order to become profitable and to gain an edge, so to say, you must be able to execute a very simple rule-based protocol. However, if you combine that with advanced knowledge, meaning that you understand the basics to an advanced level and that you can add things to the basics that the masters don't see, you will be unstoppable and you will see things that so many people do not see because they're too focused on things that do not matter. You need to understand what's important and then pay close attention to the details, because that's where the growth takes place. It's not by simply adding new stuff, the next trend, whatever might be popping off on social media. You simply focus on what works and you stick to that and you improve upon that knowledge, because this is how the market moves if bullish. You can argue with me all you want, but I know that this is the case and I want you to try and prove me wrong. And if you go into your charts, you will figure out that that is not possible. But let us take a look at this schematic now. As you can see, we can see sell side delivery occur into our smart money reversal. I must say into our point of interest where smart money reversal forms. The sell side delivery occurs through the following manner: expansion away from the origin, consolidation, retracement, expansion, retracement, expansion, retracement, expansion, followed by a reversal, displacement higher. This is an expansion leg. Retrace, expand, retrace, expand, retrace, expand. This is of course a dream scenario where it moves so quick, and usually within a real environment you will see that there will be consolidations throughout the market maker model, and this is time distortion, because logically speaking and theoretically speaking, this is how the market moves from point A, which is a smart money reversal, to point B, which is the high of the original consolidation. If we take a look at a more advanced schematic, utilizing the same foundation, but just added a few things, there are some general rules that I want to share with you that are probably not known to you thus far. First of all, we're going to take a look at the following, where we are measuring premium to discount of the range from the original consolidation's high to the low of the smart money reversal. If we have premium and discount established, premium being above 50% of that range and discount being below 50% of that range, we can note the following. And these are important rules to understand. Whenever price displaces above 50% of the range, above equilibrium, we are anticipating the market to draw towards the opposite side of the range. So a common question that I get asked a lot is the following, even on the mentorship platform. Zeus, how do you know that price is going to complete the market maker buy model or sell model if the logic is inverted? Well, if I see displacement through equilibrium of the range, it is already a very good sign to me, because it confirms to me that the order flow is bullish and that price is likely to draw towards the opposite side of the range now. When bullish, we preferably want to buy either below equilibrium of the range, so in a discount, or we want to buy in close proximity to it. If we take a look at the schematic, and we can see that every single retracement on the left side of the curve has been annotated. So for example, first retracement, you can see me mark up the low to high of that retracement and the middle of that price range. Second retracement, low to high and 50%, the middle point, low to high, and again, middle point. You might be wondering, why would you annotate that? Because it's important to understand that the left side of the curve influences the right side of the curve. What I mean with that is the following. If the left side of the curve has retracements, the moment that price expands above a retracement that occurred on the left side of the curve, you do not want to see price get back below the low of that original retracement on the left side of the curve. So if we take a look at this first retracement on the right side of the curve right here and compare it to the left side of the curve, you can see the following. We can see that a retracement occurred from this low to this high. The moment that this high gets broken, we want to see this price range act as support on price. And therefore, I've annotated equilibrium of that price range again, because equilibrium, 50%, is a very important price level of any price range. So the moment that price retraces into that price range, into that box, so to say, my eye is drawn to whether or not it is going to act as support on price. And if it does, I'm anticipating price to expand higher. Into what? Into an old CB that formed inside this expansion leg. And here comes another gem. That CB that formed on the left side of the curve can function as a roadblock on price. So it means as an area where price will have a hard time getting through. This could mean that it will retrace after hitting that CB, or it could mean that it will distort time, so it will go sideways for a bit until the right time is present, and then it begins to expand, breaking through it. But let's say that it retraces from that CB. Let's say that after we have seen price expand higher, reaches a CB, we see it retrace. How deep can it retrace? Well, it can retrace to the high of the previous retracement on the left side of the curve. So let's say that within this sell model, this is the first retracement, second, third retracement. On the first stage of the market maker buy model, the low risk buy, price refers to the third retracement on the left side of the curve. For the next stage of the market maker buy model, the accumulation phase, price refers to the second retracement on the left side of the curve. And for the third stage of the market maker buy model, the second stage of accumulation, or what we call it, the silver bullet, price refers to the first retracement on the left side of the curve. And all these retracement legs on the left side of the curve need to act as support once broken in order to confirm that order flow remains bullish and that price is drawn towards the original consolidation. So you might be wondering, how can I open positions then? On demo accounts, of course. And what invalidates my idea if I'm anticipating higher prices? Well, there are 3 entry opportunities within a market maker buy model, and they are the following. The first entry opportunity, the low risk buy, occurs here. This low risk buy is the first retracement leg that occurs after order flow has shifted clearly, after the market displaced above this high, which is a bullish breaker. Market retraces into that, into a BC that formed during this price expansion / displacement leg, into this upclose candle, into CBs that formed on the left side of the curve here. That's your low risk buy. Where do you place your stop loss? Well, if you want to be conservative, you place your stop loss all the way below this low. However, if you want to be more aggressive and you want to, so to say, be out when ipdax is not referring to the left side of the curve in a proper manner, which could be a sign of very choppy order flow, then you could place your stop below this candle's low right here. And we're cutting through candles. That means that we're looking at very specific price levels. We're not looking at candles and thinking, oh, candle got broken, therefore we don't refer to it anymore. No, we keep levels on our chart. And that's why the low of this retracement and the high of that retracement are important reference points on the right side of the curve. So to summarize, if you want to be aggressive, you enter here, place your stop below this candle's low right here, below the low of the retracement. And if you are conservative, you place it below this low right here that formed inside of your point of interest, because that low should not be violated, especially when there's SMT on the lows right here. The next entry opportunity is the following. When you have missed the low risk buy and price displaces to the upside, the next entry opportunity is a retracement into the high of that initial displacement leg. and into the high of the second retracement leg on the left side of the curve. This usually gets paired with an upclose candle right here and with a BC that breaks through that upclose candle, making it through resistance turns support, or a bullish order block forms inside of this retracement leg. If you enter here, stop can be placed below this low, because again, if price expands above the second retracement on the left side of the curve, it should definitely not fall all the way lower if prices are going to draw towards the original consolidation's high. Because order flow has to be bullish by the discount raise inside of this expansion leg, acting as true support on price. And the final entry opportunity within a buy model is all the way up here. This is, in my opinion, the final opportunity before the range between entry to target, final target, is not worth it anymore. What we can see is that after the second entry opportunity, price expands above the first retracement leg on the left side of the curve, and it then retraces into the high of that retracement into imbalances that formed during this displacement leg, during this expansion. Entry here, stop loss here, boom, there it goes towards the buyer's liquidity above this high, and eventually higher if the higher time from order flow is bullish. So let's take a look at 3 live market maker buy model executions. So here we are at the first market maker buy model execution. What we can see is that price retraced into my point of interest, which was this candle's low right here, which was a higher time frame imbalance. I saw price displace to the upside above this upclose candle and above this series of downclose candles, these two, first downclose candle, second downclose candle, and I then entered long with a stop being below the low of the potential smart money reversal. My draw liquidity was above these relatively equal highs, because I understood that the higher time frame order flow was bullish. What we see is that in the displacement leg above this high, an imbalance formed, this BC right here. We then see price begin to expand away from that BC, which confirms that the order flow is bullish. That confirms that we have shifted from sell side delivery into buy side delivery. From there on, we are looking for every single downclose candle to act as support on price once broken. The reason why this candle's high should act as support once broken, resistance turns support, is because of the following. This candle's high formed inside this volume imbalance. Therefore, that volume imbalance should already act as support once broken. But secondly, the high that formed inside of the volume imbalance, inside of the gap, should also act as support, especially because it got broken right here by a bullish fair value gap, by a BC. And we see price begin to expand away from there, immediate rebalancing taking place right here into this candle's high. And my eye is drawn the whole time to the left side of the curve to see how it is influencing the right side of the curve. My eye is drawn to whether or not this CB is acting as support on price once broken. I do not want to see price displace below that CB anymore. Same was done here. And where could price find support next? You might be wondering. Well, the next area where price could find support is right here. inside of this CB. And look, we see a retracement leg. We see price expand, low forms, price retraces into that CB, it forms a high, then continues lower. Therefore, this upclose candle should act as support once broken. Here, price is distorting time, it's going sideways. What follows after consolidation? After consolidation, an expansion always follows. So when I see this, when I see price distorting time inside of an area where I'm anticipating price to find support, it's a beautiful sign. Again, resistance turns support. Why resistance turns support, you might be wondering? Because this candle's high got broken by a BC. Every retracement is being bought by smart money. So that means every single retracement leg that you see from this point all the way to point B, eventually, which is the drawn liquidity, is being bought by smart money. They buy, they buy, they buy, they buy, they buy. And that is what high frequency trading algorithms do. Every single retracement that occurs after change in the state of delivery, formed, gets bought, and they pyramid their way to the drawn liquidity. Notice that what I said to you about this CB having to act as support on price, in fact, occurred, and notice that a BC broke through this candle's high. And their price reaches the drawn liquidity. Let's take a look at the second market maker buy model schematic or execution. Here we can see the second market maker buy model. What we can see is that this market maker buy model entry was later than the one showcased previously to you. The first real opportunity to enter within this market maker buy model schematic was down here inside of this BC. The reason why this was the first entry opportunity was because of the following. This big up close candle right here got broken through right here. Price retraces into that BC. However, because this so-called displacement leg was no real displacement, I prefer to wait until the second opportunity in order to confirm that order flow is bullish. Because look at how the market traded above these highs right here. Notice that it's very choppy. That by itself is not a very bullish sign just yet, in my opinion. When we then saw the market retrace into this BC and it acting as perfect support on price, my eye was drawn to whether or not price would continue higher, expand. Inside the expansion leg, there's a BC. Price retraced into that, and that was the entry opportunity. I believe I entered, yep, a bit late, so a bit above the BC, but it doesn't matter because the room from point A, from entry to point B, the target, is still wide enough. Stop is below this low because this low should not be broken if price is in a buy program. Why? Because this low set up the expansion leg higher, the displacement above this high right here, and notice that on the left side of the curve, a CB formed here. So if you extend that CB to the right, you can see that a BC broke through that CB. Very important. Price trades back into the BC, but no worries because it has time to expand. I apologize about the quality not being the best inside this video. Sometimes Twitter recordings can be quite messy, and in this case it's the case, unfortunately. Notice that relatively equal highs got engineered above here. Notice how choppy the left side of the curve was. So what is that signal? It's signal that when price begins to expand, it will be rather quickly. High is drawn to this downclose candle, which should act as support once broken. Why should this downclose candle act as support once broken? I'm going to give you a bit to think about that. Please pause the video if you are scared that you will not be able to think about it properly before I answer it. This downclose candle right here is an inverted breaker. Therefore, mean threshold of that downclose candle should function as support on price if price is going to continue higher. And there the big upclose candles come. At this point already, your stop is already in my mind, or my stop is already in my mind at break even. Because I know that price should never fall back all the way to my entry anymore unless it's not going to reach my draw on liquidity. Because it has broken through multiple areas that should act as support once broken. Annotating this candle's high to low, I could annotate this candle's low to high, but because this upclose candle formed inside the CB, I choose to only annotate that. And their price reaches the target. Notice that price never had to retrace back into this gap that got created here, and that is a signal of very bullish order flow. Okay, so here we are in the third example, and as I apologize. Let me just go back to the beginning of the video. As you can see, I entered inside of this upclose candle when price showed a willingness to find support inside this BC. We purged relatively equal lows right here. We are trading below the 930 opening price. The higher time frame order flow is bullish, and therefore I'm anticipating this to be the low risk buy. Price begins to expand higher. Now I'm waiting for a new sign to confirm bullish order flow. Notice that when price closed above this downclose candle, this big fat downclose candle, the next candle opens up over sell side into the high of that downclose candle, and it then immediately goes. That's a very bullish sign. Now price broke above this upclose candle with a BC. But let's take a closer look at that upclose candle. That upclose candle formed inside of this CB. Therefore, this price level should act as support once broken. But more specifically, oh, it went back all the way to the beginning. I'm sorry. Technology sometimes. I'm going to leave this in. I'm not going to cut it out. Just enjoy the technical issues sometimes. Then you can see the delivery again. So now my eye is drawn to whether or not this BC. Why am I not allowed to watch my own video on Twitter? Let's view it like this. Surprise. Okay. I'm going to download the video and I will be back with you in a bit. because it seems like for some reason Twitter is not allowing me to watch this video. I swear to God, they're doing some weird stuff with my Twitter lately. Must be random. Alright, I've downloaded the video, and let me just fast forward it to where we were at when it stopped playing on Twitter. Price displays is above this upgoes candle right here. Now price should find support inside the BC that broke through that upgoes candle, but more specifically in the high of that candle. Price begins to expand without retracing into that upgoes candle. Why does that occur? Because on the lower time frames here, price already balanced out this upgoes candle's price range. So that means that in this big upgoes candle, on the lower time frames, price already retraced off its sell side and then shut up. Consolidation, time distortion, boom, there it goes. The moment that price broke above this upgoes candle, stop can already be drawn towards break even, or even better than break even, because price should never fall below this BC again if it's going to continue to be bullish. Price reaches this premium CB, and there it retraces. This is what I mean when I say that if price reaches a specific price range on the left side of the curve, which could for example be a CB, a premium CB, that CB could act as a roadblock on price before it's allowed to continue higher. The fact that price stopped right before reaching this buy side liquidity doesn't scare me. In fact, it makes me more bullish because I know what they're doing. They're engineering more buy side liquidity to attack at a later point in time. Price retraces, and here it retraces all the way into that upgoes candle that we were targeting. Initially for another entry, for a pyramid. This retracement lag doesn't scare me, because I understand that even though on the lower time frames this area is probably already balanced, on the 1 minute time frame it is still imbalanced, and therefore we can anticipate price to retrace into it again. And as you can see, when price reached that red level, I pyramided because equal highs got engineered, cutting through candles, meaning that I want to see that BC act as support on price. Watch me annotate. As long as we stay above this low, we're in the buy program. What occurs? Price falls through that low, and therefore I wanted to be out at break even to reassess. Then what occurred was that price went all the way back to the entry and even below it. But notice that it does displays lower. In fact, you can see that the following occurred. We have relatively equal highs engineered up here. Price retraced into a deep discount. It fails to display lower. Therefore, I was looking for another opportunity to enter. I entered the moment that I saw that price was utilizing this yellow line as perfect support once broken. Price ran over this CB. So what we can see, by the way, is that if we ignore just the price action around this area and we purely look at the price action here, we can see that an original consolidation formed above these highs. Price begins to roll over, retrace, expand, retrace, expand aggressively into a point of interest for potential smart money reversal. And then we can see that bullish order flow occurs. And the reason why I'm sharing this example with you is because this is the reality of the markets. Not every single trading day will be as clean as I outlined during the previous two breakdowns. But notice how every single discount array that formed after price reached this level acts as perfect support on price. And their price reaches the target. Let's go back into the slideshow. Let us now take a look at the sell program, which occurs within Bearish Orderflow. We are first going to take a look at a general schematic which you can utilize to gauge the order flow, and after that I will take you into some live executions and share how I view the order flow whilst price is printing. So within a sell program, within a high time frame bearish order flow, we know that this is the market maker sell model that always is present. This occurs through the following lens. A original consolidation forms. Below that, sell side liquidity gets engineered. Market expands away from that original consolidation into a point of interest, into a deep premium of the current range during the right time, and it reverts. It reverses lower. The left side of the curve is filled with expansion, retracement, expansion, retracement, expansion, retracement. Final expansion, then a displacement leg occurs. So this is an expansion leg as well. Retracement, expansion, retracement, expansion, retracement, expansion. If we take a look at a more advanced version of the schematic, we can see the following. We can see that from the original consolidation to the high, we have drawn premium to discount. The reason why premium to discount is important is because if we are bearish and we are looking for shorts, we preferably want to go short inside of premium of this range. Meaning we want to short inside of the red area preferably, or in close proximity to equilibrium, which is 50%. The moment that price displaces below the range midpoint, below equilibrium, 50% of that range, we're anticipating the opposite side of the range, so in this case, the lower side of the range to get reached. Notice that we have again outlined all of the retracement legs on the left side of the curve. Let's take a look at the first retracement leg. The first retracement leg occurred here. So what we have done is annotated the high to low of that retracement leg. The second retracement leg formed here. What we have done is annotated the high to low of that retracement leg. And then the third retracement leg occurred here, annotated the high to low of that retracement leg. Then finally the market displaced below that third retracement leg on the left side of the curve, which confirms a change in state of delivery. Sell program begins. From that moment on, every single retracement leg that occurs should retrace into a previous retracement leg's low on the left side of the curve. From there on, sell side delivery should occur. Important price levels on the left side of the curves are 50% of each retracement leg. The first entry opportunity to go short is the following. This opportunity is the low risk sell. This occurs after you've determined that the smart money reversal is in and price displaces lower. Inside the displacement leg, there will be a CB here that breaks through this low. This low preferably formed inside of a BC on the left side of the curve. Market structure shift pattern, first short opportunity here. Where do you place your stop loss? Well, if you're conservative, you place it above the high. If you're a bit more aggressive, you place it above the high of the retracement on the left side of the curve. Second entry opportunity is right here. This entry opportunity is an entry opportunity which forms when the market expands away after the initial entry opportunity and the market retraces into a CB that formed during that expansion leg into the low of that retracement, which set up the initial entry opportunity. And the final entry opportunity is right here, and this occurs when price expands away from that Second entry opportunity, and the market retraces into a CB that formed inside the expansion leg, and it then continues lower towards the original consolidation. For both the second entry opportunity as the third entry opportunity, it's important to note that the stop gets placed above the previous high that forms. So where we said that inside of this entry opportunity in the first one, we would place our stop either above the swing high right here or above the high of the retracement. For the second entry opportunity, it's the following. We place our stop above this candle's high. And for the third entry opportunity, we place it above this high. Because every time that price displaces lower, price should never return back above the high that set up the displacement or expansion leg. Therefore, that's how we manage our positions. Let us take a look at 3 live market maker sell model executions. So here we are on the first market maker sell model execution. What we can see is that price traded above this buy side liquidity here, which is the lunch buy side liquidity. Market consolidated above that, it distorted time and it then fell lower. Notice that price is respecting the CBs that formed inside of it displacement leg. Then price displaces lower again, new CB, price respects that CB perfectly. And then a new CB forms. Here, price retraces into that and price will seek to find resistance there and continue lower. Notice that I entered personally already when price displaced below the highest BC on the left side of the curve right here, because that should act as an inversion on price if price is going to be bearish. Next that, this BC should act as an inversion on price if price displaces below it. Price begins to roll over slowly. New CB forms here. Left side of the curve is influencing the right side of the curve. Notice that every single upclose candle inside of this leg lower from this high to eventually this low is acting as resistance on price. But when I say upclose candle, I do not just mean one upclose candle. This could also be a series of upclose candles. So for example, 1 or 2 or 3 upclose candles in a row that get broken through, and then you see the first upclose candle in that series get utilized as resistance from price. Original consolidation right here, relative weak lows engineered. Therefore, sell side liquidity is resting below those lows. And there the market expands towards the draw on liquidity. That is this market maker sell model completed. If we just take a look at the final delivery and we account for what was shared when it comes to position management, we can see the following. Every time that a high formed and the market displays to lower, we do not want to see price trade above that high, especially when these highs formed inside of CBs. And that is the general rule of thumb when it comes to position management. So even though I am not trailing my stop like a madman here, that is what I'm looking at. I'm looking whether or not the premium rays that are forming are acting as resistance on price. Because if they don't, if they fail to continue to act as resistance on price, it's a warning sign to me that something might change in the underlying order flow. But in this case, every single premium ray acted as perfect resistance on price, and therefore this was a nice market maker sell model to include within this lecture series. Here we can see the second market maker sell model example. What we can see is that the market reached a deep premium. It respected a price level that I was looking for to be respected, a point of interest, perfectly. We then saw a displacement leg lower, right here, below this candle's low, breaking through this BC, here on the left side of the curve, and therefore this BC's price range should act as an inverse price range on price if price is going to roll over. Higher time frame order flow is bearish. We're anticipating lower prices on the higher time frames, and therefore this is the scenario we're looking for. We then see price retrace into this CB. It's very tiny, but the market retraces into that, and notice how the bodies are closing inside of that CB. The wicks are trading outside of it. They are mohawks, but the bodies are telling the story. The market then displaces lower and creates another CB here. The moment that price fell lower, again after trading into this CB, I waited and I shorted the retracement into this upclose candle, into that area. Stop was above this high, but in reality it could have already been above this high because price should have never gone above this high if it was inside of a bearish market. Now notice how I'm saying that this price range will be an inversion price range. This BC, this fair value gap, will function as an inversion value gap once broken. Because I understand that price is in a sell program on the higher time frame, and therefore all these discount arrays that are forming on the lower time frames on the M1 time frame that seem to be bullish arrays will be disrespected, and if they get disrespected, we will be looking for them to act as resistance once broken. Here you can see me monitor whether or not price will retrace into that inversion value gap. Wanted to see if that would occur because then I could pyramid there, but price reached my first partial, my first objective already before retracing. Then this BC should also act as an inversion once broken, but think back to what I outlined to you in the market maker buy model schematics. Whenever there's a BC, an imbalance in deep discount, right before the original consolidation, price could find, in this case, support there before it continues lower. And that's what we see here. Price taps into this BC and it doesn't straight break through it. Instead, it spends some time around this price range, which is time distortion. And once it begins to run, it will reprice quickly, is what you can see me right here. Notice that I'm not being fearful here, even though price is showing signs of potentially drawing higher when the market showed these big up close candles. I look at that as, oh, they're generating the idea right before my final target that a low is in. And so everyone tries to chase that. And here you can see that the market reaches the second target. And now you can see me aggressively manage the position because price went below this low, the reaction to this low signaled it all. And therefore I was looking for whether or not this BC would act as an inversion on price. What we see is that price goes above it, then finds support on it. So I knew that I would likely get stopped out on the remainder of the position. Because if price was going to trade lower, it would have just broken through this price level with speed and velocity instead of such a big mohawk wick, which seems like a sweep of sales at liquidity. And here we are in the third example of the market maker sell model executions. This was very quick from the entry because I entered inside of a retracement into this BC, this inversion value gap, and into the low of this candle right here. After I've seen that the confluences that have been shared thus far during this lecture were present, meaning SMT on the highs during the right time, displacement lag within a higher time frame, order flow which is bullish, but understand that in order to go higher on the higher time frames, we must first target sell side. We must first retrace into discount. So therefore, I was confident in that we were likely to draw towards sell side liquidity after purchasing the all-time high and seeing the signs that could confirm a reversal. Went short, wanted to see speed and velocity below this low right here. Partialed below this low. Notice that price is generating relatively equal lows right here. It's engineering, I must say. I'm not scared by this move higher right here and looking at that as, oh, this is displacement higher, market structure shift pattern, let's target these highs. No, because the higher time frame idea or analysis is always leading when it comes to determining where prices like to draw next. It's not just patterns for the sake of patterns. That's why you can see me say it's the engineering of sell side liquidity. And as long as price stays inside of the CB, I have nothing to worry about. One thing that is important to note is that if we take a closer look on the left side of the curve here for a moment, you can see me having annotated this candle's high right here. Why that candle's high? Well, that candle's high is the following. We saw an expansion leg, small expansion leg, but we saw an expansion leg, high form, low, higher high. This high acted as support on price right here. Look at the body's closing at it. Extend this price level to the right. Boom, perfect resistance on price. A gem I didn't share before because I didn't think I should share it, but here you go. And this is one of those things that many people do not see when they look at my executions, but it's just hidden in plain sight. And I would highly suggest you to investigate the logic shared during this lecture when it comes to the left side of the curve influencing the right side of the curve. My eye is drawn to these relatively equal lows. I look at all of this as time distortion, price waiting for the right time to come around, and then the market begins to expand lower. Price should now not come above this candle's high because this candle's high set up the expansion leg into the sell side liquidity below these lows. So therefore, if this high would get broken, it would be a potential bullish breaker formation. Target a premium of this range. But because there's no displacement leg that occurs above this high, no shift in order flow or change in state of delivery is present, and therefore order flow remains bearish. Final target is the London low. This red line is the low of the regular trading hours gap, also a key price level. And the market begins to expand towards the price level. Now I'm monitoring the reaction of the price level because a crucial time has arrived. And when I saw that price respected the low of the regular trading hours perfectly, I decided to close my position. However, when the market retraced into this series of up-close candles right here, 1, 2, 3, and we saw displacement lower below the regular trading hours, low, and below this down close candle, I went short again because I was targeting the London sell side, and a bit below that. And we can see beautiful bearish order flow, immediate rebalance, breakaway gap. Why? Because this price range is already balanced. Therefore, price does not have to retrace since it's so bearish. Immediate rebalance again right here, and price reaches the target. So that's the third market maker sell model execution done. We're now going to take a look at key time windows for reversals and or expansions. I'm going to specify time more for you. I have given you certain time windows to look for smart money reversals already, but we're now going to take a look at more specific time windows to also confirm expansion legs. And the reason why I'm sharing these time windows with you is because when we're viewing price, we need to understand that if price is not expanding or showing a willingness to expand during these time windows, then the market is likely to chop around and consolidate. So we are learning here how to recognize whether or not a market is going to expand or consolidate. And this is a very important lesson to learn because it will separate you from the majority of traders out there that are caught off guard when the market basically showed signs of expanding initially away from entry, and then out of the sudden it fails to displace lower or displace higher, and it just consolidates and eventually falls back on your entry and maybe even takes you out for a loss. So let us take a look at the key time windows for the London session initially. The first key time window for London is from 2:45 to 3:15 a.m. And the reason why this time window is important is because of, first of all, it's within the general time window that has been shared with you for the London session. But secondly, it's around the 3 a.m. opening. 15 minutes in advance of the 3 a.m. opening and 15 minutes after the 3 a.m. opening. And what you will often see is that if London is going to present nice market maker model opportunities, then a SMR, smart money reversal, has either occurred already from 2:30 and from 2:45 it begins to expand, or the SMR forms during this time window and after that it shows a willingness to expand. The second time window for London is from 3:45 a.m. to 4:15. If during these two time windows the market is not showing speed and velocity being injected into the marketplace, then that's a sign to get the F out. And it means to focus on the next opportunity. Because if there are no signs present of an expansion occurring after the smart money reversal is confirmed, then we can anticipate very choppy delivery to occur. If we take a look at the morning session, the first key time window for the morning session is from 9:45 to 10:15. Between 9:45 and 10:15, we want to see either a smart money reversal form if it's not in already, or we want to see the market begin to show signs of willing to expand into our anticipated direction. If this does not occur, it will likely occur during the next time window, which is from 10:45 to 11:15. If the market did not show any signs to begin to move, meaning that volatility got injected into the marketplace during that first time window, then we can anticipate the second time window to be utilized for this. With regards to environment selection, this also plays a huge role with detecting which time window is likely to be utilized for the expansion or the beginning of the expansion of that session. Because if we take a look at the 9:45 to 10:15 window, if, for example, there's a, let's say, a very choppy session, very choppy opening range, then the market is likely to chop around all the way into 10:30. So engineer liquidity on both sides of the marketplace for at least an hour and then manipulate to one side of the marketplace, trap people into believing that's gonna go one way, and then from 10:45 or around 10:45, a low or high will form, and the market will begin to expand outside of that range. Just one simple example, but please refer to the opening schematics that have been shared during previous lectures with regards to how we can apply the opening ranges. Because if we understand that during these time windows, specific things should occur, meaning that we should see displacement legs occur and the market begin to expand into a one-sided direction, then this will give us very time-based opportunities, but also very time-based opportunities to manage our positions. Because if the market is not showing a willingness to continue to expand during these time windows, or at least begin an expansion during these time windows, then that's a warning sign. That means, okay, we might be wrong with our whole thesis for now, and therefore we might need to cut our trades. For the afternoon session, the first time window is from 1:45 to 2:15 p.m. and the second time window is from 1:45 to 3:15 p.m. What you will often see is that if that first given time window forms a smart money reversal, the market will expand all the way to 2:45, and if it reaches the draw on liquidity by then, it's possible that the daily retracement will form from the second time window for the afternoon session. If the higher time frame objective, if the daily draw, so to say, the daily predetermined price level where the higher low will form, has not been reached yet before 2:45, then the market is likely to continue to expand to that price level during this time window. These are very rule-based time and price models that I am teaching you. If you're not paying close attention to the words utilized to share this with you, you are likely to miss out. And that's why you can't treat this series like a Netflix series, where you just go through everything, don't take proper notes, don't go into your own charts, because then you will not see the real value in what is being shared. I know that some people look at this and think, oh, okay, nice to know. And then next week they just go into the charts, into the live charts, and they say, oh, because he said so, it should work this way. Instead of going into their own charts and see whether or not there's any validity behind the things that I'm sharing with you. Don't be lazy. Don't be lazy, because by simply watching these lectures, it will not be enough to make you understand it. If we take a look at the next schematic, we are going to look at the following. Here we can see the schematic again from the buy program that was outlined before. For the buy program, there are three opportunities too long. Our eye is drawn to whether or not the buy program will begin between 2:45 to 3:15. If the smart money reversal occurs prior to that, so between 2:30 to 2:45, then we are looking for this 30-minute window to expand price. So to show a willingness to continue higher. If we are taking a look at the next time window for the London session, we can see the following. We can see that we are looking for a smart money reversal to form between 3:45 to 4:15 a.m. if it did not form just yet. And if it did not form yet, then this is the final chance for a smart money reversal to form. But I would say even that the smart money reversal should have already formed by 4 a.m. if one is going to form at all during the London session. This time window should be utilized for expansions. For the AM session, the time window of interest where a smart money reversal should form preferably, or at least signs of an expansion if a smart money reversal already occurred between 9:30 to 9:45. The signs of an expansion should be present between 9:45 to 10:15 a.m. By the way, if you are not taking screenshots thus far of these schematics, you are missing out. Don't be lazy, take screenshots of each schematic, and then when the delivery occurs, which it will occur, you will be able to refer back to those screenshots, back to these schematics, and you will see that there's a certain repeating phenomena that occurs during these time windows. So if the smart money reversal occurs right after 9:30, so before 9:45, 9:45 will not form the low. Instead, it will likely continue the trend of that smart money reversal. For 10:45 to 11:15, this is what the schematic looks like. This occurs when from 9:30 to 10:30 the market was messing around, chopping around, maybe generating the idea that we were going lower but not delivering aggressively lower. Instead, the market reaches a higher time for POI between this time window, and then it shows a willingness to reverse, and then from there on we can see buy side delivery occur next. Notice that it is not a preferred scenario because it's of course outside of the initial time window given from 9:30 to 10:30, but this is an additional time that we can look at if specific criteria have been met. The main criteria to look out for is the following. How is the opening range being formed? After the first 30 minutes, you already know whether or not a smart money reversal is going to form anytime soon. If the answer to that question is no, then we will anticipate a smart money reversal followed by an expansion to form later down the AM session, and that is when this time window plays a key role. If we take a look at the PM session, you can see that for the PM session, the key time window is of course 1:30 p.m. to 2:30 p.m. If a smart money reversal occurs between 1:30 to 1:45 p.m., then the time window annotated here will of course not form the low of the market maker buy model. If that occurs, we want to see that time window here expand price, so inject volatility during this time window. If a smart money reversal did not occur between 1:30 to 1:45 p.m., then we are looking to see whether or not it will form between 1:45 to 2:15 p.m. If the smart money reversal does not occur within these time windows, our eye is drawn to the next window, which is 1:45 to 3:15. If a smart money reversal occurs between 2:30 to 2:45 p.m., then we are anticipating the market to expand between 2:45 to 3:15 p.m. If the market did not form a smart money reversal between 2:30 to 2:45 p.m., then we are looking for a smart money reversal to occur between 2:45 p.m. to 3:15. Again, this occurs when that initial time of interest between 1:30 to 2:30 p.m. does not show a willingness to form a smart money reversal and expand price. Then our focus is on the third 90-minute window of the PM session, meaning from 2:30 to 4 p.m. to see whether or not any opportunities will present themselves. However, it's important to note that I suggest you to only focus at one time window, and that time window is a time window shared during the time lecture. For the people that are more advanced and want to do more, these are the extra times that they can add to their protocols. For the cell programs, the logic is of course inverted, and therefore please take screenshots of the following schematics so that you have them within your notes. Here is the second London time window where a reversal or expansion leg should occur during. Here's the first time window for the AM session where a reversal or expansion should occur during. Again, please take a screenshot please of these schematics so that you can study them at a later point in time without having to go back to the video. And here's the second time window for the AM session that is of relevance when it comes to detecting a potential reversal and or expansion leg. For the PM session, here's the schematic for the first PM session's time window where we are looking for a reversal or expansion to originate from. And here's the second time window for the PM session where we are looking for signs of a reversal and or expansion to originate from. So to summarize this lecture and to summarize basically the protocol that has been shared thus far with you, we can see that we come to the following rules. First of all, we must know the higher time frame order flow. We must determine the drawn liquidity, which comes as a result of determining A to B, where is price likely to draw towards next. From there on, we have our times of interest for all the sessions. They have become even clearer after today's lecture. We have our point of interest. We are looking for this point of interest to be reached during our time of interest. We will then look for SMT, a cracking correlation with highly correlated markets or inversely correlated markets, of course. And we will look for change in state of delivery, meaning a market structure shift or a willingness of the market to displace into the opposing direction of what the order flow was thus far until reaching the point of interest. We will then look for an entry opportunity, and once we have entered, we will feel order flow. Is order flow confirming your thesis whilst being in the position? This is trade management. This lecture was pretty comprehensive. There was a lot of topics that were discussed. I hope that you were able to listen to it properly, that you are not basically experiencing a headache, so to say, of all the information shared. If this is the case, good stuff, because you have learned new things then. And I would advise you to go back to this lecture at a later point in time when you feel like you need to pick up on new stuff or need to pick up on specific topics shared during this lecture. This is a lecture that showcased that there's way more to the market maker models than it seems, simply on the surface. And this was the first real lecture in which I shared additional gems to what has already been shared. I'm excited for the next lecture because during next week's lecture, we're going to take a look at the following topic. We have discussed so far the technical side of things. We have discussed what things we are looking for when it comes to technical analysis. We're now going to take a look at environment selection because we will only look for these things inside of the markets during specific environments. So that is what next week's lecture is going to be about. Environment selection. When do we look for these things then? Okay, it's nice that we understand it now, but when should I look for it? And when shouldn't I it? When doesn't it work? So that is going to be a very exciting lecture because it's going to be all about planning and seeing it in advance when the probabilities or the odds are in our favor. I want to thank you for watching this lecture and I wish you a nice day. I look forward to speaking with you soon. Hello there. I hope that you are doing well. Welcome to the 6th lecture of the day trading model series. During this lecture, we're going to talk about environment selection. Environment selection is by far one of the most important things to understand and to master, because having an understanding of the model, of what it looks like, the rules, all of that is simply the foundation. It's basically the thing that you apply when the right environment is present. So before you can even look to apply the rules that have been provided to you thus far, you must first know and learn when those rules can be applied and when they cannot be applied, because that's even more important. So this lecture will be by far one of the most significant lectures thus far, because this lecture will teach you when to look out for something and when not to look out for something. And that is something that 99.9% of all the traders out there don't know. They just show up every single day and they see a pattern and they trade it. And they wonder why their win rate, why their position is off. It's because they don't understand when and why and where the pattern should work. That's it. So that's what we're going to discuss during today's lecture. Before we begin, I must first give you an obligated risk disclaimer, of course. I am not a financial advisor, nor is TOTK the one said no. You have signed up to the mentorship platform, and whilst doing so, you have agreed upon our terms of services, which state that you accept that everything that gets shared is meant for educational and or entertainment purposes only, meaning that none of the information that I will share during this lecture can be used for financial investments by yourself. And we are not responsible in any way or shape. If you want to read the full risk disclaimer, you can do so by going to theonesthatknow.com. So let us first take a look at the table of contents for this lecture. We're first going to take a look at the economic calendar. That means that we're going to take a look at how we can use the economic calendar to determine what days and sessions are high or low probability sessions. Next to that, we're going to take a look at the session profile, meaning what is the current session likely to look like? How is it likely to deliver? Next to that, we're going to take a look at intermarket relationship. And finally, we're going to take a look at macros and price delivery. This is going to be a lecture in which you will have to take either a lot of screenshots or notes, because these rules will be very insightful down the line. Because when you start studying historical market data and you start studying when the model does not work and when it does work, you will figure out very quickly that the rules that will be presented today are of great influence to determining when the environment is high probability and when it isn't. High probability being the following. A high probability environment is an environment in which the odds are in our favor, meaning that there is a high chance of our thesis, of our draws for liquidity, being right, being correct. Let us first take a look at some general rules for the economic calendar. First of all, a no news Monday gets avoided at all costs, unless it's NFP week, meaning that if there's no news on Monday, we avoid this. The reason why we want to avoid a no news Monday is because no news Monday is usually very choppy when it comes to how the markets deliver. This is something that I've experienced in the past tremendously, when first of all going through old market data, historical market data, but also whilst trading or trying to trade it live. The delivery is not clean most of the times compared to the other days. And it has to do with the weekly accumulation that takes place on Monday, meaning that the whole weekly delivery is basically being set up on Monday, or at the beginning of the week, I must say. And therefore, we want to avoid a no news Mondays. Significant high impact news during a session can result in chop the session prior, meaning that if we, for example, have high impact news during the morning session, during the New York morning session, that is significant, we can anticipate the London session, which is the session prior, to be choppy. Note that this is only the case when there is a significant high impact news driver. During this lecture, we will discuss what news is significant and what news is still important but not as significant as some other news events. The reason why the session prior is likely to be choppy is due to the fact that liquidity usually gets engineered that they will be able to utilize with the release of the news event for manipulation purposes. Unless a market maker model is confirmed, meaning that the low risk phase has provided one-sided order flow, the low risk phase being either the low risk sell or the low risk buy, we do not try and predict what the high impact news will be utilized for. And the reason why I'm saying this is because let's say that you think a smart money reversal is in and news comes out in a few more minutes. Let's say that you believe to have seen displacement at a CB form. You try to short inside that CB. And now the news comes. And it immediately runs higher, it takes you out. What did you do wrong? You did not wait for significant signs of the market maker sell model being confirmed. And that's what we often see. When the market maker model is not confirmed yet, meaning that the low risk phase is not confirmed so far, the news can be utilized for another run higher for manipulation purposes, and then begin to show signs of a reversal occurring. When the market maker model is already near completion, meaning that we've already seen the market trade away after forming, for example, the low risk sell within a sell model, and the first distribution stage taking place, and now we're at the second stage of distribution, then news is likely to be utilized for the heavy repricing lower towards our target. And the reason why this is important is because by knowing this and by studying this, you will see at what times people that trade in front of news get it wrong and get it right. Let us now take a look at the economic calendar for an NFP week. For an NFP week, the focus is on the beginning stage of the week, meaning Monday till Wednesday's AM session. The reason why we want to focus on these days is because, first of all, it's the first week of the month. So that means that the first week of the month is crucial for determining how the remainder of the month will likely deliver. That's also why NFP takes place at the beginning of each month, because they utilize it to basically reprice it aggressively to, for example, basically confirm what the delivery for the remainder of the month is likely to be. That's why NFP is a crucial reference point, and that's why oftentimes you see NFP just be one very heavy repricing, one-sided, and that is crucial for the monthly delivery. And because this is the case with NFP, we do not want to basically trade the day prior to NFP, meaning the Thursday, because the Thursday is going to be very messy. It's usually very choppy. And same for, of course, the London session on NFP days. The only reason why we want to book the trade on Friday is after NFP's release and after we have seen clean delivery, but we will touch on that soon. The reason why we want to focus on the beginning stage of the week is because the beginning stage of the week is likely to be utilized for the nice clean order flow instead of the final part of the week. Because there are still orders that have to be fulfilled every single week. So when do they do that? Do you think that big institutions would wait for basically Thursday or Friday to fulfill their orders? To make the transactions required? Of course not. Why not? Because the risk is too high. So they do it early on in the week. And that's why you see the cleanest delivery during NFP weeks early on in the week. So here you can see the rule: avoid Thursday at all costs. It's not worth even looking at Thursday during NFP week because the delivery is going to be very choppy. Usually avoid Friday's AM session as well, because when NFP reprices aggressively one-sided, the delivery afterwards is usually not pretty neither. It's usually very slow delivery, And if it begins to deliver, it will be quick. However, the amount of PD arrays that form during that period are usually not a lot. So therefore, if you want to still trade after NFP, the focus should be on the PM session. So the focus is then on Friday PM. We're now going to take a look at the economic calendar for an FOMC week. FOMC is always on either Tuesday or Wednesday. So that means that if FOMC is always on Tuesday or Wednesday, we can already know that the day prior to FOMC, we want to be very nimble when it comes to taking risks. And the reason why we want to be nimble is because FOMC is next to NFP and next to CPI, that we will discuss soon, one of the most important economic news drivers that takes place, that is fixed. Of course, there are also random, so to say, events that take place that have a huge impact on the markets when it comes to volatility injections. But these are the volatility injections that we are aware of, that we can see coming because they're already scheduled for the whole year, basically. But because we know that FOMC is always on either a Tuesday or Wednesday, we want to avoid the day prior. Meaning that if FOMC is on Tuesday, we want to avoid Monday. If it's on Wednesday, we want to avoid Tuesday. And the reason why we want to do so is because for FOMC, again, a lot of liquidity has to be engineered that they can attack during that news event. Whenever there is FOMC in the afternoon, avoid AM at all costs. Meaning that if FOMC is, for example, during Tuesday's PM session, we will avoid the AM session at all costs. And the reason why we want to do this is because the AM session is likely to deliver in a very tight range. If FOMC is during Wednesday's PM session, we will, of course, look to avoid the Wednesday AM session for the same reason. Now, it's very important to note that FOMC is something different than FOMC minutes. They are two different events, meaning that the FOMC that we're discussing now, that we are being very cautious about, is the following. It's a two-stage delivery event, which means that the first manipulation run occurs at 2 p.m. and then the second manipulation at 2:30 p.m. We look to engage post 2:30 p.m. There's another FOMC event which is called FOMC minutes. This event is basically a 1 moment volatility injection, just like any other regular high impact news driver visible on Forex Factory. So if we know the difference between FOMC and FOMC minutes, we can say that FOMC is basically the news driver that we're discussing these rules for, and for FOMC minutes, the same general rules apply as discussed prior. So let's take a look at the economic calendar for CPI. CPI is always on either Tuesday, Wednesday, or Thursday, or it's basically during the middle of the week, between Monday to Friday. Don't trade the day before CPI. The reason why we don't want to trade the day before CPI is because, again, the day prior to a significant high impact news driver is likely to be choppy, meaning that liquidity gets engineered, meaning that time distortion is likely to take place, meaning that the marks are likely to be held in a tight range, consolidate, and then that consolidation will be utilized for the repricing during CPI. A general rule of thumb when it comes to CPI and NFP and FOMC is that you never want to stand in front of them, meaning you will not try and gamble on the outcome of these events, because these events have an increased likelihood of being used for manual intervention, meaning that someone or an entity literally goes into the markets and says, we need to reprice it to this price right now. And that's when you see like a one-sided up close or down close candle of a lot of points or handles or pips. If CPI is on Tuesday, we skip the Monday. If there's CPI on Wednesday, we skip the Tuesday. If there's CPI on Thursday, we skip the Wednesday. We're now going to take a look at something more advanced because the rules for the economic calendar are pretty straightforward when you understand them. And one thing before we dive into the session profile is that for the economic calendar, it is crucial that you really spend time investigating whether or not what I just outlined to you has an increased chance of you staying outside of low probability days and taking unrequired risks. Because if we know that a session is low probability, why would we even decide to look at it? How to detect if the session is likely to chop around? First of all, we will take a look at the economic calendar. For example, the day prior to significant high impact news is likely to be filled with choppy sessions to engineer liquidity as explained prior. If we know that this is the case, if we know that there's a significant high impact news driver tomorrow, what can we anticipate for today? We can anticipate today to be a mess, and therefore the best thing to do is to walk away. Secondly, a choppy session usually takes place when there's no clear higher time frame draw on the liquidity, meaning that it's not clear on the higher time frames what the move from point A to point B is. Therefore, we need to wait for more market data to become available to signal to us this is the next likely move. Thirdly, we will take a look at intermarket relationship not supporting one-sided order flow. Meaning that intermarket relationship is not showing signs of, for example, the dollar distributing lower whilst the index futures are going higher, or for example, the index futures themselves not being in sync with one another. When one of those two scenarios occur, we can anticipate either a very choppy consolidation range or a high resistance liquidity run. Neither of those scenarios are preferred because our job is to determine low resistance liquidity runs, the runs in which you enter and it immediately begins to expand. And finally, the macros not supporting one-sided institutional order flow, meaning that the macros that we are focused on not showing signs of the market wanting to reverse or expand, therefore not move in a one-sided direction. Because if that would be clear, if that would be obvious, then of course we can say, well, the only reason why the macros would begin to expand is because there is a clear higher time frame draw on liquidity and because the market is predetermined to expand during that session. But if that is not the case, if those macros are not supporting that one-sided institutional order flow, then it's a very big warning sign that we either completely walk away, decrease risk significantly, or cut our positions quickly, rapidly, trail our stops aggressively. We're now going to take a look at a chart example where we can see the macros not delivering one-sided institutional order flow. This was the PM session prior to NFP, so this is exactly the delivery that could have been anticipated. What we can see is that even though during the 11:45 to 12:15 time window, the market trades higher, we see that it's very messy. We see that there's a lot of back and forth going up, sideways, up, sideways, up, sideways, up, sideways. And then it retraces, 12:45 to 1:15 comes along, consolidation, very slow repricing higher, repricing higher, 1:45 to 2:15, market turns around very slowly and it goes sideways, it consolidates, and then between 2:45 to 3:15, a few minutes of distribution occur, market reprices lower aggressively. Are you noticing how there aren't any real expansion legs during this whole delivery, during this whole PM session? Meaning that there is a lot of back and forth going in which the order flow itself is not pretty and it's not nice delivery at all, especially this reversal right here. And when you see that this is the way that the market is delivering, where the candles themselves are rather small, meaning that the volatility that is present is not that high, is a sign that, okay, this session is likely to chop around a lot, and this means that you either walk away right away, or you say, okay, I'm going to decrease the risk because the likelihood of the market not expanding is very high whenever it's the day prior to, for example, NFP. And this is a perfect example of what a PM session prior to NFP looks like. Meaning that the delivery is choppy, the delivery is slow, the delivery is not aggressive. Even though there might be imbalances that you can trade off, it's not worth risking anything in my honest opinion. Please don't fall for the following trap. This is a trap that many people fall into when they begin to learn about rules for environment selection, and it's the following trap. Please be mindful of this. Here we can see the Monday prior to CPI. So CPI was on Tuesday. What do we know? Whenever there's CPI on Tuesday, we want to avoid no news Monday, because no news Monday is likely to chop around. What we can see is that during the AM session, the market repriced higher. Then during the PM session, the first 90-minute PM cycle, the market forms a high and it begins to reverse or show signs of reversing above the AM high, above the morning high. Now I'm going to ask you whether or not the delivery above the AM high right here, showcased by this gray box, is clean. Is this a clean market maker sell model to you? Is this whole leg, which could be the low risk sell followed by the distribution, followed by again distribution, clean? The answer is of course no. Why not? Because it's the day prior to CPI, meaning that there is a lot of back and forth going until the market is finally allowed to expand lower aggressively. And this is exactly why the majority of people fail themselves, because they don't understand that these type of days in which there's this nice low resistance liquidity run lower are not representative for all the Mondays prior to CPI. And therefore, when someone sees this that is completely new to the markets, they immediately feel like, whoa, damn, I could have participated in this whole move lower. I could have shorted it above the AM high. That's what a point of interest is for the PM session. You know, that's the mindset that a complete newbie has. They are driven by emotions. They are driven by, for example, fear of missing out. So they want to be in every single move. And I'm telling you right here, you will never capture every single move. And neither should you even want to. Because why would you want to create so much mental baggage for yourself that you engage in low probability environments? And even though an environment like this might deliver one day, the next time it will likely not. And the next time after that, again not. And you just engage in 2 low probability days because on the first low probability day, the market delivered. And you thought, okay, this is representative for all those days now going into the future. Absolutely no. And that's exactly the reason why sometimes these type of days get utilized for still clean delivery, to trap people into believing that every single low probability day like this within such an environment is going to deliver this way. And I'm telling you, it is not. And if you spend enough time in the charts, you will figure out that that is the case. And therefore, you need to give yourself permission to say, I am going to determine the environment, and based on the environment selection that I subscribe to, I choose whether or not I would even look to engage within a session. That is how you decrease the frequency of trades, that is how you decrease the amount of risk that gets taken, and that is how you gain a edge in due time. Because you will be able to refer back to all the times that you engaged in environments that were not preferred, and you will be able to learn from that. So this wasn't a very important chart for me to share, in my opinion, because I feel like this is something that could potentially harm someone that's completely new. They might listen to the rules that I'm providing here within this lecture, and they might look at the chart still one day on one of those days that I told you to avoid, and they see the clean delivery, or they see a low resistance liquidity run, and then they think that that is representative for all of those days. And then you think I'm wrong, and you think that the rules, the logic that I'm using doesn't work, etc. Well, I'm telling you, This logic is what keeps you out of the mess in the long run. And one day of okay delivery doesn't mean that you can then expect that same delivery to occur on every single day that has the same environment. So when you determine a session to be low probability, why are you even looking at the charts to trade with your capital? Why would you even do that? When I ask you the question, doesn't it make sense to just run away, to do something else besides trading, to do something fun, to spend quality time with your loved ones, maybe to just relax, to recharge for high probability days? Of course, that makes sense to do that. But the reason why you're still looking to trade is because you're addicted to doing something. And that is something that we will discuss during the psychological lectures that you will have to get under control. Because that's right there is a sign of a potential gambling addiction in which you want to do some, you want to just feel the urge, you just want to take the risk, you just want to push it. And that is wrong, my friend. You need to control yourself, and that you do that by simply saying, I will only submit to look at high probability environments, high probability days. And that means that you can immediately decrease the amount of days that you will be even looking at the charts significantly. And that time you can utilize for other things. And isn't that the goal of trading? To not be addicted to the charts all day? Of course it is. Of course, that is the goal. To be able to determine this day is high probability, that day is not, so therefore I should avoid the low probability day. If you still decide to look at the charts on a day that you have determined to be low probability, decrease the risk significantly. Meaning that if you take a loss, that loss will not make you worry about it, that loss will not make you upset, that loss will basically be counted by saying, you know what, I was in a low probability environment, I took a minor loss, that's it. If you over leveraged on a low probability day, the mental baggage that will carry along with it will not be worth even taking the risk in the first place. And you will have to experience that a few times before you understand it. And when you understand it and when you experience it, you will come back to this lecture, maybe in a month, maybe in a few months, maybe in a few years, and you will think back to me saying this, and you think, damn, he was right. Imagine what it would feel like if you would take an unrequired loss with a large amount of risk in a session that you already recognize to be low probability. Just imagine what it would feel like. Just close your eyes for a second and imagine yourself going through that. Imagine how you would respond. Imagine how you would feel. Imagine maybe the amount of sweat that you would create or the pressure that you would feel. Would that be worth the risk? Would it be worth it to risk something in such an environment? You already know the answer to that question. It's just that the impulsive person inside of you is still trying to make you trade days that are not high probable. And that is where the analyst has to be in control no matter what. Because environment selection is a result of determining, okay, when is the market likely to deliver in a way that I want it to deliver. And the only person that can determine that is the analyst inside of you. There are three main drivers inside of each one of us. We first of all have the gambler, we have the trader, and we have the analyst. The reason why the gambler is in the first place is because this is our human nature. This is how our brains have been created. We are impulsive, we are emotional, we are basically flawed in that sense, meaning that we can do things based on emotions. This is how the markets take money from everyone. The trader is in the middle because this person is the person that executes, the person that puts in the positions, manages the risk, and executes it. And the third person that could be in control is the analyst. And the analyst is the one that listens to sound logic, that listens to his protocol, and is able to do things based on that. you need to always have the analyst be in the control of your own actions. Or as ICT always used to say it, make the analyst be in the driver's seat. Always. Because if that gambler of you is gonna sit behind the steering wheel, things will go wrong. And to avoid the gambler being allowed to sit in front of the driver's seat, in front of the steering wheel, I must say, the one thing you can do is simply basically making sure that the analyst makes a good preparation. This is the day I'm looking for to trade. This is the day I'm interested in, and then showing up to that day and not showing up to the day that you're not interested in. Because by showing up to a day that you're not interested in, you're already giving the gambler an edge, because the gambler is already like, oh, today the trader is not completely listening to the analyst. Maybe I can slip in. And that right there is the devil, my friend. And I'm sorry I'm going off topic here. I'm not going to cut this out because I think that rant right there, when you truly understand the meaning behind it, and when you truly have experienced stuff like that, you will see the value in that. And if you're completely new, you might think, why is he going off topic? Well, I just explained to you why. And the people that have been in the markets for a few years, they've at least have at least experienced it once or a similar experience, and therefore they can relate and they can appreciate me sharing that wisdom with you. So let us take a look at the following: how to detect if the session is likely to expand. First of all, we must know point A to point B, meaning we must have established a draw on liquidity on the highest possible time frame, relative, of course, to the time frame that we're going to trade. There must be low resistance between A to B, meaning that there's a likelihood for the market to immediately just expand towards a price level that we're interested in. Intermarket relationship is important to confirm whether or not a session is likely to expand. If you want to listen or find more information about intermarket relationship, I would highly advise you to watch the previous lecture in which I shared a lot of insights on intermarket relationship. Because intermarket relationship by itself is a very important topic to discuss and to share insights on and research. And finally, is the lower time frame institutional order flow supporting the thesis from point A to point B taking place? Meaning, is the lower time frame institutional order flow supporting the idea of the market expanding? Session profile conclusion. You must refer to the economic calendar, the higher time frame or institutional order flow, the lower time frame institutional order flow, and intermarket relationship to determine how the current session is likely to deliver, or what the current session's delivery profile is likely to be. Intermarket relationship. First of all, you need to look at correlated markets or inversely correlated markets to determine whether or not these markets are moving in sync. If they are moving in sync, we can anticipate nice delivery. If they are not in sync, we can anticipate choppy delivery. Nice delivery meaning very clean runs with a lot of PD arrays acting as resistance or support on price. And not in sync being choppy delivery, meaning that the market goes sideways for long periods of time, expands, maybe retraces deep, maybe not forming any PD arrays at all, just very messy delivery with a lot of time distortion, consolidation inside of it. In sync being that the markets are behaving in the correct manner relative to each other. Refer to the previous lecture if you want to learn more about this, but simply said, in sync being is that the markets that are highly correlated, either inversely or exactly in the same manner, should be delivering in a certain way in relationship to one another in order to confirm one-sided institutional order flow. For inversely correlated markets, this would mean that one should, for example, go higher whilst the other should go lower. For correlated markets, this would mean that one market should make, for example, a higher low, and it should mean that the other market is making a higher low as well. If it does not, and that market trades a lower low, that could be a sign of SMT. However, when one of those markets creates a higher high and the other one creates a lower high at the same time, there's SMT on both sides of the marketplace. And whenever there's SMT on both sides of the marketplace, we can anticipate very choppy delivery because the intermarket relationship is not confirming one-sided order flow and therefore expansion. The only thing that it is confirming is that it is confirming very choppy delivery being the case. We're now going to take a look at macros and price delivery. During our time windows, the market should behave in a certain manner once it reaches our point of interest. These time windows are our times of interest or our macros, whatever you want to call them. These times are familiar to you now if you've been paying attention to the model series thus far. If you have made it to the 6th lecture, I'm sure you're aware of what I'm referring to. The reason why time is crucial is because if we understand that these markets are driven by algorithms, that means that these algorithms should behave in a certain manner during a specific time window. And if they do not, if those signs are not present, it's the sign to us that, okay, maybe this session or this whole day is not going to be it. If the market does not deliver in a specific manner during our time windows, we disengage because ipdax is showing to us that it's not going to deliver the way we want it to deliver today. If the market does begin to behave in a certain manner during our time windows, we need to remain patient until the prey walks by. And when the prey walks by, we shoot. We shoot the prey because it's time to eat. Notice that everything that I'm outlining to you can be automated. And when it can be automated, it means that it's algorithmic and it means that it's objective. That's the whole goal of this model series. And it's exactly what the majority of people that even go through this series will not understand. They think it's just a pattern. They think it's just, oh, this is something. No, we're writing code together. We're creating an algorithm together. We're thinking like an algorithm. And by doing so, our trading becomes very mechanical. Do this, don't do that. So here we can see a random day of the Nasdaq's delivery. And what you can see is that I've annotated the macros/times of interest for us. First of all, the 9:45 to 10:15 window is a time of interest for the AM session. What we can see is that from the 9:30 opening, the market repriced higher and it then turned around to offer sell side lower. At 10:07, the market formed a low during our time of interest, 9:45 to 10:15, and it began to show signs of reversing. And from there on, we saw bullish order flow all the way towards the 9:30 buy side liquidity. Notice that every single time of interest is being utilized to expand price, meaning we see it begin to expand here, sideways, very slow delivery. 10:45 comes along, boom, there it goes, higher, sideways. Wait. 11:45, boom, expand. And that's what I mean when saying to you that during our times of interest, during our macro windows, the market should behave in a certain manner to confirm one-sided institutional order flow. If it does not, it's our warning sign to maybe throw our stops aggressively or get out at all. Let me now annotate some imbalances for you. What you can see is that I've annotated 3 imbalances, or 4 if you count these imbalances as 2. What you can see is that this imbalance right here formed during our time of interest. Market reprices into it and notice where the low forms. Inside of that price range that formed during our time of interest.
Market begins to expand higher, keeps on reverting to those two imbalances. Then 1045 comes along. Market begins a buy program, BC forms, it retraces, there it goes, expand. New BC forms right here, market retraces, begins to expand slowly. 1145 comes along. Market retraces into this BC that it already traded into prior. Purchase relatively close. Boom, there it goes. Begins to expand. What I'm showcasing to you is how time moves price. How the market begins to move during specific times. And this does not occur every single day on the session or on the market and during the session that you're looking at. And therefore you need to understand that it might occur on another market, and that's okay, because once a week at least you will see the precision be present. Here we are on another chart, and what we can see is that from 9:45 the market retraced into a CB that formed after the market formed a high after the 9:30 opening. Market respects that CB, notice that the wicks are tapping into it, and the market begins to expand lower. New CB forms here after displacing below this low, important low. During our macro, during our time of interest, market retraces and it continues to lower. Notice that this delivery right here is a beautiful algorithmic price delivery where you see every single premium ray gets utilized as resistance on price to continue lower. Market consolidates right here, eventually goes even lower. And here we can see the final example for this lecture, and it's the following. What we can see is that during 9:45 to 10:15, the market begins to expand to the downside. Multiple CBs form and multiple times the market retraces into those CBs and forms highs in them before expanding lower. Notice that the market is predetermined to go lower during this time window and a sell program originates. But until when can the market go lower, you might be wondering? Until what time is it allowed to go lower? Until the next time of interest. So from here, a high forms around this time window, and then the low comes in around the next time of interest. So what we see is that the market moves from time of interest to time of interest. High during this time of interest, low during this time of interest. Now imagine if you were short above here, anywhere in this area, and you were trying to take a time-based partial. What could you utilize to take that time-based partial? Or what could you utilize to determine when you should take a partial? Besides, of course, price levels. Time. Because if you know that 10:45 to 11:15 is a crucial time window, when it arrives and you see signs of reversal occurring, you know, okay, now I should probably get out because it's likely to retrace deep. And that is what you see. You see beautiful bullish order flow where every single discount array is acting as support on price, and price has one objective, repricing higher, all the way back to the entry here if you went short up here. To conclude, you might feel like I have given you two specific rules, but it is exactly through these rules that the feeling of randomness about the markets gets removed. Because by giving yourself first of all a structure through which you internalize price action, a lens through which you view the markets that is based along the first of all economic calendar, the environment, and then going down into the lower time frames to look for very specific characteristics of algorithmic order flow, you begin to see signs that repeat. And if you see those signs repeat, if you see those signatures be present, then the feeling of randomness will automatically disappear. But that feeling of randomness will always be there unless you start submitting to accepting that environment selection is key, knowing when these things are likely to work and when they are likely not to work. These concepts, they work during very specific weeks, days, and sessions. If you know this, If you can establish this, why would you worry about the periods that are deemed low probability? Why would you even consider looking at those low probability environments? During this lecture, I've given you a few reasons why you're probably trying to do so. And I truly hope that after you are done finishing this lecture, after you are done viewing this lecture, I must say, that you begin really controlling yourself more and only paying attention to the highest probability environments. So here's a homework assignment that I've made up for you. I want you to go into your own charts and try to really digest what a high probability environment looks like. I want you to pay attention to all the details, meaning I want you to do top-down analysis, starting with the high time frame institutional order flow. Is it clear where the market is drawn towards? Yes or no? Is the economic calendar supporting that the market should draw towards a specific price level? And then go into the lower time frames to see if intermarket relationship is confirming that a specific session can be deemed as high probability. I want you to try and find 15 high probability environments and look for the model so far presenting itself. You will probably be surprised about how many times it occurs. And the reason why this is a very important homework assignment is because the FOMO, the fear of missing out that you are right now experiencing probably, you want to be in every move because you explain why every single move occurs. The FOMO will be tackled by digesting and understanding how many times these things really occur. And when you truly see how many times these setups present themselves that are high probable, that FOMO will disappear because you will come to realize that you only need one a week or two a week and you're done. You're literally done and you're outperforming everyone. I want to thank you for watching this lecture. Next week's lecture is going to be about psychology, and I want to include risk management as well, because I believe that those two topics are topics that will be very important for you now that you have an understanding of what you're looking for and when you're looking for it, and when you're especially not looking for it. Please try and complete the homework before the next week's lecture, and that way you will be able to be guided as best as possible. I want to thank you for watching this lecture and I wish you all the best. Be safe. Hello there. Welcome to lecture 7 of the day trading model. This lecture is going to be about risk management. This lecture is going to contain by far one of the most important components of this whole lecture series. This lecture will dive deeper into the concept of managing risk, trailing positions, managing these positions, managing our own psychology, and managing our own mindset. First of all, I must give you a risk disclaimer. TOTK, or the ones that know, is solely an educational platform. This means that all the information and knowledge that gets shared throughout this lecture series is meant purely for educational and/or entertainment purposes only. If you want to read the full risk disclaimer and terms of services that you agreed upon when signing up for the mentorship, you can do so on theonesthatknow.com. We will first take a look at the table of contents. First of all, we're going to speak about risk management from a technical stance. This means that we're going to take a look at some technical chart-related risk management tips. Secondly, we're going to take a look at psychological risk management, meaning how we handle risk management from a psychological stance. This will be the focus of this lecture. So let us take a look at the technical aspect of risk management. First of all, we must determine the following. What leads you to take a trade? What is your protocol? If there is no protocol in place, if there are no rule-based systems in place that make you decide whether or not you want to be a buyer or seller, you are gambling. You are gambling, and you are already starting out on a loss when it comes to risk management. Because in order for someone to manage risk effectively and accordingly, they must have rules to adhere to. And if these rules are not present, then you're just basically getting thrown around by ipda. Secondly, the next question that has to be answered is what invalidates your idea? From what moment on is your trade or trade idea no longer valid? These are questions that you need to be able to answer right away when they pop up. If you do not have your model yet, you're probably listening to this and you're like, yeah, the answer is still no. It's because you don't have a model yet. However, for the people that do think they have a model, but are not able to answer these questions directly within a short period of time, that means that the model is not understood properly yet or isn't even defined properly yet. And of course, it is also possible to know what validates the idea. How do you know whether or not your idea is likely to play out? What variables can you add to that? We will all discuss it during this lecture. First of all, we can take a look at institutional order flow confirming being drawn to one level, meaning that we have established that there's a clear point A where a run begins from and a terminus, point B, is present. In a chart within a buy program, this looks like the following. Point A is down here. This is where the buy program began. And point B is where the buy program is likely to end. This is our draw liquidity. And to confirm that the order flow is being drawn to that level at point B, we can take a look at how every single expansion retracement is followed by a new expansion leg. Every retracement is of course into a discount of that current range, and then the market continues higher because it's drawn towards a price level above current market price. This is what validation of a buy program looks like. Validation of a buy program can, however, also look like the following, where there is an expansion followed by a retracement followed by an expansion, and the market just goes sideways. As long as it does not displace to the downside, we can anticipate higher prices to be next. And therefore, that is what we mean with IOF confirming being drawn to a specific level. Because if price would begin to displace, for example, below this row, why specifically that row? Because that row retraced into this expansion leg right here, that could signal a change in the state of delivery. And therefore, this is how we confirm one-sided institutional order flow when bullish. When bearish, point A is up here and point B is down here. The institutional order flow that is one-sided is bearish, and it occurs from this price level, which is point A, and it goes towards point B. Every single expansion leg lower is followed by a retracement higher, followed by an expansion, etc. The moment that price would displace above a high that got created here, that set up an expansion leg, we would have to be careful with thinking that point B is likely to be reached. However, this is also the way that the schematic can look, where we see an expansion, retracement, expansion, consolidation. And again, as long as price does not displace above this high which set up this expansion, there is nothing to worry about. And order flow is confirming that it is likely to be bearish and that we're likely to draw lower. And the moment that order flow would, for example, displace to the upside, meaning that we would see a displacement above a high that set up an expansion leg, then we had to be cautious, because then we would have to consider the possibility of our idea of point A being the inception of a run towards point B being wrong. And if we see those signs that confirm that we're wrong, we need to get out and we need to accept the fact that our analysis was offside, and we then gotta move on towards the next opportunity. We're now going to take a look at invalidations in the form of institutional order flow changing against our direction that we were anticipating. If we anticipate that this point A was going to set up a run towards point B, and we begin to see the falling occur, then we are wrong with our analysis. Meaning, if we anticipated the sell side of the curve to turn into the buy side of the curve from point A, and the market begins to expand, it retraces and it expands, but it fails to find support, so to say, inside of the range from this low to high, and it displaces lower, then we know we need to get out, because institutional order flow is not confirming bullish order flow. The reason why this is not occurring is because point A was not the real point of interest from where a buy program was likely to unfold from. So when we see that price displaces below this low, that's an exit. That means that we can trail or stop aggressively, because we already know that if price was going to continue higher, it would have formed a shallow retracement here, and then boom, there it would have gone. And by managing our positions like this, by allowing for very specific signatures to occur, we know that when these signatures do not occur, so it means when the order flow is not supporting the idea that price is going to continue to expand higher, then we know that we're offside, and therefore we know that our stop loss is likely to get hit. And that doesn't mean that our stop would have to remain here if we entered inside of this retracement leg, and our stop would have to remain here. No. Why not? Because if we know that this displacement leg lower should not have occurred, the moment that price really displaces below this low on the lower time frames, means that we can already get out and save equity. And now the thing that the majority of traders might think when they hear that is the following: but what if it takes out the low and then goes? So what? So what? Doesn't it mean that you can't re-enter? There will be a new retracement leg after an expansion leg higher, right? Why are you scared of entering and exiting positions? Because if you are asking that question there, it first of all showcases FOMO, fear of missing out. You don't want to miss out on a move. And secondly, you do not understand yet that whenever you see the market take you out of a position, you can always re-enter if your idea isn't really invalidated just yet. So that means that if we see, for example, this low get ran, turtle soup occur, meaning sell-side liquidity get purged, market immediately reverts higher, and then expands above the CBs that form inside of this leg, and we see a BC form, that retracement leg is a buy opportunity to go higher. So are you seeing how there are rules on top of rules, and it is so advanced? And by listening to me explain this simple breakdown right here, by simply looking at a chart, no write-ups or anything, you are learning, and you are learning rapidly. So let us take a look at the bearish example in which we had a point A right here, from where we were anticipating the buy side of the curve to turn into the sell side of the curve towards point B. And what we see is that the market expands lower, retraces, expands, and then it reverses, it displaces to the upside. above this high. What did I just explain to you? When a high gets formed that gets utilized for an expansion leg lower, that high should not get violated above or should not get displaced above if the smart money reversal is in fact in. So that means that the moment that price displaced above this high, we need to be careful with thinking whether or not point A was really where the SMR was gonna take place from. Because if it didn't, then it was just engineering of buy side liquidity to be targeted inside this run higher. Let's say that the market trades above this high here and it immediately rejects it. It soups it, so to say. And it then begins to displace lower. There's always a new entry opportunity for you. So my advice to you would be investigate whether or not there's any validity about what I'm saying right here when it comes to gouging order flow, when it comes to getting a feeling for how price is delivering. It is so simple when you understand it. It is so easy and practical when you understand the logic that I just described to you. And I explained it over very simple charts. But when you study my breakdowns, when you study all of my reviews, this is how I try to break down price to you. Because trading is easy. You are the one that is adding complication to it. And that's a topic that we will discuss during the psychology part of this lecture, which is where I want to put the emphasis. And you might be thinking, risk management, why are we speaking about invalidations, confirmations, whatever? It's because risk management isn't just a calculation of how much RR can I make, or how much money can I make from this trade, or how much money can I lose from this trade. That's the most simplest form of risk management. And that's the monetary side of things. That's the equity side of things. And that's very important to know and to have rules for. But it is not something that none of you should be worried about right now. Because you're not at the stage, likely yet, where you should even consider trying to trade with real money. Because you don't understand the technicals yet and you don't understand yourself yet. So to then try and go out there and follow some rules that I would share with you when it comes to, oh, this is how much you can risk, this is how much you can risk per position, this is what happens when you win, this is what happens when you lose, would be dangerous. Because then you would go out there and you would think, well, this is what he said, and you're not going to focus on the protocol, you're going to instead focus on what is there to gain, what is there to lose. And it is not how I want you to think, and it's not how I'm training you to think. I'm training you to think by simply one rule, and it is following the protocol. And the protocol consists of so many different rules, and it is so advanced, but at the same time, very simple. So let us take a look at psychology. These markets are programmed to play in on your weaknesses as a human. This means that you as a human possess weaknesses that the market will seek to exploit, or I should say, the algorithms that are in control of price are trying to exploit you. And they do this by making use of the weaknesses that every single one of us possess. In order to become aware of our weaknesses, I'm going to share a list of potential weaknesses that you might be struggling with. For example, we can be fearful, we can be emotional, we can be impulsive, we can be overconfident, we can be greedy. These weaknesses get played in upon to make us do stupid shit. The money in the market moves from the gamblers to the professionals. So if we know that, if we have now defined what weaknesses are out there that we could be struggling with, we must learn how this money transfer from the gamblers to the professionals occurs. And the way that this works is through the following. A gambler is driven by emotion. He is driven by all of these basic character traits that can influence his decision-making process. The pros, however, know that if they let their emotions influence their decision-making processes behind the charts, that they will do harm to themselves. And therefore, they understand that structure has to be put into place, or a system has to be put into place that can save them, that can basically guard them to prevent them from doing those stupid things. Because the gamblers will keep on pushing it. They will keep on going out there and they think they're following their model. They think they're doing everything right, but all they're doing is simply projecting their own feelings onto the marketplace. Whilst that is not the way that you can objectively internalize what price, what IPDA is telling you, whether or not the institutional order flow is still on your side or whether or not it is changing. And I know that some of you are probably listening to me speak and reading through this list and are probably thinking, damn, this hits home. Yes, that's exactly what it's supposed to feel like. Because when you feel like that, and when you are aware of these character traits that are hindering your performance, that are hindering your development as a trader, you can change them. You can go out there and you can look for ways to learn how to deal with that behavior. Because the emotions will stay, but the behavior around those emotions or that originates from those emotions can be changed. That can be adjusted. It can be limited. There can be a structure or a system that says, okay, whenever I feel this, I don't do that. Whenever I feel that way, I do that. And during this lecture, I'm going to share with you rules of engagement and disengagement that will help you within that process. It's important to note that I will just share examples. I will just share schematics. The only way to control our flaws is by putting systematic rules in place. These systematic rules get put into place through journaling and realizing what repeating behavior has to be adjusted. Look, journaling is by far one of the best things that every single trader can do if they are still trying to figure out who they are as a trader, what is working, what isn't working, the technical side of things, but also who am I? How do I behave? How do I react to certain things? How does that influence my decision making process, etc.? That is where journaling plays a crucial role to determine answers to those questions. Because through the answers to those questions, you will be able to learn to master yourself. And that mastering takes place through the implementation of systems. Let's take a look at rules of engagement and rules of disengagement, because those are the systematic rules that I'm referring to. Here we can see an example of rules of engagement. Please do not be scared by all of the boxes and lines out there. What we can see is that, first of all, this is where the whole schematic begins. The first question that is being asked within this schematic or protocol for rules of engagement is the following. Am I noticeably worrying about something? Meaning, is there something on my mind right now that is controlling my thoughts? That's the only thing I can focus on. If there is, I will walk away from this charts. Because if I do not, then I can't be purely focused on the charts because in my mind I'm somewhere else. If I'm not worrying about something, the next question that is being present is the following. Am I in a calm state of mind? No. No trading. Walk away. If I am, however, in a calm state of mind, I can open up the charts and run the technical process, meaning the technical protocol. Look for this. This is of course not important right now since we're focusing on the psychology. But This is where the technical process comes in play. The technical checks get made and the main question get asked. Is there anything in the current market environment which I can deem as high probable? If there is, I will continue. If there isn't, I will walk away and reassess, because I know that a high probable environment will come again, and that's the environment in which I want to push it. I do not want to push it in a low probability environment. So let's say that there is a high probability environment. The next step is the following. The technical edge that I am in possession of, my model, will be looked after. If a setup is present, I will trade it. However, if there are any doubts about the setup, I do not take it. If there is no setup present, I wait or walk away. Eventually, after the trade gets taken, I will log the outcome. These are all the rules that are present within this example of rules of engagement. This is of course a very simplistic schematic. The questions are rather simple and rather short in its totality. It can be made way more advanced, but I hope that this example has given you an insight on how you can create basically your own process for rules of engagement. It all begins by asking questions to yourself and offering two options: yes or no. Highly probable, yes or no. Do I feel well? Yes or no. Am I in the right state of mind? Yes or no. And then for each option, there will be follow-up steps. Do this or do that. Don't do this and don't do that. And by doing so, you can objectify your process. So I made the schematic with Miro.com. I would highly suggest you to take a look at it if you're going to try and make your own schematic like this. Here we can see the example of the rules of disengagement. What we can see is that the rules of disengagement example schematic is very similar to the rules of engagement schematic. However, some boxes have been made gray to showcase that this is a disengagement that's taking place. What we see is that all the way until the box that signals or showcases that a trade is being taken, everything is the same as the previous slide. When we study what occurs after the box that signals trade, we can see the following. The main question that we need to ask ourselves when being inside of every position, or any position, I should say, is IPDA supporting your idea? Is price showing a willingness to expand away from your entry towards the anticipated draw liquidity? Meaning, is IPDA showing to you that you are in sync, that you are on the right track? If it isn't signaling that, if the answer to that question, which is highlighted or made bold, is no, then you manage your trade aggressively, meaning you look for signs that could constitute to IPDA being bullish, for example, if we're anticipating higher prices. However, if there are signs present that signal that it might go lower, that it might reverse, that the order flow might change towards sell side liquidity, then we need to be managing our positions aggressively and cutting our losses tight soon. Let's say that we do see IPDA supporting our idea. What we then do is that we remain in until the draw on the liquidity gets reached and we partial there or we close the position fully. Either how, we log the outcome of what happened. Logging or journaling is by far one of the most important things that you can do because it showcases to you how many times something occurs and something plays out. The second question that's impossible to ask yourself whilst being inside of a trade is the following. Are you fearful or anxious whilst being in a position or in the position? If you are, you need to cut the position and read the tape. Log the outcome. If you aren't, then this question is irrelevant and we focus on the main question at hand, which is the recognition of institutional order flow. Because if you can recognize institutional order flow changing or shifting, so to say, then you can manage your positions aggressively and you can say, well, there are signs present that can make it go up or down. This is not highly probable. Therefore, you should walk away. Again, this schematic was just an example, so please start making your own schematics when it comes to rules of engagement and rules of disengagement. Now notice that everything here was purely meant for basically the way that you act and the way that you behave as a trader. However, these type of schematics work perfectly as well when it comes to developing your own technical approach if you do not have one just yet. Handling losses. Losses are a result of us being wrong with our analysis and the market not delivering to our anticipations. This means that a loss can never be the fault of the market. This means that every single loss is your responsibility and your fault. You made an analysis, you put on a trade, and the market showed to you that you were wrong by taking you out for a loss. And you can't be scared of realizing that loss. You can't be hoping that the market will get back to break even so that you can get out of your loss at break even. When the market reaches your invalidation level, you are out. And you accept that. And you submit to time and more data to see if your analysis was really wrong or if your trade management was wrong. It is good that we take losses and that we get taken out of our positions because our analysis was offside and therefore we need to be away from risk. We need to be away from the place where we can lose equity when we know that the environment is not according to what we anticipated. A good loss takes place when you follow your rules of engagement and disengagement. A bad loss takes place when you did not follow your protocol and therefore did something that was not according to your rules and you took an unrequired loss. Because during this lecture I've already said it multiple times, following your protocol is the number one thing that you should be worried about and that you even should be caring about. Because if you follow your protocol and you know that your protocol contains an edge that you know to be true due to your own historical market data research, your backtesting, and your tape reading, etc., you know that not following that edge is not smart. Therefore, I want to give you a psychology conclusion. Because within this relatively boring lecture, I've shared very important topics and insights with you. And to conclude, it all begins with not acting like a fool. It all begins with simply submitting to time and price in accordance with your protocol. Anything beyond that is dumb. If you take trades outside of your times of interest, outside of your time windows, times that you are looking at the markets or should be looking at the markets, what are you doing? If you are a New York trader, why are you looking at Asia? Commit to following the protocol day in, day out. And success will arrive. one day. You should make it an obligation to follow the protocol. And you should check with yourself at the end of each day whether or not you followed the protocol or you slacked off. You need to be brutally honest with yourself because that's the only way to grow and develop. You need to journal everything, and you journal everything in a private manner, meaning you hold your own private journal, and that is your best friend. You share everything with it, and by writing stuff down, by writing things down, you can learn from those experiences. And you will also be able to forgive yourself if you did something stupid. Because you said, okay, well, I did not follow the protocol. I did not do what I was supposed to do. I just wasn't there today. And then you accept that, then you move on. You don't dwell upon it. You write it down, and it ends right there. Because if you would dwell on it, then you would automatically cause emotion that would influence you the next trading session or day. So think back to the weaknesses that we as humans possess that I outlined earlier during this lecture and how they get utilized or exploited to extract money from the gamblers to the professionals. So I want to give you some homework with regards to everything that was discussed during this lecture. However, before I do so, I want to share with you that I will be speaking about equity management. I will be speaking about how to actually manage positions over a longer period of time. However, I came to the conclusion after planning for this lecture that it would have been better to simply focus on the technicals and the psychology side of things. Because if I would have now shared with you, okay, we're now going to discuss the equity management, we're now going to discuss the percentages game, we're now going to discuss how much we can risk and how much we can win. After I had shared the technical important knowledge and secondly the psychological insights, you would forget about those two because you would only think about the numbers. Oh, he says you can make $2,000 if you risk 1,000 or $3,000 if you risk 1,000 on demo accounts, of course. But you get my point. That's for another day. That's when you're ready. That's for when I have shared what I wanted to share and when I believe that I have given you enough to build your own protocol completely. And when you get to that stage, the equity management will be the cherry on the top. And it will be the most important thing on the cake. So let us take a look at the homework for this lecture. I want you to begin journaling your thoughts and feelings throughout the day and especially your pre-market thoughts and feelings. Think back to the protocol example for the rules of engagement that was provided during this lecture. It begins by asking questions. And by asking questions to yourself that you can easily answer each day, you can see or you can test how you're feeling. I want you to also begin journaling your thoughts and feelings during the trading day. Either, for example, right before you put on a trade, right after you exit the trade, or even whilst you're in the trade. Because by doing so, you're able to see how you're speaking to yourself. Is it a positive inner dialogue or is it a negative inner dialogue? Is the inner dialogue, for example, held by fear or is it held by confidence or controlled by confidence, I must say? I want you to begin journaling the outcomes to your trades. This speaks for itself if you aren't doing that yet. Your trades being, of course, demo trades, non-financial advice over here. And I want you to begin reflecting on those journals every single week to see if there are any repeating phenomena that have to be tackled. These phenomena get tackled by putting systems into place. I want to thank you for watching this lecture all the way to the end. I know this was probably one of the most boring lectures thus far within the whole model series. However, it is by far one of the most important components to this lecture series. I wish you all the best, and I look forward to speaking with you next week. And I'm not disclosing yet what I have in store for next week. Be safe.